不懂啊。
We'll see you around the timeline. Feels good to be back.
I think that Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm with Jesse from Base. Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Headed to the top. If we're not already at the top, we're going to the top.
We're going.
Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for the Rollup.
The institutions aren't coming, they're simply here. It's the golden age of crypto, guys. Get right, let's go. Welcome to the nest. See you on the show.
Day 2.
Welcome back to day 2, baby. Let's get some love,
Digital
man.
Assets
We're doing a
Summit,
marathon
day 2.
stream today. We are live, baby.
We are live.
We are live, presented by OKX, our lovely friends.
Yes.
One of the biggest exchanges in the digital asset landscape. Let's give OKX some love. The biggest Asian
exchange faster, better, stronger than your average crypto exchange. These guys are putting in real work to onboard institutional products, RWA products on chain onto their application, guys. Let's get into today's topics. We've got a lineup of a lifetime
Should we go
today.
through this lineup? Absolutely insane lineup. Why don't we just speed run through the entire
Digital
thing?
Asset Summit Day 2.
Day 2, we are going to start off hot with Charlie from Chainlink. Then we're going to get into Chris from 1KX. Then KPMG. We have Franklin Templeton and Ondo talking about their most recent partnership. We have drumroll, Vibhu from Solana, the marketing guy who's not a marketing guy. We have Santiago Santos, the most bearish person in crypto. We're gonna find out here. We've got Jeff Park. Very excited to have Jeff on the show from ProCap. Then we're just gonna keep it rolling. We've got Muriel from Optimum. She's gonna be coming on with Tarun. So Tarun is gonna be welcoming the show. I've got a panel with him tomorrow. RJ from Align,
Yes,
Miller Whitehouse-Levine from the Solana Policy Institute, Mike Dudas from Six Man Ventures, Austin Campbell, Phil from Li.Fi. Yes,
Insane.
sir. And we're gonna have the framework guys, Parker, the third framework guy is going to be welcoming
Let's get
us
some love, man.
and closing
It's
out
gonna
the
be
show.
lineup today. It's gonna be unreal. Let's go, man. We got markets and weather. We got an institutional bull market is very much here, and as Rob mentioned, founders, CEO, and more joining the show today.
Any takeaways from day 1 before we kick off day 2 here?
Guys, my takeaway is that we are not in a bear market. We are in an institutional bull market. There is more happening in this space than I have seen in a long time. This conference, as Yano tweeted, was to bring optimism back to the space. It's happening. It's here. I know there's a token bear market. Unless you've been following our Tau trade and our hype trade, there is a lot of bullishness happening here on the roll-up, guys.
Give us some air horns. And behind the scenes.
Let's go, BitSensor, man.
Let's go.
Of course, today's topic is powered by Trezor, the
Trezor.
hardware wallet for your self-custody crypto, guys. Use
absolutely.
code ROLLUP10 at Trezor.io to get access to Trezor. Now, guys, let's go into the markets and weather. Before we do, let me tell you about Frax. Frax is one of our cornerstone partners here on the roll-up. Building the infrastructure for the future of digital money, open, stable, and borderless. For more information and start using the future, visit frax.finance today. Guys, it is a little chilly out there today. We are not in the tokenization tower, but we are at the Javits Center, and it is 44. It is windy. It is sunny. We're inside. So I'm feeling good about it. And yeah, I mean, Rob, we're wearing suits today.
Every time I come up to New York, I somehow miss the blistering cold or the snow. I just get extremely lucky with the weather up here in New York. So I think I'm going to be coming back here more often.
There you go.
Which is an absolute pleasure. And yeah, I mean, look, it's a beautiful day out there. It's not as cold as yesterday. It's also greener in the markets than it was yesterday. Let's go ahead and get over to
Yes,
our
sir.
markets segment.
Yes, sir.
Weather, of course, sponsored by Relay.
Yes, sir. All right, guys. It is a bit of a green day today. If you've been watching BitSensor and Hype, risk is turning on again. A bit of a relief rally as Iran comes out today and says that they want to end the war. Oil has dropped sharply back under around the 90 range. There's kind of this
They also gave a
energy
gift.
shock panic shifting towards more of a de-escalation relief.
Apparently, they gave a gift to the United States.
What do you mean?
Trump says that there was some big gift. It was very valuable. It was worth a lot of money. Didn't go into
Interesting.
too much detail. Someone asked him whether it was nuclear related, this gift. He said no.
Interesting.
But then he said, someone else asked if it was oil and gas related to the Strait of Hormuz. He said yes. So we don't know
Interesting.
exactly what this present is
Well,
from
hope
Iran.
the war ends. I
Yes.
did see something that Iran was telling the U.S. troops to come closer on the ground and that they had been waiting for a while. I love the war movies. I just can't imagine this stuff happening in real life. Rates and dollar are getting a little bit softer. We had Felix on yesterday. He was telling us about his kind of anti-dollar debasement thesis, dollar rebasement. My uranium position looks great today, guys.
Oh, very
So
nice.
stoked on that.
Great to hear.
Yep. And Hype and Tau look amazing. So, guys, key drivers here, ceasefire, negotiations, and more. Generally just kind of risking back on And yeah,
I think it's important to note that we did see some action in the equities markets as of yesterday.
Yep.
As a result of the yield issue that came to light. The yield issue, of course, being that there's probably not going to be yield on stablecoin balances.
Yep.
Coinbase took a big hit. Circle took a big hit.
huge hits. Yeah.
And so, we're going to be watching that very closely. Obviously, there's a big presence here in terms of stablecoins. Circle's here. We're going to be talking with them behind the scenes and continuing to monitor this
Tether
situation.
May be getting a successful audit from a Big Four auditing firm. We'll see what that kind of happens, how that happens. I think that kind of drove a lot of the price action, actually more than the news about the clarity.
Really?
I think
Tether
that
getting an audit?
Yes, I think that the arbitrage around Tether, people got optimistic about that, and in turn shorted Circle, because the actual stablecoin yield stuff, it's actually favorable to Circle because they can basically keep their moat of passing yield back to users on kind of like idle balances if this happens, whereas others won't be able to. We'll see.
Right, so they can retain all the net interest margin that they're currently passing back. I worry that anyone who's not gaining yield from these stable coins is going to revert back to fiat or just end up losing out on market share.
Guys, all our markets today are powered by Zama. Bitcoin at 70.9, Ethereum at 2160, Chainlink above 9, and Near sitting at 1.3, also ready for its next leg. As this AI narrative comes together, I think Near is probably next, guys. Powered by Zama, who just had a huge announcement yesterday. Let's give Zama some love.
Absolutely.
They actually were able to form a really important partnership with a large group called T-Rex Group. We're going to cover it in a few. Let's get into the news. Let's get into the headlines for today. But before we do, let me tell you about Near. Near is the blockchain for AI. Near is the blockchain designed for AI native applications and autonomous agents. Start developing today at near.org. Guys, we had massive news in the Ethereum staking landscape. Bitmine has came out with Maven. They are planning to be the world's largest single entity staking operation and pushing for a future of post-quantum Ethereum staking. This is massive. Tom Lee acquired Peer2, which is one of the world's largest Ethereum staking businesses with about $6 billion of staked ETH, and they are now going to be building out a massive Ethereum treasury. Here's my take. Tom Lee recognizes that Ethereum needs to go to the post-quantum world. Tom Lee realizes that he is one of the largest stewards of the Ethereum protocol, and so it is in his best interest to push forward the post-quantum efforts as described by Justin Drake forward for the Ethereum protocol. This is not a charity business. This is not a little handout. This is Tom Lee putting his foot down and saying, we're going to be one of the largest Ethereum operating companies in the world, and we're going to push to make sure that this asset is post-quantum secure. And I think that is one of the most important things that Ethereum has over Bitcoin right now. And this is a massive win for Bitmine and all Bitminer shareholders.
As of 5 p.m. on March 24th, that was yesterday, Bitmine total stake ETH stands at 3,142,643 ETH. That's almost $7 billion of ETH that is currently being staked. Bitmine has staked more ETH than any other entity in the world, which is absolutely incredible. It's really no surprise that they're going to be verticalizing their stack.
And now after this, they will get more. They have an additional $6 billion of ETH joining their operation, guys. I mean, Tom Lee wants to build the biggest Ethereum company in the world. He's doing it with Bitmine, and he's doing it with this acquisition of Peer2, now known as Maven. Congrats to Ash, congrats to Pat, and the entire Peer2 team.
I have one take that, just on the heels of the conversation we had with Brian Pellegrino yesterday, part of the thesis around Zero, the chain, is that it's going to be production ready from day one. Now, we are going to be facing things that are almost unfathomable in the coming months to years. One of those being quantum security. I think it's important that we do have flexibility and we prepare ourselves for upgradability as these protocols mature and as we're faced with new challenges such as quantum. And so I think we are seeing two fundamentally different approaches here. You heard Brian talk about the Ethereum roadmap and how this is more of like very different approach on the zero side. I think Ethereum is in the stronger position as it relates to quantum security because they have already executed successful hard forks in practice. As this plane is flying, they're upgrading it in real time. If Layer 0 is thinking that they've solved it all from day one, I'm going to be very interested to see how these two very different approaches play out in real time as we're faced with challenges such as quantum security.
Most definitely, guys. We're going to move into one other piece of news before bringing our first guest from Chainlink up. We talked about this with Jim yesterday of Superstate. Invesco joins the tokenization race and takes over Superstate's $900 million on-chain fund. Guys, this is massive. Jim basically came in and told us that Invesco is now the major player of Superstate. Superstate is the technology provider to Invesco and its funds, and this is now enabling Superstate to scale all of their product offerings to the entire cast of characters and customers that are using Invesco's products from the commercial side all the way to the retail side. Superstate is working on new licensing as well that will enable them to have products available to just not just accredited investors, but to retail investors as well.
There's a bit more here, and we're seeing it play out across all the tokenization protocols. We're continuing to see the unbundling of the tokenization stack. And so obviously Superstate had accumulated about $900 million into this fund. It was their flagship fund. They said, look, we are not asset managers. We are a tokenization enablement partner. And that is the role that they're continuing to play. Then they will have Invesco as the asset manager of the fund. This is mirrored in the other partnerships and announcements that we've seen dominate this week. We were talking with Carlos Domingo, our friend of the show. Securitize was able to partner with the New York Stock Exchange. They're going to be the tokenization enablement partner of the New York Stock Exchange, and then we'll see a plethora of tokenized equities on top of this, as well as lots more tokenization agents, digital transfer agents, and asset managers. Later on today, we're going to have Franklin Templeton and Ondo talk about their partnership, and we're going to have them on, and they're going to be explaining a little bit more about what this divergence looks like, because it is very similar to what Invesco and Superstate are doing. Franklin Templeton is the asset manager. They are issuing the ETFs. Ondo is the tokenization enablement partner. So this is the pattern that we're going to continue to see play out. We are unbundling the stack, and we're getting more specialization as this industry and this sector matures. So I would anticipate that we're going to see a lot more of this. We're going to see more funds. We're going to see more asset managers, and we're going to see this complexity start to arise as there becomes more specialization in the tokenization stack. I would continue to watch out for this pattern as these funds mature.
Guys, we're going to get our first guest, Charlie, up here from Chainlink. He is one of their principal leads at Chainlink. And so what we're going to talk about with him is the evolution of what Chainlink is doing and bringing these institutions on chain. So we're going to pan back to Rob and I, and we're going to get started with Charlie here in just a few. And yeah, here from Chainlink, we had them as one of our core partners during the DC Blockchain Summit last week. And so looking forward to kind of getting more, chatting more with Charlie and the entire Chainlink team here in New York City. This is the beginning
Let's
of
go
day
ahead and
2.
cut off the news and tell you a little bit, because I am quite excited to speak with Charlie. Charlie spent 11 years at Citi. And so he's definitely got the institutional backing and the knowledge as far as what these institutions are looking for. We're going to be hearing about what exactly the value proposition is of them coming on chain and how these big institutions are thinking through some of the nuances here, because as we understand, sometimes you've got, the banking department that is at odds with crypto. This is right next to the investment department or the asset management department that is looking at the volatility in this industry and are very excited about getting involved. So even within these institutions, there is some combativeness and friction as we look to the digital assets industry as a whole. So I'm quite excited. I think
so we're going to get Charlie up, Rob, in just a second. We're going to take a super quick standby, one of our only of the day. We're going to get Charlie situated and sorted, and then we're gonna rip, guys. We are about to rip
Don't go
this
anywhere,
one
guys.
hard. See you guys in just a second, all right?
fun admin. Like, who are the? I got to ask, who are the winners and the losers of all of this? And we have 4 winners on stage. Obviously, don't gloat too much.
Of course.
But like, yeah, who? Like, what other? Where else are we going to see disruption?
Well, I think it's easy to start with where do we see the least amount of disruption? And like, I'm looking 5 years forward, and I'm saying this as an individual, and I'm not an expert, you know, yada yada. I think the least amount of disruption is eventually going to be at the custodian layer. I think the job of a custodian is going to change a little bit. You know, you record ownership of a security on behalf of someone. You record ownership of a security on behalf of someone using a token. I actually don't think that goes away. People never are going to truly want to manage their private keys. They're not going to want to like actually change like, you know, how they own things. So I think custodians are going to change the least. I think, you know, on the other end of the spectrum, we have exchanges. This is good and bad for but you know, I think we're going to move from a world in which, you know, in the US, there's really only like 2 equity exchange groups and like venues where things trade to a world in which like equities are trading on like the same stocks on like 100 different venues where it gets really easy to make an order book. And there's almost no reason why the tokens can't move into brand new systems. I think exchanges are going to change the most. In the middle, I think we have like broker dealers. Their job won't really change that much. They'll have to integrate tokens and new systems instead of, you know, just the old way. And, you know, against that entire backdrop, we're going to have startups trying to destroy everybody and, you know, take away their market share. But, you know, I think least is on custody. I think most is on exchange. And I think everything else we'll wait and see.
I think wary of giving stock picks on stage, so not financial advice. But I kind of slightly disagree on the custody side. So I think it's going to be a bit of a bifurcation. So you'll have some people who will be kind of more, I guess, first adopter mentality, who will be like, they just want the raw, ugly experience at all times, but they love the feeling of being a first adopter, and they'll want to self-custody, etc. But then you'll have institutions who essentially remain using a custodian, but they'll essentially just see it as like almost paying, 2 bips a year or half a bip a year for the risk transfer. And you're paying almost essentially for an insurance premium to transfer that risk to another kind of GSIB bank or something like that. So I think it's not necessarily, I think a huge part of their book will be disrupted, but some of the body won't. I think the massive disruption comes to parts of the plumbing which are very manual. So things like fund admin, kind of data reconciliation, those things can start to become much more automated, and particularly in a world of AI, can be AI assisted. I think asset managers like ourselves are probably beneficiaries in some regards, because we can streamline our back office and be a beneficiary of the utility, be that kind of collateral management, but also around kind of fund structures and underlying, and we might choose to be self-custody, for example, and benefit from that. But I think we're also threatened on the perspective, which is that if you are lowering the access to tools like collateral management, you're lowering the access to the hurdle rate to access to those instruments. So we might also be threatened from the perspective of having almost like a Robinhood 2.0 phenomenon in our structure. So we need to be wary of that and making sure that when we're charging management fees, we're adding alpha for that. So there's kind of we need to stay feet to the fire on that approach. The one that I think is the most interesting who will be really threatened is around distributors. So less the exchanges, but more kind of like the stock platforms, the fund platforms, particularly like in the UK, Hargreaves Lansdown, in the US, like AJ Bell, the Charles Schwab, those sort of players. Because if you start to move, particularly on the consumer side, if it's all in wallet.
Ladies and gentlemen, we are back live at DAS in NYC, day 2 here at the Javits Center. Today we are joined by our first guest, Charles Dunkin, the Principal Solutions Lead at Chainlink, a man with extensive experience in finance, bringing a lot of these institutional flows and adoption on-chain. Charlie, welcome to the Rollup.
Thank you.
Chainlink in DC last week was huge. This week we're in New York. How's the conference been for you?
Conference has been great. A lot of great conversations with banks, asset managers, right? You can see that all of Wall Street is here and actively talking about how to explore blockchain technology.
Yeah, man.
You spent 11 years at Citi,
Yep.
and so you've got an extensive knowledge bank as far as what these institutions are looking for before they make a technological shift. Just curious about your experience there. Talk us through what you were doing with Citi, and then ultimately how you found Chainlink.
Yeah, absolutely. So I spent 5 years investment banking on the debt capital markets desk, and then 5 years as a product manager building the technology that supports capital markets issuance at Citi. So great experience for how banks think about enterprise grade technology solutions, and have been following the market and knew that I wanted to get into the space. And for me, that was always Chainlink because of the enterprise grade security that they provide for these institutions when connecting to blockchain, which is really what they care about.
Yeah.
Yeah, I mean, do they ever, right? I actually put out a tweet that said, if the tokenization thesis is correct and trillions of dollars of assets move on chain in the coming years, which company will benefit the most? And folks had a variety of answers, but it was around lending markets and DeFi protocols, exchanges, and oracles.
Yeah. So I also do think that traditional finance institutions are well poised to benefit from this as well, right? Part of the benefit of blockchain technology is increased efficiency, right? I saw firsthand building capital markets technology, how complex it can be, right? Each bank spends tens of billions of dollars each year on these technology systems. And so being able to have more efficient markets and reduce your tech spend is going to greatly benefit all of the participants that are here this week.
Yeah.
Yeah.
A couple of the most prominent announcements this week have been from the tokenization partners and the asset managers that they're working with. New York Stock Exchange working with Securitize, Superstate working with Invesco. I'm curious, it seems like we're starting to get more competition and more specialization in the tokenization market, but oracles are underpinning a lot of this. Chainlink, can power tokenized equity feeds. You guys are working with S&P on some stablecoin things. Just talk us through, is there kind of this competition layer on top and you guys are just powering it all very similar to DeFi?
I would say that's a great way of putting it, right? We are the infrastructure that is underpinning, bringing data and connecting systems on chain, right? I'll say that all of these institutions are enthusiastically investigating how to do this, right? And whether you're just bringing data on chain, we did with S&P bringing their SSA scores on, or if you're orchestrating systems, you need the reliability that Chainlink has proven that it has over the course of X many years.
Yeah, reliability and resilience, and it's no wonder that Coinbase comes out today and announces that they're doing a major data integration with Chainlink. They announced order books, spot prices, perp futures, e-mini futures, and more on Chainlink, powered by Chainlink. What does this mean to the community? What can you say as to why Chainlink is the right fit for Coinbase? And what does this kind of open up for you guys from the establishment of the brand perspective? Obviously, Coinbase is a massive public company. What does this mean to you, and how did this kind of come about?
Yeah, this is a really exciting time, and really Chainlink's bread and butter, as you guys both know, right? Bringing data on chain in a secure and reliable way, and working with an institution as large as Coinbase is incredibly exciting, right? When they think about bringing this data on that all markets need in order to support the growth of where we all think that this is going, they need to ensure that security is first and foremost, which is what Chainlink provides.
Yeah.
Yeah, I'm just curious, how deep this partnership goes. I'm also seeing here, CCIP as the dedicated bridge technology that helps Base communicate with a lot of these chains. Coinbase is obviously moving lots of tokens and coins given their reconciliation process as a centralized exchange. Just take us through, the depth of this partnership and why Chainlink is selected to work with Coinbase.
Yeah, so again, we've got data coming on chain as well as CCIP to bridge the wrapped assets. And so when you think about the two most critical parts for assets moving and being on chain, you need reliable data, and then you need access to the liquidity of the entire DeFi community, which is what CCIP provides off the shelf, right? And so with all the chains that we support as an agnostic infrastructure provider, we were able to provide this service for Coinbase, again, with the security that they require.
Yeah, man, I mean, this comes off the back of a lot of this stablecoin conversation around idle balances with Clarity. Kind of yesterday, Circle and Coinbase took a big hit in the equity markets as Tether also announced that they're looking to get Big Four audits on their kind of reserves. I'm sure you remember the Bitfinex guy on Medium back in the day, and just kind of like generally how this is shaping up. But I guess like the one way to kind of put a bow around all of kind of like what's happening here is we're getting to an era where trust me, bro, is just simply not enough. I mean, it's not been enough for a long time, but I mean, even further now as we're getting the onboarding of a lot of trillion-dollar asset managers, this kind of transparency, track record, and Lindy is required. And so I think that's all great. But if I was to push back on this, I would say, what makes Chainlink any better than just using a traditional kind of provider of data, like a centralized kind of like a database or a centralized kind of like intermediary to connect? Why are institutions, or why is Coinbase going to use Chainlink rather than just kind of like do this in-house or use something in a more centralized fashion?
It's a great question. So I think that part of it is the scale as well as our depth of products, right? Obviously, if we're just talking about Coinbase, it's DataLink and CCIP, but in the conversations that I'm having with banks and asset managers, bringing data on chain is one thing, but there's also orchestration of, if we're going to tokenize a security natively, right, I need to be worried about KYC, AML. How do I know that this is going to a accredited investor if it's going cross-chain? We have the compliance framework to support that with our also digital transfer agent. It's really a full stack of connectivity layers that these banks and asset managers can use as Lego bricks, right? So rather than doing a piecemeal, pulling together different vendors, having a non-scalable go-to-market, you come to Chainlink, we're able to provide the full service in a cohesive fashion.
Yeah.
I'm curious, taking a step back, zooming out a little bit, there's a lot of uncertainty out there in the world right now. Andy, you put out that tweet as far as like if the tokenization thesis is correct. I think, just kind of toying with the idea that it is still an if. A lot of people here believe it's a when, it's inevitable, but some of the uncertainty could put some slowdown or obstacles in the way. I'm curious if the United States, faces a recession or their uncertainty blows, out of proportion. Do you think that tokenized equities is going to take a hit? Do you think we're going to end up slowing down the tokenization wave just to kind of face what, could be more pressing financial circumstances?
So, just speaking from my own experience, right, we've seen plenty of bear markets, right? And when I was at Citi on the desk, every time one would happen, you'd hear bankers go, I knew that was nonsense, on to the next one,
Always
whatever.
in hindsight, right?
Exactly. I will say that this year, October 10th changed none of the conversations, right?
Yeah.
It is, markets go up and down, totally fine.
Yeah.
Let's continue with the path forward, which is really the infrastructure that will underpin all of this.
Got it.
Yeah.
And just quick follow-up, how much do you think things like 24/7 market access, hyperliquid, the price discovery that is now happening on chain, whereas, previously there was no price discovery, markets weren't even open. How much do you think that could help fuel and push forward the economy because it does become more efficient? Is this something that institutions are taking seriously?
Certainly, and I think the most important aspect that they're focused on is cash on chain. So we know stablecoin providers, but all of the banks are thinking very hard about how they handle tokenized deposits, right? And then collectively as an industry, how do we maintain singleness of money? Because when cash can now move with the velocity that it's supposed to have, 24/7, there's no T+2 for a wire settlement. Now you have all of these asset managers, pension funds interacting natively on chain. They may not even know that they are, but they just know they can move cash as needed. And that, I think, will be what is required before we see a explosion of tokenized securities, because at the end of the day, they're the ones buying it. And so it's immensely important for, I think, our economic growth to bring cash on chain first.
Yep.
Yeah, interesting. Kind of a different topic here. You guys are bringing S&P risk data on chain, and I think this kind of brings us to an interesting parallel here where there are S&P Global has a ratings agency as part of its kind of offerings, right? It does billions of dollars per year just on their ratings agency. It's kind of ironic that the rating agency also is ran by the person who runs the index and a lot of the platform there. But how does Chainlink think about becoming like the ratings agency for institutions on chain, right? Because you guys sit at this very interesting point in between the two. Not that this is a new product or a new launch, but talk to us about like what the ratings are that institutions are looking for on-chain safety. Like, what does that actually look like?
So bringing ratings on-chain and working with the ratings providers is really table stakes for robust securities issuance on-chain. So, back in my debt capital markets days, I sat on the investment grade desk. You have asset managers that have a mandate that can only buy certain rated assets, right? That doesn't change just because they're on-chain. And so bringing that data to market participants in the place where they're playing, which will be this on-chain future, will be required, again, before we see this robust issuance. So we're slowly laying the bricks for this future, and Chainlink is the one that's underpinning all of it.
Yeah.
You've seen the fear greed, index, right? I'm just curious if you could put this tokenization super cycle that we find ourselves in on the fear greed index. Are we closer to fear? Or are we closer to greed?
Man, that's a tough one. I think I'm gonna kind of pivot in my answer and just say that we're so early days. I know that it's very exciting and we have a lot of headlines, but there's so much more to do and so much more to come that I think is happening quickly that it's almost too early to tell. We don't have enough data points.
Okay, so just a quick follow-up here is like, what more to do? Because we've seen so many announcements, asset managers, tokenization, like every asset goes on chain. I think at a high level, people understand what that means. But how do we get there? Like, if you could put in sequence the stepping stones to ultimately put every asset, I'm not going to ask you to walk through all of this off the dome, but
yeah, how much time do we have?
Yeah, right. But like, what are some of the things that you're most focused on? What do you think is most important as the work that we have to do as we're seeing all of these headlines?
Yeah, I'll say in order of importance, it's cash on chain so we can bring that demand. Because just if we're tokenizing a security, who's going to buy it? The cash needs to be there. Again, great for the conversations I'm having because these banks have spent billions on core banking systems. These need to connect also to central banking systems. Come to Chainlink, hit an API, we handle that orchestration for you. The next is going to be handling corporate actions and all of the maybe less sexy features about a tokenized security, right? If I need to figure out a proxy vote or a share split, how does that orchestration happen? Where does that business logic sit? Chainlink allows banks to maintain that business logic and not have an exorbitant like gas fees and handle that orchestration. And then once those are laid, now we'll start seeing native bonds and equities issued in force.
These are some of the things that we don't hear about, the less sexy version, benefits of bringing these things on chain. So, a proxy vote. I'm of the understanding, equity holders right now, very low voter turnout. It's a very high lift thing to do. You mail all these things, people don't respond. How much easier is it? What is the benefit to corporations that are doing some of these proxy votes on chain?
So
is this what a DAO is supposed to be?
I would say that this future would be rather than your shares immobilized and going through broker dealers to which you can do, but it's complicated. If I am directly on the share registry, right, then I have the benefit of monetizing that vote without going through all these extra steps and a bunch of paperwork, right? Mm-hmm. So. Let's say there's a vote that I don't particularly care about, but I hold the share. We talk about this feature of extracting monetization value of I could sell my vote just for one day to someone that does really care who also holds shares, right? And so that is sort of science fiction right now. But as we move on chain, we're going to see ways of securities interacting directly with their owners in a way that honestly we can't even think of right now because they just haven't been invented.
Charlie, that is really, really interesting because it sounds a lot like the convex curve bribe wars that we saw a lot about in DeFi summer, where people were, selling the future emissions and the voting rights in order to bribe more incentives towards their protocol, but it's happening at an institutional level. If they do this with corporate stocks and equities, then you could see those sorts of application layers on top of an asset class that is 10x, 100x larger, and those applications, that business logic still applies. I'd be really curious to see that application in action.
Yeah, and it's very exciting. And when you say at the institution level, the hardest challenge that they need to solve is still maintaining all the legal and regulatory compliance that they have to, right? And so we are actively helping them with that orchestration of ensuring that we can build this exciting future, but also that they're totally compliant in doing so.
And how much different is central banks versus doing that at the corporate institutional level?
They're equally interested. The scales at which they move are just slower. But the conversations and the velocities that we're having these conversations with are active and pretty frequent. It's just, a much bigger scale that they need to think about, so understandably move slower.
And is there any case studies, just a couple of shout outs to your favorite central banks out there in the world using Chainlink?
I like them all so much I can't pick a favorite.
Yeah. Okay. Charlie, can you tell us some of the more frequent questions that you're fielding, like the unanswered questions about how does something work, or what is the right way to do X, or how do you think about Y? Like when these allocators and institutions are asking you about whether it's tokenized stocks or equities or cash or stable coins, what are some of the common questions or misunderstandings that you're used to answering?
Frequently, I find myself describing why a decentralized Oracle network reaching consensus is so important for blockchain, because I think there's still a misconception at a lot of these institutions that a blockchain is just a database as opposed to an immutable record. So it's, why can't I use my API and just put this on chain myself? And it's now having a conversation of, if it's just one data fail point, this creates massive risk for you as an institution, right? Whereas if you leverage the Chainlink decentralized Oracle network to reach consensus, right? This is why we have shown year after year why we're so reliable. You're now able to trust the data that you put on chain is immutable and verified.
Got it. So still kind of understanding the consensus mechanism of blockchain design and why it's needed.
Absolutely.
you know, they haven't existed in a world where that's been any sort of like the consensus is often unilateral, or it's kind of like multiple databases confirming ledger entries, validators, nodes, etc., and understanding the importance of like the immutability of that. I can understand how that would be a little bit of a new kind of like learning curve there.
Yeah. And what's exciting though is that all of these institutions are very eager to learn. Right. These conversations are no longer, why should I do this? It's how should we do this?
Right. And it's how can we do this quickly, right? Because it's, you know, Invesco has just partnered with Superstate, and the NYC just announced a partnership with Securitize. So if I'm the NASDAQ, I'm like, all right, well, you know, who am I working with, right? And S&P futures just went on hyperliquid through Trade XYZ.
Call that institutional FOMO.
Right, and it's happening.
Yeah, absolutely, which is great, right? We want the FOMO so that people come, and it feeds a lot of the interesting conversations that we're having. We are benefiting from, again, being an agnostic infrastructure provider, which really resonates with these institutions, to help them accomplish whatever use case it may be. It may be payments, it could be securitizing assets. They may just be trying to figure out how a proxy vote can be done on chain. We're here to help all of them.
Yeah, man, and the suite of products from the Chainlink side has grown significantly, such that for most any institution that you speak to, you typically have something that can help them.
Yes, yeah. I have not come across an instance in which we don't have a Lego brick that they require.
Yeah.
Which is also helpful. A lot of these institutions maintain deep digital asset teams, and so we're also very happy to say you guys have built a great working product here. You just need the last mile. Let us help you with that, right?
I'm curious, you know, given that you guys are an agnostic team and helping to support a lot of this via the infrastructure that you've built at Chainlink, how important is Clarity Act, regulation, ultimately for the progress over the entire industry? But given that you guys are agnostic, whether they're securities, commodities, does it really matter?
So I will say that I care about, not trying to do a pun here, I care about clarity as a concept, not necessarily law, because it will allow institutions to interact and know the risks and trade-offs, where right now if it's ambiguous, it's hard for them to come in and enforce. As soon as we have regulatory clarity, not even necessarily that law, just in general, of how they can interact, that's removes another blocker from them coming in and force.
Yeah, incredible. Yeah.
Yeah, man. I mean, last thing for me, how long have you been at Chainlink?
I've been here for about 9 months.
Okay, great. And through this evolution, what do you want to see from Chainlink as a team, as a brand, as a protocol going forward in this kind of like massive institutional bull cycle? What do you want Chainlink to really excel at and fulfill in these coming years?
I would love for us to continue to be the infrastructure provider for these, you know, obviously the main headlines that are very exciting, but all of the mundane back office things that I lived and breathed for a while that are very complicated to solve, that is where I think that we provide a great product market fit. When it's complex and needs to be brought on chain, that is our bread and butter.
Beautiful.
Awesome. Charlie, thank you so much for joining us.
Thank you.
Hope you have a great conference.
Chainlink's always a pleasure.
Absolutely.
Yeah.
Have a good one.
Yeah, we'll see you next time. Enjoy the rest of your conference.
Guys, a lot more to come here. We're going to take a super quick commercial break, and we'll be right back with our next guest, guys. Stay tuned. Special guest coming on. Guest.
was being regulated, and great tech was just enough, and a venue that familiar with. So even things like service levels, you know, the service level that I experienced in the crypto world personally, you know, when there's an issue, can take hours to get back to you. In traditional finance and equities or foreign exchange, is, you know, things have got to be sorted in a second. So we, you know, dealing with LMAX, where they've been familiar with the name for 15 or more years, certainly makes them more comfortable. So the transparency, the matching logic that's, you know, public, and they understand it, all add up into that user experience.
And one of the more recent products I've become familiar with is the Omnia API. Can you tell us a little bit about the unified API offering there? And does that target audience change a little bit than the rest of the exchange business we've been chatting about?
Yeah, very much. So Omnia Exchange has been in stealth mode for maybe 2 years, been live for a year, and only just publicly announced. So it's what we call our future finance department. It's a sharp small team of people that have developed an API that crosses all our markets. So, everything we do, foreign exchange, crypto, stable coins, ties it into a single API. And with routing logic, you can choose to settle instantaneously on-chain, settle off-chain via our rails, and it's powering some crypto debit cards, some charity donation type things. These guys are going, while we've been talking to the 40 banks in the world, these guys are going to mobile phone congresses and all sorts of stuff that's different than our traditional client base. It has no scheduled downtime at all. It allows trades down to 1 cent or 1 penny, 24/7. So it's different than the traditional markets that we've operated in before.
So is the end user here more of the sort of like a B2B product then, and it's meant for other products to get built on top of, essentially?
Yeah, very much so. And so I'm a customer of theirs in a way, to allow my clients to be able to exchange stable coins.
All right, ladies and gentlemen, we are back in New York City at DAS Day 2. We've got Jacquelyn Melinek here, special appearance before her amazing panel.
Friend of the show.
She was on with us in DC. They just released their Crypto in America annual episode with Chairman
SEC Chair Paul Atkins.
Chair Paul
Don't
Atkins.
worry, I got you. Yeah.
Give us the rundown. What was the key takeaways?
Yeah.
Obviously, his policy framework has shifted so much. What was some of the key points there?
Yeah, so we had him on Friday after DC Blockchain Summit. We were going to do it in person, but he had a flight, so we're like, listen, whatever, we'll do it virtually. But it was kind of a full circle moment for us because it was our 1-year anniversary of Crypto in America, and we had SEC Commissioner Hester Peirce, oh my gosh, I should know this, on the podcast a year ago. So it was kind of nice to have this annual SEC appearance on the show. And so when we had Paul Atkins on, obviously he took this position, and he essentially was talking about, the SEC and CFTC kind of working together now. It's no longer so fragmented, and they're really trying to move forward on the policy front that they talked about last week. And then he also commented a bit on the Gary Gensler era of regulation by enforcement and how that's kind of in the past, and then what they're really trying to do now. So I mean, it's all the ball's in their court, and we'll see how everything pans out. I've heard mixed reviews on the SEC CFTC kind of proposal, but I think the main thing here is that we're getting clarity and guidance, and that's key.
Yeah. I mean, it was landmark, guidance that they put forth last week when we were all in DC. Obviously, the thing is always what's coming up next. Did he give you any hints, anything that he dropped as far as what we can look forward to?
I think maybe a brighter future
Okay.
is kind of the takeaway on this, right? And then in terms of what's next, I guess we'll kind of see with the Clarity Act coming into play, and then the variations under that in terms of market structure, stablecoin yields. I know we saw something yesterday.
Yeah.
I didn't read too in depth about that, but didn't look good for Circle stock.
Yeah, did not either. Or Coinbase.
Yep.
Yeah, that was weird. And Tether had their kind of Big Four auditing announcement. I think that's kind of what drove it, actually.
Yeah.
Jackie, we're here, and it feels like we're in not a deep bear market, in this room. I feel I mean, there's a lot of energy, excitement, partnerships, tokenization, stable coins. Everyone's kind of the institutions are here, they're coming on chain, it's happening. How would you describe kind of the sentiment at DAS and just generally what you're seeing in conversations? Are folks more excited, less excited than you expected? Generally, what's your take on the state of this kind of sentiment? Yeah.
I would say the vibes here are a lot stronger than some of the other conferences I've attended recently. I think the DC Blockchain Summit one was also very optimistic, but in terms of the type of people in this room, it's very different. That one was very policy heavy, congressmen, whereas this one, you know, we got the suits. Everyone here is like dressed pretty nicely.
Yeah.
You know, there's some people casual, but like, I mean, all three of us are dressed up, right? And it goes to speak to kind of like the caliber of the people that are here. And even the conversations I was having yesterday were mostly with traditional financial institutions. Like, I'm not talking solely to crypto companies anymore. I'm talking to banks, asset allocators, family offices, and it's just like a very different audience. And I think, you know, Blockworks has done a good job of curating this conference over the years and really making it towards that like TradFi, DeFi kind of convergence, so to speak.
Yeah, we've been calling this institutional FOMO.
Yeah.
Because like they're kind of like banging the door down, right? These institutions, we saw Invesco, New York Stock Exchange, S&P, all of these guys are just, you know, they're trying to talk to all the tokenization companies. Those are the most prominent announcements. I'm starting to feel like this, it still feels early, but maybe like a little oversaturated. You know, like maybe there's like, just feels like we're getting announcement after announcement. There's
I was just talking about this. Yeah, the New York Stock Exchange and Securitize, Superstate and Invesco,
yeah.
and then today Ondo and
Franklin Templeton.
And Franklin Templeton. Thank you. Like I have to think of these pairings
because there's so many.
Yeah. And listen, I think there's probably space for a lot of these, and like even like 1% of like their total AUM is a big push into this space.
Yep.
But whether or not it actually gets traction on the flip side is kind of yet to be seen.
So I asked our first guest, Charlie, this just how we meter it. You know, you've seen the fear and greed index. Like,
like where are we
do you
at
think
on the
we are?
tokenization?
The tokenization fear and greed
I think
index.
there's a bit of greed on that front. Even though we're in a bear market, there feels like a lot of greed to like grab these title names and like partner with them, work with them, etc. And then it's going to be interesting to see like where the demand falls in that. I think BlackRock with the Biddle Fund they were not expecting that. Like they didn't say that verbatim, but I think they were like pleasantly surprised with how big that became. Yeah. And even on the ETF front with like Bitcoin ETFs, some of them were like the biggest launches for a lot of these traditional firms.
For any ETF ever.
Yeah. So we'll see.
Yeah, I agree though. There's a lot of like the logo by logo partnerships happening that like feel.
You guys want to work together?
Yeah, exactly. You know, it feels like there's a lot of like this building up. Obviously, prices aren't really reflecting it, but this is like the kind of stuff that happens in the bear where it builds up, and then you look back in hindsight and you're like, all right, Clarity Act passed, all the institutions came on chain, we had the most friendly regulatory agencies ever, new Fed chair came in, and literally like foreign sovereign wealths are accumulating Bitcoin as digital gold. Of course we bottomed, but right now it's hard to kind of like feel that and see that. But these types of things build throughout the bear and it becomes obvious in hindsight.
I agree with you. And I also think the energy in here does not feel like a bear market at all. And it's not that people are like, superficially optimistic. It's more so that, you know, they kind of see what's on the horizon and it's okay that Bitcoin's down because we all kind of know that it'll come back up and that there's like a market ahead that really is institutionally enterprise grade driven, right?
Yeah. You know, we realize that your time is tight here. You got a panel
I gotta go on stage.
Liquid yet?
Just give it.
I did buy it. I told you guys I'm a woman of my word, and it's down, so you guys owe me money.
We got it.
Yeah, we've already pivoted from
No,
Hyperliquid
we're
to
ripping.
Tau.
We're ripping today already.
Is it up? There we go.
Yeah.
It's going. It's
Robbie's like,
good.
back to the programming. Enough. Yeah.
Just before I let you go, any takeaways from day one, or what you're most excited about day 2 and day 3?
I'm excited to see what other announcements come out. It's kind of a bummer that these things like don't move the markets anymore, because can you imagine if any of those 3 announcements we just talked about came out like 2-3 years ago? It'd be like ripping. But that goes to show like the maturation of the space, and like Bitcoin's volatility isn't as big as it was, which I think is a positive, even if it doesn't affect our bags that way.
Yeah.
Cool.
Enjoy your panel, Jacquelyn.
Thanks.
Great to see you.
Great to see you guys. Yes.
Nice shirt.
Thank you.
Nice fit.
You guys look great.
Cheers.
Always great show.
Thanks.
Bye.
See you next time.
Alrighty, guys. Up next, we've got, as part of the institutional FOMO, we've got the head of digital assets, a manager of digital assets at KPMG, Christopher. Sorry, that's not Christopher. It's Greg. Greg Genega. Greg, join us, please. Greg is the manager of digital assets at KPMG, a very large firm in finance, a global firm here at DAS Day 2, talking about the future of what KPMG is doing on chain. Greg, welcome to the show, man.
Yeah, thanks for having me. Appreciate it. Nice to meet you guys. Yeah, thanks for having me.
Yeah, Greg, I mean, Welcome to the dark side, man. Welcome, this is madness. Welcome to the madness. You've caught us at a sport coat and suit time of our life. If you've been part of the show the last 5 years, this wasn't exactly the case.
Past the hoodie phase.
Yes, past the hoodie phase. As you may know. Greg, how long have you been with KPMG, and when did you guys start your digital assets arm, and how's that going?
Sure. So I've been with KPMG coming up on 4 years, but we've been in this space for about 10 years, right? So a few of our clients started adopting and custodying digital assets that long ago, 10 years ago, and we were actually one of the first audit firms that basically had to figure that out. There was no guidance. There was really not a lot of certainty on how these things should be accounted for. So we got really lucky that we were one of the first to kind of take that in, and we didn't abandon our clients. We're like, okay, we're going to go on this journey with you to understand this, and because of that, we've seen immense growth in our digital asset practice. That's effectively only grown over the last 10 years.
So KPMG is one of the big accounting firms. You guys do a lot of consulting with helping your clients, and I would imagine, and I'm curious to hear from you. Since you have a large customer network, a lot of these companies and teams will approach you with first questions. They just to even formulate what their entrance into the space could look like.
Exactly.
When you're talking to these companies and it's a first touch point, what are they bringing to the table? Is it just pure curiosity? And if so, where do you have them start? What do you introduce them to?
Yeah. Well, it really depends on what their needs are, right? So basically Big Four is generally it's audit, it's accounting, it's tax, right? It's regulatory, governance, risk, etc. It's all these types of things that pretty much all large companies need at some point. Right, so when we're talking about this ecosystem specifically, it could be right now we're seeing a lot of interest from a lot of the traditional finance institutions, GSIBs, super regional banks, asset managers, wealth managers, payments companies. Like, based on everything that's been going on in the last few years, we're getting a lot of intake from them, and like to guide them on their journey. They're like, what is everyone saying right now? What are folks doing? How are people taking their first steps? So that's a big inquiry currently, but there's a lot of crypto native, blockchain native funds and firms and infrastructure companies and miners and all sorts of people that they need to do their taxes, they need their audits at the end of the day, and so they want to make sure that there's companies out there that have the right technology, that have the right credibility, that they have a staff of experts that they know can understand their business, and so generally it really just comes down to what are their needs, and then exploring like how we can best help them.
Yeah, and so we saw Tether announce that they're looking actually to hire a Big Four firm. I'm not going to ask you if it is KPMG to do their audits, right, for their entire stablecoin business, their reserves, all of their equity holdings, their stakes in other businesses, their treasury holdings, their entire 9 yards. They've got things in El Salvador, in Switzerland, in all over the globe. What does that even look like? Like, how does one, take us through what a audit for a company like Tether would look like, and what does the market want to see from that audit? Basically, that they are backed, that they have enough capital, but what does that process look like? What would that actually look like in practice?
Yeah, I'm not sure about them specifically, but I could just say broadly for companies that custody digital assets, that have smart contracts, or they create digital assets. Your example, like a stable coin, is basically a smart contract on these permissionless blockchains. And so making sure that we have effectively the technology that we can, on a third-party basis, verify that what these companies, what they are custodying, that their security and their controls are up to snuff. And you think about what an audit consulting firm does. We're that third party, right? We sell trust, right? We're those folks you bring in to basically look under the microscope, making sure everything is good. 1 + 1 = 2. Of course, we've seen many things in the past. Most of the legislation coming out of since the 1920s, or Enron and those things. A lot of those were created these engagements that the market needed to. We're there to promote capital efficiency, market capital formation in markets. So the markets need this information, investors need this information, the regulators need to make sure that there's no disasters, et cetera. So we're there to basically help those companies on their journey, to give their investors confidence, to give the market confidence, and so no matter what kind of company you are, if you do custody digital assets, you need to make sure you're bringing on a partner that has the right technology, processes, people to look at it.
Take us inside the company a bit. Personally, what is your day as a manager of digital assets at KPMG? What does your day look like, on a day-to-day?
Yeah, so I'm kind of like a jack of all trades. I'm mainly in the audit practice, but I also help a lot on the advisory side as well. So sometimes it's internal training, right? Sometimes it's maybe we want a new client. Some of the auditors need to get up to speed, and it's just talking to them, guiding through them. This is how a blockchain works. This is what custody is. These are the types of controls that we would expect. So there's internal training. There's providing thought leadership to external entities. I've actually spent quite a lot of time over the last few years talking to like C-suites or finance departments who might not even be like a crypto native or blockchain native firm, just to tell them like, hey, here's what's coming. Like here's these things called stable coins, right? Here's this thing called tokenization. Here's how this might disrupt your business or finance coming up. So having those conversations, just providing those insights to our clients. Clients is a big one. I'm flying out tomorrow to basically do exactly that with a client. Nice. The advisory side right now, there's a lot of interest looking at like enabling tokenizations is a huge topic right now. So all those examples I mentioned for a lot of asset managers and banks, they're looking at their first steps, like looking at the whys, like why are people doing this? What's in this for our business? And then once they kind of see that benefit, it's okay. How do we get started? How do we navigate this? So talking to all of them and helping with their governance and such.
What sector of the current financial ecosystem do you think is the most ripe for disruption of, by tokenization?
Yeah, so I don't know if I call it disruption. I feel like it's an augmentation almost, right? Because I feel like the traditional plumbing, like it's always going to exist in a certain way. I feel like this is just another bridge, another settlement layer, right? Another liquidity layer, another efficiency layer that they could augment into the current system, so that there's just different rails, different ways to get access to more of a consumer base. At the end of the day, we think about like why we're all here and what the value proposition of a blockchain is. And in my opinion, it's essentially a settlement layer, right? It's essentially all you need is internet connection, and you have access to this global financial ecosystem. No centralized intermediaries, right? You look at emerging markets where there's a lot of instability in the globe right now, right? Some emerging markets they can't trust their banks, or they can't trust their governments and stuff. So if they have access to internet through satellites or something like this, and like all they need is a private key, now they're in a global financial system. And so when you're seeing those use cases and that adoption happening there, then you think about the traditional ecosystem. Well, it's like, well, now there's ways that we can give access to more of our markets more broadly, and of course all the settlement benefits and disintermediation. When you have disintermediation, it generally has an element of lowering costs as well.
So we have settlement layers now in the current financial system. Yep. Where do those fall short? If the primary value is settlement value, where does the current settlement fall short?
I think it's there's a give and take depending on what your needs are, right? I would say clearly if speed is of a necessity, then that's where tokenization could really shine. One of my favorite examples, the 2022 UK gilt crisis, if you're familiar with that, right? Where effectively the rates on UK treasuries kind of were very, very volatile, and there were a lot of pension funds that were very exposed. They had money market funds, which are considered to be very safe. They effectively had like a margin call at that, and it caused central bank intervention for that. But if they were to be able to have tokenized money market funds, they may have been able to address address that kind of systemic issue much quicker might have prevented some of that central bank intervention. So just having more velocity and fluidity of the transfer of assets is generally only beneficial. Now you're still going to have wire transfers. You're still going to have ACH. You're still going to have all the things where maybe speed isn't that important, and they're still going to work fine. It's just going to be a world where there'll be more options.
Yeah. When it comes to actually having more options, having kind of like a traditional settlement engine, a traditional equities market, for example, and then something like stable coins or something like tokenized equities, how do you see the transition occurring? Right, it's starting very slowly now, but from your perspective, from the consulting side, from KPMG side, like what are the core drivers here of this transition? Is it just purely like a monetary opportunity? Is it a kind of catching up with your competitors? Like, where do you see the core drivers of the transition into this new kind of like multifaceted world where there's different ways to do kind of like the same thing?
Yeah. I think it comes down to a few things. For one, it's the maturation of the technology, right?
Yeah,
these blockchains, Bitcoin and Ethereum said that they've been running for over a decade, like unhindered. So, they've kind of stood the test of time there. So I think a lot of folks will see it's like, okay, like this is working as a settlement layer. And a lot of these institutions, even way before any of a lot of the regulatory momentum that's happened in a couple of years, they've still been building on this technology for quite a long time, right? And still been taking advantage of some of those things. It's just now with the regulatory updates, some of the more recent guidance from U.S. regulators. Of course, we had the Genius Act last year. It's now giving more options, more rules of the road, more comfort for people to engage. And so now that you kind of have, at least at this moment, like a green light to experiment, to innovate, and people are seeing yeah, exactly where is the opportunity here, right? So again, whether it's disintermediation, saving them costs, lowering the settlement times, and expanding liquidity, the composability, bringing in DeFi avenues, whatever is most valuable for whatever the company is that looking at it, there's more options to explore now.
And do you guys see this as a new avenue of business for KPMG too? Right, like if Tether's going to go to a big four firm and get kind of a stamp of approval, then you ought to think that okay, there's going to be other large digital assets companies that are like, well, we also need a stamp of approval because that's what Tether's doing. This is going to open up a whole new line of business for you guys as we have the next evolution of the space. If you're a believer, you see $10 trillion market cap, 20 trillion, 50 trillion. How do you think about opening this business for KPMG?
Yeah, potentially. But this has been going on for 10 years, right?
Okay.
It's only been up and to the right, effectively, in terms of adoption and growth, and the number of companies. We look at the last year. We've had so many IPOs in the last year, which we haven't really historically seen, right? So it's always been kind of a strategic imperative for us, just because we've seen that. We feel pretty good at this technology, so supporting people on this technology. We feel like we have a lot of really great clients that come back year over year, and yeah, we think the word will get out. And again, if people need audits or help with tax or help with consulting or whatever it is on the risk side, the governance side, et cetera, we're getting more and more cred as we add more and more clients. And as more the next unicorn, the next IPO, right? The next digital asset native company, they're looking to grow up, and they need to explore some of these things we offer. We're there.
Definitely.
Yeah.
That's where the space is going.
Yeah.
The only question is KPMG going to survive the AI accountant crisis? That's the real question here.
Yeah, right. Yeah, I know.
Are you guys all going to be out of jobs pretty soon?
Well, who knows? The thing is, Gen AI is definitely something that we're another very, very core focus of ours. We've invested very, very heavily into that very shortly after ChatGPT burst out into the market. So we are definitely looking at all avenues to create efficiencies with Gen AI, and I'm playing with it quite a lot. My panel this afternoon, right after this, is on agentic commerce, right? Nice. It's a really fun topic. Yep. And so when you kind of look at the crystal ball and see where things could go, with how powerful that technology is getting, how rapid it is, it's definitely both an exciting and a scary world ahead of us.
Yeah. Does it make your life easier or more difficult having all these payments and all these transactions happening on a blockchain?
So in some cases it's both. The auditability of a blockchain is really great because there's you can run a node effectively and verify everything very, very easily, and you can run it independently, right? Instead of kind of getting access and exports and stuff like that. So in some ways it's actually quite easy. And now that we're having a lot more guidance and we're on these working committees with like the AICPA and other governing bodies in the area, we're able to apply a lot of what we're learning, a lot of what we're teaching in those areas to make it clearer, to make it easier.
Awesome.
Yeah.
Greg, thanks so much for joining us.
Greg.
Yeah, appreciate you having me.
And hope you have a great talk and a great conference. There's actually a funny tweet that just went out from a kind of like a meme account. He was like, the worst thing about crypto right now is you actually have to act like you care about agentic payments.
Oh my God! Yeah, it is quite a controversial topic for some reason on Twitter, right? You've had the people who think like, oh, this is so boring. It's never gonna work. On the other side, like, this is the future. What are you talking about? This is why we're here. Satoshi didn't make it for people. He didn't realize he made it for machines.
For robots.
Yeah, exactly. So, but we'll see. It's all unwritten story, right? So we'll see where it goes.
I mean, with the advancement of micropayments, you can see that blockchains were basically meant for this, especially high TPS chains.
Yeah. How are we going to give AI agents social security numbers? Right? Probably not.
That's the big problem, right? Is the identity and like the credit card and all of that structure. So
yeah.
Great.
It's going to be very interesting.
Man.
Yep. Have a good one,
Cheers,
guys.
buddy.
Yeah. See ya.
Thanks.
KPMG is in crypto, ladies and gentlemen. They're going to be auditing major companies. I would imagine a world in the future where they are actually so someone's going to put the stamp of approval on Tether. Someone is going to do it.
I just want to bring up. I mean, we were around when you remember Bitfinex.
I know. There was all these Medium articles about them being completely insolvent, not being
Tether
around.
Back in the day when they spun out of Bitfinex, that was kind of the early innovators of this.
Yes.
And then eventually it was like, hey, are they solvent? Or are they not? It was Circle was always like the Western stablecoin. Tether was always like the shadowy Eastern stablecoin. This is 2018 lore for you guys.
I know. I mean. And now I literally see a world where if KPMG actually, or some big accounting firm, right, when one of the big four does Tether, then I think there will be other companies forced to kind of follow in the footsteps. And I think maybe I'm getting a bit too bullish, but I think it's going to happen. Ladies and gentlemen, we're going to take a super quick break. We've got two guests, Ondo and Franklin Templeton, talking about their latest partnership. We're going to get them all set up and sorted, and then we're going to talk about what they're doing with tokenization. Guys, be right back.
Token layer and packaging it that way. We have Patrick, who is building universal tools almost that can enable privacy across many different blockchains. We have Eric, who has taken that from a very chain native perspective and baked those privacy controls into the network itself. And then we have Yannick, that is probably the most aggressive of the privacy preserving protocols, in that it's all encrypted compute. So they're all different ways that you can get privacy on chain. So I'm expecting a very nice conversation. So maybe Catherine, we'll start with you. You've spent years around CBDCs and stablecoins and tokenized assets, and you have a lot of experience in talking to regulated institutions about coming on chain. What do they usually mean when they say they want on-chain privacy? Because there's many different forms that on-chain privacy can take. You can have confidentiality with the general public, so it's not on a blockchain explorer that you can easily pass, or it can be privacy with your counterparties, or it can be privacy against the actual the infrastructure nodes that they can't see what's happening. What do institutions want when they say they want privacy on chain?
Sure. I think all of the above, in the sense that depends on the institution and the use case you're looking at. I think privacy really means quite different things when you get to the nitty-gritty details of how you actually design that privacy feature. And so the way we are looking at privacy is really, it's a spectrum, right? It's not like you either have privacy or not, but it's like, what level of privacy are you looking at? And we actually just wrote a report quite recently that you guys can take a look on payments.org, which is our website. And it's a report we just launched on privacy this Monday. So the way we look at it is actually by a 2x2 matrix, in the sense there's the sort of privacy in terms of identity. And then there's the privacy in terms of like the amount and balances of transfer, the value, essentially, value against identity. I think for some institutions, they care only about, say, hiding the value bit, but they can just have the addresses still retain as is, i.e. your public addresses are being known. You don't need to hide it any further. This is what we call confidentiality, right, in which you hide the amount, you hide the balance, i.e. the value, but you don't need to hide the identity. The other folks who are looking at the reversal, which is more the anonymity set, which is looking at hiding the identities of the sender and recipient, but they're fine by leaving the balance and stuff on chain. And of course, there's the more extreme end, which is what we call total secrecy, which is essentially combining both the identity layer and the value layer to be hidden and private. And I think what's interesting is increasingly when we talk to financial institutions, that's actually more and more the desired level of privacy they're looking at, because a good example is, say, a fund manager creating a pool of student loans and you only want to give to a subset of approved entities. Then in that specific case, if you want to do it on mainnet on a public chain, you don't want anyone else to know exactly what's going on other than the parties involved in that specific use case. So you want to hide both the identity as well as the amounts being involved in that specific case. So in any case, I think it's an incredibly exciting and complex topic for us to spend a lot of time investing efforts into it. And I think as Solana, thinking about how
Alrighty, ladies and gentlemen, we are live here, day 2 at Digital Asset Summit, live from New York City. I've got Sandy and Ian with me here from Franklin Templeton and Ondo, respectively. Guys, welcome to the show. How's Dash treating you?
Awesome. It's great. Yeah, lots of excitement.
It's your time to shine, guys. Isn't that right?
I think that's right. Been waiting for a while.
Our day has come. Our day has come.
Yeah, it's been a while. Well, guys, you are partnering today. We don't want to bury the lead. Let's just talk about what the partnership is about, why it came about, how it came about. Ian, we'll start with you first.
Yeah, no. So, as some of you know, Ondo has been really on a mission to make institutional-grade financial products available to a global audience seamlessly, permissionlessly. We started with treasuries. Most recently, we did that for stocks and ETFs with our Ondo Global Markets platform. We're now listed on major exchanges like Binance and BitGet and Gate and OKX. And so we're getting to the point where hundreds of millions of users finally should have access to institutional-grade products. But obviously, we still need a partner to bring more products on chain, to design custom solutions for this global investor base. And that's where we're so excited to partner up with Franklin Templeton to make that happen.
Beautiful.
Great. And from our perspective, right, we have been passionate about this wallet-based ecosystem for years now, right? We launched the first tokenized fund ever back in April of 2021, so we're coming up on 5 years of being 24/7. We are looking at this partnership with Ondo as our opportunity to really bring more of the Franklin Templeton organization to this wallet-based investing audience. And we really want to start with our ETF suite because this is where we have already been really investing in thinking about what are the products that are really going to drive return. So we're looking at things like gold, we're looking at things like new technologies, and then you need to have basic diversification. And that is something we feel like, this audience is ready to really embrace, is having a diversified portfolio so that they can be building long-term returns along their short-term volatility and opportunities. So we think this is a great way for us to come to market and really learn more about the investor appetite and help to shape it together with Ondo.
Yeah, I think that's amazing. I mean, because for the longest time, we've had only crypto assets on chain, meaning that users have to pull funds out of the ecosystem to access other assets. I mean, every time that I do that, I feel like it's like, oh, I'm safe now. I'm going, all right, I'm going to put into my Schwab account. I'm
Right.
good. But then the weekends come, and we are in a regime that is very volatile, and all of a sudden oil futures are flying on something like Hyperliquid, or I want to quickly trade into a gold ETF, or I want to have access to some yield product that is, safe by means of FDIC or by means of a large bank, not by means of a DeFi protocol or by a stablecoin. And so there's kind of this evolving set of users. No, I mean, come on, like I like stablecoins. Come on, there's a change here, and so there's an evolving kind of user base here that's going to be using these products. Sandy, talk to us about the type of user that you're trying to reach through this partnership with Ondo. What is Ondo's distribution on chain really? What do you look to get from their set of users and token holders?
Yeah, so I think that there's three really critical things that we feel like we're going to get through this partnership. Is number one, we believe that this audience is an audience that has come from the crypto world and is now starting to have more interest in the traditional investing world, but they don't necessarily understand it as well as they might understand crypto. And so we think this is an opportunity for us to bring the financial education that we provide all the time through Franklin Templeton to this audience. We're going to be doing things like learn to earn programs, right? We think that it's going to give us an opportunity to really understand how to build, to us, a 21st century portfolio, right? Most people today think about a portfolio as 60-40, 60% equities, 40% bonds, and hey, that was awesome for 1970, but it's 2026, right?
It's time to full stack into Bitcoin, baby. Let's go, Sandy!
Right. I want my crypto. I want some exposure to private equity. I want some exposure to private credit. I want to see some tokenized cultural assets in my portfolio, and we want to build those products, right? We are here to deliver the products our customers want, and this audience that Ondo has access to is really, I think, the audience of the future. And so we want that understanding. And then I think the final thing is, look, Ondo, like Franklin Templeton, has leaders that come from a traditional financial background who understand consumer protections, who understand how to build a safe and reliable system. But they also, like Franklin Templeton, have this passion for innovation. And we want to push the boundaries. I want to always be pushing the boundaries on how do we use these rails to do more and to let our investors do more for themselves, which is such a new concept that I love about this space.
Yeah, Ian, I think it's very, a very easy tagline here is just do more with your assets, right? That's what blockchains enable, that's what Ondo enables. What do you envision the kind of Franklin Templeton products coming on chain into Ondo's product suite as part of the offerings that you guys have? What do you anticipate the growth traction to look like? How do you plan to kind of onboard folks into more traditional products on chain? You guys are doing a great job so far. What does that look like moving forward after this announcement?
Yeah, I think it's a great question because to Sandy's point, you're dealing with an audience that's fully on chain. Some of them may have brokerage accounts like yourself, right? But the moment you go outside the US, the odds of that dropping are pretty high. You're dealing with an audience that doesn't necessarily even know what is an ETF, right? So you really have to start educating them first and foremost on what are these investment products? How should you think about a diversified portfolio, right? We joked a little bit about going full stack into Bitcoin, and that's good, right? But at some point, hopefully, people made some money and then they got to diversify. But what does that look like? The 60-40 model is clearly outdated. How does crypto fit into something like that? So figuring out what do these actually diversified portfolios look like? How do you think about commodities versus equities? Versus crypto, what should be the blend, throw in some fixed income in there. So really helping users educate on what it is, how we think about a 21st century diversified portfolio across asset classes, and then really building the content to bring that to this audience so that they know what they're investing in. And then when there's a crypto bear market, maybe they do want to invest a little bit more into these stocks, ETFs, US capital markets more broadly. Like if you take a bit of a step back, the global wealth engine that has been US capital markets is truly phenomenal, right? We joke a little bit about the return sometimes in crypto of an S&P ETF, But 12% over the past 25 years is a marvel. It's unbelievable. So just the fact that you can put these products all in the hands of a global investor base, literally hundreds of millions of investors that can now self-custody these things and trade them 24/7, that's incredibly revolutionary. So that's why we also need a traditional financial partner who can think through how do we even create portfolios in a setting like that to give people better diversified exposure, better returns, while still putting crypto in that basket of assets.
So one of the things that we haven't quite kind of, we've been orbiting around it, but investors want these products on chain. They want to have a diversified portfolio. What a lot of the investors on chain, Sandy, want to do with these assets, though, is they want to go do something with them.
Yep.
A lot of us have been doing DeFi for 5-6 years. We've been first to a lot of early opportunities, a lot of highly speculative, highly risky opportunities, but there's always a desire to create productive capital on chain. It's almost like a culture of the crypto environment. It's like always trying to create maximum capital efficiency. Sometimes that increases risk, oftentimes it does too far, but there's always a kind of group of people wanting to do that. Talk to us about how you think about these new products, these ETFs, coming on chain and then doing more with them.
Yeah.
Do you envision a future where investors could actually borrow against tokenized equities or gold ETFs or earn yield on them? Talk to us about kind of like this unlock here that you see that isn't currently available on brokerages in an off-chain environment.
That's right. I mean, and you've hit it on the head, Andy, right? It's that every asset that sits in my wallet should have utility beyond its stated purpose, right? So my ETF that sits in my wallet that's been tokenized by Ondo should give me the return stream of all the underlying securities that are held in that ETF. But once I have that return stream itself is an asset. And I should be able to use that return stream coming off that ETF as an asset in another investment vehicle, either as collateral, either as a lending opportunity, as something that I could use to start to lever, right? I need to be able to look at every asset that sits in my wallet and think about what is the additional utility I can get from that. And in the way that we do traditional securities today, that's really tough to do because you have to go through this know your customer anti-money laundering. You have to update these off-chain books and records. None of the securities are transferable, wallet to wallet. We are a digitally native company at Franklin Templeton. Ondo is a digitally native company. That's why we felt there was such good alignment, and we want to be able to see these tokens that Ondo is issuing have that added utility that if you were just buying the straight ETF, you would not have. Right. So to us, this wrapper is actually enhancing the value of the ETF itself.
Yeah. Then back to you, Ian. I know that Ondo has a very unique way of tokenizing assets, but there's some education that is required. When we're tokenizing Franklin Templeton's ETFs and other products, what kind of actual ownership and rights do users have? Folks who are holding these in brokerages are used to a certain set of rights. On-chain users are kind of used to like, my keys, my coins.
Yep.
How do we educate and kind of what kind of rights do users of Ondo's tokenized and owners of Ondo's tokenized assets have?
Yes, I love this question. There's so much debate
Yeah,
on
there
like
is.
how to tokenize.
Yes, there
and it's kind of
is.
funny to me because I mean, for all the listeners, I guess typically there's a debate that centers around: do you do native issuance, native tokenization, where the thing you hold on chain is the equivalent of the actual stock? Or do you go for a wrapped model where what you're holding is a different instrument, but it's fully backed by the actual stock? It's just not exactly the same. But the token, the wrapper token that you're holding can give you full economic exposure, but technically it's something different. And I find it interesting that we're relitigating that debate a little bit because the most popular asset by far that has been tokenized is a stablecoin.
Yeah.
It's a wrapper, right? It's backed by off-chain assets, and what you're holding is not the same thing as a dollar. If you want an actual native tokenized dollar, the closest thing is, I guess, a tokenized deposit. No one's holding tokenized deposits. People are holding stablecoins.
Yeah.
And that's totally fine because stablecoins can be permissionless, right? Increasingly, they have better investor protections. And that's the same thing with our stocks and ETFs. You can have incredible investor protections as long as you structure these things in the right way. So when you hold an Ondo token, you have what's called a security interest in the collateral. You're holding a debt product against the issuer that will always give you a security interest in the collateral that is perfected by a third-party agent that has access to our brokerage accounts, that posts daily attestations. We're always fully over-collateralized. So the wrapper token is something different than the underlying stock, but it does give you full economic exposure. It's fully backed, fully bankruptcy remote, and on top of that, it is permissionless.
Yeah.
So you can hold it in wallets just like you hold a stablecoin. Yeah. You can use it in DeFi just like you can use a stablecoin. If you're going to go the permissioned route, might as well hold it in a brokerage account, right? Yeah. I don't really understand what we're doing there. And on top of it, if you want a native issuance, kind of like what some of the others are doing, you can't actually do that to Tesla and to Apple and to some of these ETFs because you need issuer buy. So we fundamentally believe the wrapper model is a superior model. If you look at it doesn't mean that the other model can't exist. We think all models should exist, and then you let the market decide. The market is deciding, right? Tokenized stocks and ETFs went above $1 billion last week as a category. Ondo has 70% market share in that with 700 million.
There we go, Ian.
There you go. X Stocks with Kraken has 25% market share, and then the native issuance model has like 5% market share, right? Yeah. So I find the debate, there's a lot of time spent on it. That's fine. The market is deciding. The wrapper model is great. It's fully compliant. We have an approved prospectus in the European Union. We're approved for secondary market trading in Abu Dhabi. Franklin Templeton has reviewed the model and is very comfortable with it. So we feel very confident about it because it gives you, honestly, economic exposure to the assets, and it enables permissionless access and DeFi composability in a way that a native model can never get.
And if I could just add to what Ian said, Andy, I think that you have to always challenge your preconceptions.
Yes.
Right? This is what I think crypto is brilliant at, is the entire crypto industry has basically said to the traditional financial world, hey, you say it has to be done this way, but why? Right? And that why, I think, is so important. And if you lose that ability to question the established models, then you're really not belonging in this industry. And so what is exciting to me is that I want a permissionless token that gives me these types of exposures, because having that token be permissionless gives me new options for utility that I've never had before. Right? And it's not necessarily the exact same way you do it in your Schwab account, but you know what? Maybe I want something better than what I have in my Schwab account.
I mean, what are we doing
Sandy,
here?
Preach.
Let's go, Sandy.
So that's why we're super excited. And that's why we want a partner who's also willing to say why. Why does it have to be that way?
Welcome to the Rollup, where we challenge assumptions and ask hard questions. Ian, thank you for the answer. Sandy, back to you here. How big are we talking? What is the TAM here? Franklin Templeton is a $1 trillion asset manager firm. Obviously, the total market cap of cryptos is around $2.5 trillion. On-chain TVL is still low. You know, if we're talking just bips here, we're really making a big dent. How big are we thinking, and kind of what's the time scale for this evolution of tokenizing a lot of Franklin Templeton's ETFs, assets, and kind of how do you expect that transition to happen?
Look, the global ETF market is $30 trillion, right? So let's just say we get 5% of the ETF market in additional growth from new audiences, which really, Andy, could be very conservative. But even at just 5%, we're talking about $1.5 trillion more dollars coming into the crypto ecosystem, which would be a huge expansion to what we have today in terms of total value on chain, right? I think it could be much higher than that, but I don't see any reason why starting with a 5% transition over the next 3 years is, I think, a very solid conservative estimate to think about what this ETF opportunity alone might look like. Forget as we bring even more products to market and extend that into completely new types of portfolios and assets.
Yeah. Ian, last thing for you from my side. I think Ondo, correct me if I'm wrong, around 70 assets on chain right now, 70 to 80 or 100?
We expanded. We went to 260 recently.
260 recently. Okay, there we go. There we go. Always challenging assumptions and correcting each other around here.
Yeah, it's good.
there's, I mean, thousands and thousands of equities and ETFs and products on chain. You know, like you said, there's Ondo, X stocks, and I think Denari has like 70 or 80 assets. There's really not that many providers who have significant amount of actual quantity of assets on chain.
Right.
How do we scale this to thousands? Like, is this partnership going to help? What does that look like?
Totally. I think this is where the partnership comes in, and this is where I think the unique model of tokenization that we've built really helps to do that. So I think that the issue that some of our competitors historically had is when they brought a new asset on chain, they wanted to recreate liquidity for the asset on chain. So they were deploying like DEX pools for all these stocks.
It's very difficult.
You can't scale that model.
No.
And there's also no reason to do that, because the reason why it's interesting to tokenize these assets in the first place is because they're so incredibly efficient and they have incredibly deep markets in TradFi. Yeah. So the tokenization engine that we built essentially is, you can almost think of it like a bridge between TradFi liquidity that is very, very deep, and then on-chain demand where users actually want to buy these assets. So with the Ondo Global Markets platform, we can tokenize as many assets as we want, and when people buy this, the price they're paying is the same as in a brokerage account. The liquidity we have available to instantly mint these tokens is the same as is available in TradFi. So we're really not capped, quite frankly, in how many assets we put on chain. We started with 100, then we expanded to call it 180, now we're at 260. Like by the end of the year, we could be at 1,000, no problem. It really is just like getting these smart contracts deployed and building the distribution rails, and then working with the asset managers like Franklin Templeton to create very interesting products to put on chain. But the tokenization rails and engine at this point has been built for us to scale to thousands of assets, no problem.
Yeah, beautiful. Guys, congratulations. I hope you have a great rest of your conference. It was an absolute pleasure to chat with you all, and look forward to the ever-growing tokenized asset growth on-chain, more users for Franklin Templeton, more assets, more products for Ondo. Guys, congratulations.
Awesome.
Thank you so
for
much.
having us.
Alrighty, guys, we are live here, day 2 at DAS. We're going to take a super quick break and be right back. Thank you, guys.
Are sort of isolated, and when you want to do something like smart order routing across all of those dark trading venues within TradFi, you encounter the dark pool smart order routing problem. With shared state and encrypted shared state, we can turn all of those black box trading venues into lit trading venues, but all of them exist within this encrypted space, this encrypted realm. Now, when it comes to compliance, what I think is so important to understand about all of these cryptographic primitives, including the cryptographic primitives that we've been developing over the last years, is that with encrypted execution, all of this becomes multi-dimensional. So I can define an algorithm that specifically specifies when I perform a transfer from my wallet to someone else's wallet here in the audience, then the financial institution that is providing the stable coin that is being transferred should also get access to that information, right? And all of that happens in a verifiable, encrypted way, takes a few milliseconds, that's it. There's full privacy, full cryptographic security, while there's auditing in place. And that is only the most simple system you can build with encrypted execution. You can actually construct systems where you can have, and that is, I guess, more of future music down the line in a couple of years. But the way I see this technology evolving, not just within finance, but enterprise as a whole, is that we can get rid of a lot of expensive processes and simply define clear rules which defines how information is being processed and what are the consequences of what is contained within that information. And only if certain rules over which there is collective consensus are met, then this information, let's say, gets shared with a third party. And I think that is the future where open finance together with traditional finance will move most likely. At my heart, I am extremely cypherpunk. I would say the ideal world that I see is a fully encrypted world where everyone, be it an individual or be it an organization, right, has this ability to bring themselves into a strategically superior position by keeping ownership over all information. I think that's what it is at the end of the day. And that's what we see on an individual level, but also within capital markets.
Patrick, I might throw to you because what Yannick is describing is a whole new system. But I get the feeling that traditional finance really wonders whether any of these new systems are backwards compatible with the frameworks that came before. Is any of this backwards compatible, or are we really just building a new world that we had better exist in for the better of the industry overall?
I think the space has steered closer and further from that. I think with the early ideas of Bitcoin and some of it like Zcash, some of these early like more cyberpunk things, I think it was very much like it's our way or the highway. But now with like all this focus on real world assets and stable coins, like, I mean, we've definitely put ourselves in a position where it takes two to tango. So I think like you can layer on all this crazy cryptography and whatever, but if ultimately like whatever asset issuer it is has the right to stop it or inhibit something at some point, like why add it? Like it's
bingo.
It's a big question. And like I love the cyberpunk stuff and like it would be really cool. The problem is I think I mean, whether or not it's true, there's a lot of people that think it runs the risk of really aiding illicit finance, and you can take a really strong position on like cyberpunk principles, but if you're not willing to go down with those cyberpunk principles, like you're going to have some very, very difficult conversations with some people from three-letter agencies. And you know, I think that like the technology ultimately you have to reckon with its impact on society, and I think that sometimes it doesn't feel quite like the society that wants to see crypto thrive, wants to see this full encrypted world be the world that ends up taking advantage of this technology. So I'm hoping that like we get to that, and I think like an internet world that is enabled by that is really cool. But like if the user demand is like on these assets that are issued by regulated entities on chain, it begs the question of like how close we can actually get to those ideals unless we like really rethink how those assets are actually issued or what those assets are. If we're on like a massive metaverse where like nothing is actually physically tied to anything and it's like a globally native asset where there is no true ownership, like true like creator or manager, super interesting. But I think for a lot of the assets we're working with today, like I think temporal privacy is much more useful and interesting. Like, can we hide trades before they're actually executed, but then after executed reveal certain information about it is much more compatible with the worldview that a lot of the enterprises that want to bring significant value on chain have. And so I think there's a question is like, do you comply or do you choose to go the other way? And I think there's a big open question today in the crypto landscape. How big is that market for the let's go all the way to cyberpunk? Because in recent years, it seems like that group of people has gotten smaller, or that is just not as loud anymore. Yeah.
I mean, imagine a scenario, JP Morgan calls a regulator, great news, just installed some new tech. I can't see anybody's balances anymore, but a black box gives me a big thumbs up every time something happens. Like, it's just kind of a ludicrous example, but I think it is telling that this isn't really additive if we're trying to rotate the GDP on chain. It's all extremely additive if we're trying to create regulatory arbitrage and push the boundary and disintermediate and attack and create something alternative above and beyond what the existing system is. And that's fine, there's a definitive space for that. But it's not necessarily the application that, I don't know, we're working on at Canton. So I don't have any qualms with it whatsoever. It's just not really eligible to be applied in these contexts. Maybe yet, you could add to my statement, but I don't think right now.
Catherine, I might throw to you quickly, because in how I have viewed Solana's trajectory in that it really did start out as a very retail-focused. It was the community chain almost. It was very retail heavy. Big shift now towards institutional interest, and that's because the institutional interest is here. But is there a world where if institutions are coming on-chain at scale and they use Solana, where does retail fit into this? We don't even have to talk about Solana specifically, but the chain space overall. How does retail still be catered to when institutions are so powerful in what they're demanding?
Yeah, it's basically two-sided of the market, right? You need retail, you need institution, and the marketplace is where they meet. In fact, I think it's very important to have both retail and institutional on the same platform, whatever that might be, in order for them to interact. Because when we think about institutional use cases, it's not just wholesale financial use cases. It's very much there's a small B2B, B2C, whatever you have it. I think actually just kind of, again, tracing back a little bit of the history and all of the things that happened organically, I think is very interesting. And I think as you're asking the question, I was just kind of thinking that the growth or the trajectory of how Solana has evolved over all these years sort of like on a macro scale reflects the trends in crypto overall. And what I mean by that is, as I said, at the very start, right, like SVM, Solana Virtual Machine, the Solana entire architecture was designed to be the NASDAQ. And right now we're calling it Internet Capital Market. That vision has never changed. We really wanted to create a blockchain that is highly performant, that can compete with all the centralized exchanges, etc., in a completely trustless, permissionless setting. And we are achieving that right now. Now, what's interesting is that now you have this amazing high-performance, scalable infrastructure, but because this is an open, permissionless network, any use case, anyone can come in and build and see what will actually succeed and take off and what doesn't. And so it just happened to be that there was a period in time that, you know, whether that's NFT or whether that's meme coins, like that actually brought a lot of retail interest. And it's actually through that experiment, if you will, it allows a lot of the retail liquidity to come on chain. And through that experience, they start to have a wallet, right? They start to understand financial literacy in a very different and interesting way that as a creator of the chain, you would not have predicted that like ahead of time, but it just happened organically. And that's what I think about is very interesting when it comes to market forces, and you just see how things go, right? But now, as we're thinking about the future state, I think what's obviously everyone acknowledge, regulatory plays a massive influence in all of that. Prior to 2025, I think the sort of the trend is there, but it's always undertone because no one dared to move into here. And thanks to Genius, thanks to hopefully Clarity and many other things, we finally have a real shot for financial institutions to participate. And of course, we need to treat it very seriously because, as I said, without institutions, retail can only, like just in a specific corner, but it's the same case for institution as well. Ultimately, blockchain is used for distribution purpose, is used in order to aggregate a lot of these liquidity such that, different assets, as we said about composability, can interact, can compose, can really trade against one another. This is where new value creation can also come in. And this is where I think is really exciting. If we continue to be, highly scalable, performant, and composable right from that design, I think ultimately it's the market forces to really tell us, what's the next trend, where is the real value is going to stick.
Eric, I'm wondering your take on that, because Canton, it obviously has a focus. Can you learn from the retail market forces anymore, or is it the institution's game?
I mean, I know I look 27, but I'm old enough to have lived through a lot of the early days of the internet. I do think that we too often hold Bitcoin and Ethereum as our model for what does a successful public network look like, and I think actually the internet is a much better case study. And it's gone through very similar evolution to the early days of the internet. I mean, the early adopters were building their own single-page web apps and blog posts, and there were, encyclopedias online and things along those lines. And then it became a co-mingled existence of retail, institutional, certain websites came to much larger domination than others. And I think that's just part of the general evolution. It's rare that you find the incumbent institution be the first mover. I don't think that that's a reasonable expectation. And I saw a really great Twitter back and forth with some of the founders of Stripe, and they were talking about how once they really opened up to the challenger ecosystem, they got kind of two things. One is the obvious one, which is really fast feedback loops, and the product just evolved much quicker. But I think more telling was that they said that those new business models that got built on top of this capability got pioneered by the challengers. And that was the part that was harder for the incumbents to kind of come up with. Well, how do I really take advantage of this? What's the value to the user? And again, just kind of a silly hyperbolic example, I always like to talk about Napster versus iTunes and Spotify. Napster, I think even to this day, is the fastest adopted thing on the internet in our history, something in that neighborhood. And I think it's undeniable that it completely changed expectations for what it means to consume that form of media. But it wasn't Napster that won. And the risk that it comes with interacting with a fully decentralized regulatory arbitrage gray zone enabler of a change is fundamentally different than the safe contractual delivery of that to me in a format that I can consume at whatever pace I'd like to. And so I think that this is a natural evolution, and I'm like unbelievably supportive of all this stuff that takes place in these broader ecosystems that are retail first, that push the envelope of what's possible. We get boom and bust cycles and experiments that do and don't work, but it's always changing the perception of what's possible if our economy is on chain, and it serves as a really strong light to help us understand, well, what should we be enabling? So I take tremendous inspiration from everything that takes place, especially the failures, and even from places that people don't anticipate. Like, I've been pretty public about how there's far too much hate for things like JP Coin in this audience, maybe not so much, but I mean, if you go to the more crypto native ecosystems, that's a pretty common whipping child for the market. But what it took for them to build the internal institutional knowledge to be able to engage in these ecosystems, how can they do it? They're going to be able to react to opportunities unlike any other institution, just from the investment that they've made to date. So I think there's far too much like religious debate in this space, instead of accepting whether it's retail for retail's sake, decentralized for decentralized sake, institutional and highly centralized. All these things have a place on the map. Finance is deeply heterogeneous. Capital markets are deeply heterogeneous. There's a lot to learn from all of them. And there's no one size fits all. So yeah, our go-to-market is just B2B first, but we do have tons of retail use cases going on in the network right now. Just people are not as aware of it as, the big names that we have been lucky to work with.
Unfortunately, that's all the time we have for today. Please give our wonderful guests a round of applause. Thank you so much, everybody.
Thanks so much to our last panel. Next, we've got a talk on DeFi vaults and building earn products for institutions. Coming up, guys, I want to give a warm welcome to our next guests, Jacquelyn, Sunand, and John.
No, come on in. I think you guys are friends, right? Hello, everyone. Happy Tuesday. We are almost at the end of the day, so we're saving, the best for last. I am Jacquelyn Melinek. I'm the founder and CEO of Token Relations. We do a lot of crypto investor relations for a lot of the teams in the space. And more importantly, I am joined here today with John Zentner, Kraken's Director of Product for Earn, and then San Raghupati, the CEO of Veda. It's my pleasure to have you guys here on stage. And to start off, obviously, for a number of years, institutions have been more or less eyeing on-chain yield, and historically, it hasn't been that easy to access. But now we're seeing products like Kraken Earn, which we will get into, and other DeFi vaults kind of extracting that away. To kind of set the scene here, this has become a bit of a universal trend right now. I feel like everyone is talking about vaults all the time. So why do you think is driving that? It's the year of the vault. Happy 2026. But maybe we'll start there. Why do you think it's the center of discussions right now? Is it because they're popping up, or what's the deal?
Well, I think, first of all, I've been in crypto long enough to have gone through a number of narrative cycles, and to finally have the pleasure of being in the center of one when it's going is always great. And I think one of the reasons why it is very pressing right now is because Number one, you're in a situation where there is a positive rate differential, where like you can just earn more with vaults than you can earn in other yielding opportunities. That is, and for all of those who aren't super familiar, where does the yield come from? The yield comes from over-collateralized borrowing on the other side of borrow-lend protocols. And if you just think about the efficient frontier, you can understand why these things are paying more than treasuries or other sort of investment-grade bonds. So number one, you've got the fact that on USDC, you can earn more than you can in TradFi. There is an opportunity to earn on other assets as well, which can in sometimes is higher than the staking yields. And then I think the other thing that's just new and fresh right now is that the infrastructure has shown up. No better person to speak to that than Sun, but the infrastructure now with embedded wallets, with the Vault EIP 4626 and all the standards that have been built, they are time tested, they're battle tested, they hold a lot of TVL, and it feels like it's just, it's time to go now that all the puzzle pieces are in place.
Yeah, I'll just add a little bit to that, which is yield has been a universal demand in crypto and finance forever. Literally, it's like one of three things that maybe matter. People want to send money to each other, they want to earn on their assets, and they want credit. So yield has always been this universal product demand. I think there are three factors that have made vaults viable finally and brought them to the forefront. The first is stablecoins, right? We've seen this proliferation of stablecoins. It's almost like every fintech, every traditional institution is looking at stablecoins because it's just a more efficient way of moving money. The second piece is
Alrighty, guys, welcome back to DAS Day 2 in NYC. We've got our afternoon marathon starting now. I mean, we've got 10 speakers left, some absolute bangers. Up next, we've got Vibhu Norby, CMO at Solana. Their comm strategy has been very, very unique as of late. Looking forward to having them on. Rob, had a great conversation with Ian and Sandy from Franklin Templeton.
Tell me about it.
3 huge announcements. Franklin Templeton and Ondo, Securitize and NYC, and Invesco and Superstate. And yeah, I mean, they are bringing a ton of Franklin Templeton's ETF products on to Ondo's product suite and on-chain, expanding the total breadth of Ondo's product offerings. Basically what FT is looking for is more buyers. Looking for more buyers of their products, they're looking for more distribution, they're looking for a new user base that they're not really used to having. And that is what Ondo's bringing them. And that is kind of like the trade here. In a way, these teams get this stamp of approval, this legitimacy, this access to new products, and these kind of traditional firms get access to a new investor base, and that's kind of seemingly what we keep seeing from these firms doing these partnerships. So
yeah, I didn't catch all of the episode, but I did hear Sandy say something particularly interesting, which was that she believes the crypto native power users, buyers, and investors that have been investing in these tokens are actually starved for some high quality assets.
Yes.
She didn't say this verbatim, but she believes that there will be crypto users on chain that will pivot from buying exclusively tokens and meme coins into buying something more
into
sustainable.
other assets. Exactly. Yeah. Yep. 100% going to happen. That's her thesis. All right, guys, we've got Vibhu here. Vibhu, if you're ready, come on the show. He is ready to get started. Solana's strategy here. Looking forward to this one. There's an interesting comms game going on over there that we're going to talk about. And yeah, they also just picked up a new hire, Seraphim, Macromate. So that's going to be interesting. He's going to try to help Solana dominate the game there. And yeah, I mean, there's a lot to talk about here just from the pure marketing side. If Vibhu's ready, we will bring him up and get this show on the road. And guys, we're here for the marathon now, Rob.
Let's do it.
Absolutely.
I'm so ready.
Yeah, are you?
I'm so ready. I don't
Nice
think
suit,
I've ever
man.
been so ready.
Hey, Vibhu.
There
Good
he
to meet
is.
you, man.
Hi. Welcome to the show. Oh no.
Oh goodness.
You're just coming in,
Coming in
wreaking
hot there.
havoc right
Yeah.
away, just like you're doing on the marketing side.
Yeah. We got Vibhu Norby. Vibhu's going to answer, is Solana's comm strategy winning? Welcome to the show, man.
Thanks. Well, thank you for having me.
Of course, man.
You actually want me to answer that, or?
I mean, we'll kind of
rhetorical?
answer that throughout the conversation. I'd
Okay.
like to ask you about a colleague's tweet, Lily. Gaming on blockchain is dead. Was this strategic from Solana side?
Yeah, there's, in crypto, there's no difference between like 4D chess and 1D chess. So I will never reveal the answer to that.
There you go.
But no, it was not. There was no strategy. And Lily's just yapping, like we all do. I guess the strategy is let the people speak their mind in public and deal with the consequences.
Yeah. I mean, I feel like Solana went from like this, like the fast chain, the cheap chain. It went through like the meme coin chain. Then it went through like the Ethereum killer phase. Like it's gone through many narrative evolutions and descriptive evolutions. Some of them put on by external forces. Some of them probably internal. How would you describe the comm strategy now and why you guys are doing such a great job of being able to be top of mind consistently?
Well, thank you for saying that. I genuinely don't know how much of it is strategic versus like Solana is just like has just been like I mean, it's like almost built into the history of the chain. Like we were kind of platformed by Ethereum folks who were fudding us for a long time. And I think that people don't realize that like FUD is good. Like it actually like is a huge attention like boon. And so I think we've been like Solana was built in the fire, and anything we do creates a lot of opinions and controversy.
All right, guys, we're back with Vibhu here. Vibhu, what is Solana's primary focus as of now? Obviously, we're here at DAS. It's extremely tokenization-oriented, a lot of kind of RWAs. People want to see Solana evolve into this institutional, welcoming chain. How does that process look? What's the main focus?
You know, we like to think of Foundation as like an economy builder, and we do a lot of things all at the same time. Obviously, but we're very responsive to what's happening around crypto. Obviously, like stablecoins, tokenization is a huge thing happening right now. Over the last year, our RWA TVL has grown 10x. We're by far the fastest growing chain in like distributed RWAs, which means like RWAs you can actually buy and use, not just represented value. And we're just below Ethereum on that vector. On stablecoins, we're behind Ethereum. I'm quite a bit behind there in terms of TVL, but we still have significant volume relative to other chains, and we're leading on payments. From a product standpoint, I think we're kind of all in on AI. I came here at Blockworks just a few minutes ago to speak about our AI strategy overall and how we're building products here and building APIs and skills and kind of preparing for what's happening, which is, I think, we're basically 2 years away from like 99% of everything happening on chain emanating from agents. And so that's a big focus for us. But yeah, there's a lot happening. Solana is basically number 1 or number 2 in like every single category that matters in crypto. And we want to be number 1. So we're gonna keep working as hard as possible.
How do you balance an institutional positioning from the comm side with, kind of Solana's track record of, pump fund, meme coins, a lot of success and activity was driven as a result of that. Now feels like the entire industry is kind of like repositioning around institutions and AI. So there's kind of like a three-headed beast. Ethereum doesn't really have like a central communications or marketing strategy. So it's almost like, everything and nothing at the same time. But you guys are a lot more organized in a certain sense. You have a central comm strategy. How do you balance those three factors?
I mean, to be fair, we use the resources that we have. Like, there's, this point kind of like triggers me a bit because the Ethereum Foundation owns at Ethereum on Twitter, just like the Solana Foundation owns at Solana. And it's just like a choice on how you want to use that to benefit your ecosystem. We've just chosen to use it for max distribution for the teams that are building them on Solana. So like that's like there's certain things that can't be decentralized from a marketing standpoint. So that's a values choice. Let's be very clear about that. Solana is really for everything. I think that's what makes it exciting. And like meme coins as an example, because of how people trade meme coins, it made Solana's DeFi infrastructure extremely resilient. We survived the Trump coin launch, which was the single biggest thing that happened it
was insane
in crypto. And because of the work that we did on the chain to be able to support that kind of stuff, when 1010 came around, Solana was by far the best performing network. Fees stayed minimal, and whereas like in other places, like people were getting absolutely wrecked. So I think our view is yes, there's a ton of institutional adoption, but everyone wants the same things. They want a fast, cheap, resilient network, and okay, maybe you don't like the methods at which it came to be, but the reality is that Solana is like super, super battle tested, and then I would say on the social side, sorry, I'm kind of running on here, but you mentioned comms and its relation to this. I think our marketing team simply disagrees with how most people think about this. I can't tell you how many times the institutions have come to us and said, dude, we love what you guys are doing out there. It's hilarious, it's fun, it's interesting. These are all just people, whether they're wearing a suit or not, it's still they still resonate with humor and chutzpah and all that kind of stuff. These are just basic human nature. It's never penalized us. It penalized us, if anything. It's just brought so many people to our doorstep who just want to learn how they can tap into that.
Yeah. I mean, I think that this world is shifting, but at the same time, Twitter is Twitter, right? There's a community
the
there.
Overton window shift. I mean, look what the White House is tweeting. Like it's in different time, and everyone. I don't want to give advice to our competitors, but like it's very obvious that the Overton window on how to do marketing shifted over the last few years, and we want to live in that place, not in whatever the old world is.
Yeah. So what you describe that as like mimetic in a way, or?
Yeah, I think it's living chronically online, and our marketing team does, and understanding, and trying to just be in touch, and being responsive and being brave. There are things we put out that nobody in our industry would ever dare to do. If you remember our StarkNet teaser.
Oh my gosh.
I mean, we did a thing with Ripple and XRP, Wrapped XRP, and the tweets that we put out in that campaign were not only the most viewed tweets in our history, but they were also the most viewed in Ripple's history. And those guys are cracked on this stuff.
Yeah.
We're just like you guys. We're degens, we're there, but we're not afraid to use our main accounts in unconventional ways.
Yeah.
Do you think Twitter has gotten more or less important over the last couple of years as the industry's evolved?
Yeah, so Twitter, I think of Twitter as the industry itself, because our industry lives there. And so, I think there are some folks that say, why does it matter at all? The users aren't there. But the fact is, that's where the builders are. That's increasingly where the TradFi folks are scrolling for news and spending their time. So I still see it as like the number one channel for us from an industry perspective. But it isn't the only thing we're doing. We're all over Instagram and TikTok. We're doing different things in different places. But you guys work in the industry, so you kind of know us for that. But we're kind of everywhere.
Yeah, definitely. When it comes to actually building a kind of distribution strategy for builders and for projects within an ecosystem, what do you think is something that a lot of ecosystems get wrong? Like what has Base gotten wrong?
That's bait. Because I don't really, honestly, I don't pay that much attention. I can't really speak to what people are doing wrong. I mean, I can just tell you how we think about it. But,
Sure.
Yeah. I'm not going to fall into that trap.
I'm just curious.
By the way, speaking of Base, we announced yesterday that Jesse is speaking at Solana Accelerate USA on May 5th. So he's coming to a Solana event for the first time.
How did you guys pull that off?
We asked him.
Nice.
We're working with him on stuff.
Yeah. So the distribution strategy from Solana side has always just been like supporting builders at all costs and bringing them and putting them in the spotlight. But has there been a preferential treatment of any sort, or is it pretty much maximally distributed across, like, as long as there's a live product or a credible product or a solid announcement, you're happy to kind of amplify, engage, and support? Or kind of like, how do you think about the preferential way of supporting and betting on individual companies within the space while kind of maintaining this neutral perspective?
I mean, I think we try our best. We are human, but like this year alone, we've talked about 300 plus different companies from the Solana main handle. Over the last year, we've diversified the number of different audiences that we're talking to. We rolled out capital markets, X402, at Solana Payments, at Luminary. So we've kind of created a constellation of different accounts that, and really just to handle the inbound that we get and requests for amplification. I would say like the only place where it might feel preferential is that Solana also, two things. One, we want to protect users, so you won't often, we'll do diligence before we're amplifying things. Like, we're not going to bring attention to scams and things like that. And then second, there's kind of we're also marketing ourselves, and so there's like certain themes or like areas we're really focused on at different times. Like right now, we're super focused on AI, and so like like if there's something that's interesting in that work stream, we're like much more likely to hit the retweet or quote tweet button. But I don't see it as preferential. I think we probably amplify more builders than all other chains combined. Like we're just really prolific. And it works.
Last thing for you, from me, is there a strong internal focus on this kind of agentic economy running on Solana? Like, how do you think about capturing a lot of that market on Solana?
I think that 2 years from now, I just said this on stage, but I'll be even more strong here. 2 years from now, basically 100% of all things that happen on chain will be agentic. I don't think people are going to be pushing any buttons. I think they're going to be chatting to an LLM, and they're going to be laying out a strategy and letting their agent do the work. This is like if not exactly correct, directionally correct for sure, and we're kind of prepping for that. And we see that as a combination of APIs that help agents do things, supporting payments at a deep level. We just announced today we're building a payment gateway for agents, lets them pay for things in the real world with stablecoins and Sol. And then we're also working on some moonshots, which are how else can blockchains service agents who need trust and who need permissionless access to things and coordination. We are playing to win here because, in my opinion, AI is basically the only game that's going to exist in the next couple of years, and it's absolutely existential for us to be there.
Beautiful.
I think that's the right take. I think 2 years from now, almost 100% of the things will be executed via LLMs, agents. 2 years doesn't seem like a long time to change consumer behavior, but when you think about the people who are transacting on chain today, it's all early adopters. They change their consumer behavior very, very rapidly.
ChatGPT is 3 years old.
Right.
And Claude Code and Codex are basically 2.5 months old, and you see how fast these things are changing. You're not prepared for 2 years. You can't even imagine 2 years from now. I mean, I think there's insane things happening.
Thanks so much for coming on, man.
No,
appreciate you.
How was your talk?
I mean, I don't know. I was probably a little low energy, but it was good. Like
He's a pep in your set,
you said the thing. I'm tired, man.
You got a dry sense of humor. I enjoy it.
Okay.
Yeah.
But we need to do more. You guys need to do more on Solana. More yapping on timeline, more drama. We got to have you guys at Breakpoint. I hope you'll come by.
Give us more. We got to have more. Like, give us more that we
I
can.
will. Okay. I have someone on the marketing team, and their full-time job is booking guests for external podcasts from the Solana ecosystem. I'll connect you and make this happen.
All right.
There you go, baby. Thank you, man.
Totally on the
Thanks, buddy.
show before we know it.
Yeah, we never had Totally. What the hell's up with
what's
that,
going on?
No, totally.
Got response to all my tweets.
I've never
Not
been
all
on the
of
show.
them, but, hey, guys, we've got Santiago Santos coming up next. That's Vibhu. That's the Solana's comm strategy. Certainly an interesting one, and a very dry humor.
Very dry sense of humor.
Very, very dry humor.
I don't know if he's like that all the time, because he certainly doesn't seem like that on the timeline. But absolute pleasure having Vibhu on the show. Obviously doing great things. Our next guest, friend of the show, been on several times. Absolute pleasure, as always, to have the man, the myth,
What's up, Santi?
the inverter.
How are you, buddy?
I haven't died. You
Good
guys
to
still,
see you,
you
man.
guys still haven't, gotten tired of me.
No, I
bring him
know.
the coffee so that
I
enjoy
think
it every time.
I think we're trolling you a little bit today. I think the marketing team put the headline as is Santiago the biggest crypto bear on the planet?
The biggest crypto bear in crypto.
I've heard a lot of things. I have not heard that.
Okay, well today you have. No angel checks this year. Tokens are not going to perform as well as equities. The once prominent angel investor sitting in front of us is at DAS, not wearing a suit.
Not wearing a suit.
I mean, what's going on, Santi? How are you, man?
I'm sort of like a chameleon, right? You sort of constantly reinvent yourself so that no one can just pin you down. Look, I've survived this long,
Right.
No, I'm not. I don't know what you guys want to talk about, but I'm not a perma bear. I continue to believe a lot of tokens are just uninvestable. Yeah. But that doesn't mean that there's a ton of adoption. I came in yesterday at 9 a.m. There was a line that looked like TSA, and there's like a lot of institutional crowd. Like, I could tell you, like, how many of the folks here do you think is their first time attending a crypto conference?
Yeah, right.
Decent chunk of them. Yeah.
That, I mean, I'll tell you, that to me is like the sign of the times. As we look across the room, there are a lot of people here that are coming here not to buy a token, or not to understand what token to buy, but more so the CEO of their company told them, guys, you got to get your shit together. I mean, just had the CEO of Western Union. You know how I feel about Western Union, and I was like, how real is Western Union about stablecoins? And I think if you heard him on stage, it'd be something along the lines of, it feels different than a pilot. And from what I've been told is, I'm excited to see how they report that through their P&L over the next year. I think they're going to save like a couple $2 billion on the float. I think they're going to, which is crazy because you would have heard the CEO go back to like call transcripts as early as like 2 quarters ago. He was like, I don't believe in stablecoins. I don't think it's real.
What do you think? What do you think changed his mind?
Probably the competitive landscape.
The institutional FOMO.
Yeah, I mean, he's looking at like Visa jump in the space. He's looking at MasterCard do one of the larger acquisitions. BlackRock. I mean, most of like, so I did an analysis in looking at every single stock the day that they started talking about crypto and then when they implemented it. If you look at the stocks that are, most of those early adopters were founder-led companies. Generally, founder-led companies just do well, better than the traditional company. But that basket of public company stocks has vastly outperformed the S&P.
Yeah. Since we last spoke, there was this really interesting integration in the S&P 500 with Hyperliquid and Trade XYZ. This is kind of like the one token that you keep leaving out of your kind of basket of bearishness. I don't mean to put you on the spot here, but what do you make of this kind of 24/7 tokenized trading growth? Like, is this something that you think is an accelerant to bringing new assets on chain, trading on chain? Like, how do you reason about this trend and then like investing into this kind of inevitability? It feels like.
Well, I remember sitting down with you guys out DAS, like in Brooklyn. I told you guys I was long volatility. I continue to be long vol. So how do you express that thesis? You want, like, crypto sits at that intersection. Young generations want to trade. They want to trade all the time. Prediction markets are just one expression of that, right? The second to that is when you say, we've always had this like 24/7, 365 DeFi market, but the reality is not everyone wants to trade your tokens, but they want to trade commodities because they see Stan Druckenmiller go up and say, you got a long copper. And then silver did what it did a couple months ago, and now oil is front and center given geopolitical tension. So Hyperliquid has just become that venue. And I haven't seen the numbers, but I'd be really curious. I could probably say the amount of volume that's coming in. There's like now over 1.3 billion of open interest on commodities after HIP 3. Super impressive. I think that 10x or 100x in a year. But it's not your tokens, right? People want to go along these things. So you guys probably heard me say, I was sitting in a room over the weekend when the war broke out. And a lot of these PMs, some of the smartest macro guys were, like, I was just sitting in a lunch. And they're all pontificating, oh, you know, what's Monday going to look like? I'm like, what are you talking about, dude? Like, have you heard about Hyperliquid? They're like, Hyper what? Pull up my phone, look at the chart. Like, stock's already at $86. Right. And they're like, holy shit. And I've only ever felt that with stablecoins, like 6 years ago. Where when I was fundraising back in the day for DeFi, before DeFi was a thing, and I would convert, like, everyone was like, you're going to invest in what? I'm like, DeFi. And like, we don't understand what that is. It's like, go try a stablecoin and then come back to me. Like, you see the light when you send a stablecoin. You see the light. This is happening now with Hyperliquid, and of course it paints a picture of like it's commodities. I'm not sure stocks are going to take off as much, but commodities I'm super bullish on.
I want to use Hyperliquid's revenue generation and buybacks as a segue. Intertwine that with what we saw in DC last week, SEC, CFTC working together on some of this guidance. They classified tokenized commodities, tokenized securities, a couple other classifications in there. I'm thinking that we're going to start to see the token economy reflect what we see in the equity asset class, meaning, right now we have growth stocks and then we have dividend stocks. And we don't have any dividend tokens or companies in that space because that would classify them as a security. But now that we have regulatory clarity, is that the right way to pass revenue and value accrual back to token holders? Is, you know, a relatively stable coin, token, but paying a pretty nice dividend from the revenue generated on chain?
You know, I'm not a regulatory expert, so I can't really comment on, like, is that going to be enough to convince people that that's something that they want to hold in their portfolio? I think the market's fairly narrow in why they want to buy something, and the narrative around Hyperliquid is very strong. It's strong because it's tokenized commodities. It's strong because it was a community launch. The last time we saw that was with Wi-Fi.
Yeah.
You know?
Yeah. Andre Cronje.
Boy, were we heavily involved in that as a farmer back in the day.
Yeah.
So I'm not sure. I mean, there's a whole body of psychological studies as to why people hold stocks. There's something really true around the narrative needs, the mind can only comprehend one concept at a time. Stocks that have like different narratives people don't really understand that. I think for Hyperliquid it's very pure. What is it? They do a lot of buybacks, right? They subsidize part of the fees. Like it is the token that most resembles stocks.
Yeah.
And it's backed by like very clear understanding that like you're seeing basically trading for tokenized commodities go parabolic.
Right. Yeah.
I'm not sure how much volume and open interest there is in the S&P one, but I'm tracking that as well.
It's starting to become one of the top 5 now in terms of volume. Yeah. But I can see what you mean by commodities may be stronger and provide more volume for longer than just individual equities or indexes, because they can be way more volatile, and there's a lot more geopolitical dynamic happening right now that is creating volatility in those commodities. So you said that you're not doing really much angel investing as of now. Your former firm, Parify, just announced a $450 million raise. What do you invest in right now? Like, what do you do with $450 million looking at the landscape? There's prediction markets, there's AI, there's crypto. Like how do you allocate hundreds of millions of dollars into the current landscape? Because clearly you're not seeing opportunities for, you know, your angel checks. So how are funds going to be allocating going forward?
Yeah, I mean, I don't know.
Yeah.
I'm tempted to not go too far and say there's no investable opportunities.
Right.
But you're seeing a lot of the larger players, like Rain, certainly Polymarket and Kalshi, like those rounds are getting larger. The stuff, there's like a very clear divide. The stuff that is working is really working, and they're getting easy, you know, those guys are not struggling to fundraise. But I mostly traffic in early stage, like you guys, like first check-in, second check-in. I do across stages, but that's sort of been where I mostly have deployed in terms of a number of deals, not necessarily dollar amounts. And I haven't seen that much. Yeah. And that is consistent. Like, I'm like, is this a skill issue? Maybe people are not reaching out to me anymore because I'm bearish, or they don't want to work with me, or I'm a terrible angel, or whatever. So I go out and talk to a lot of venture funds. I'm like, are you seeing quality deals? And they sort of say the same thing. So, I mean, I guess like I'll catch up with Ben tomorrow. I would most likely think that they're going to be investing at this intersection of fintech and DeFi. I mean, Parify has always been a DeFi-focused shop since I was there. That's where I see most of the opportunity, candidly. Like the lines between what was a standalone fintech Silicon Valley startup and crypto are converging, and they're one, right? You're seeing funds like traditional VCs like Sapphire Venture. Like look at the funds that have invested in Rain's last round. Rain, the crypto card. It's mostly fintech VCs, along with some sprinkled crypto native VCs. But that distinction is going to go away. In fact, I would argue if you're going to want to be successful in crypto, you're going to have to quickly become an expert or hire partners and investment professionals that really understand fintech, because that's, you know, you're seeing that convergence. So I think there's a lot of opportunity to invest meaningful size into those. I just this morning, I was on the way here, I got a pitch for like a different flavor of prediction markets using like consumer data. Is that going to work? I'm not sure. But you know, they're raising $2 to $3 million at a sensible valuation, like 20 million, which is, you know, where anything above 20, 30, you start thinking twice. So again, I think it's a very interesting time in the market if you have capital, because you always want to deploy in this moment where valuations are compressed, people are being skeptical like me, and the only difference this cycle versus others is that I think there's like a Stanford engineering index. If there isn't one, I think Electric Capital talks about it a lot because they build the developer ecosystem map. They track the number of developers as a whole coming into crypto, and that's a great barometer. But it's sort of like a lagging indicator. Like your Stanford engineer is captivated by AI.
Yeah,
Like
entirely.
we did not have AI. Like I'm fascinated by AI. Like
Yeah,
I can tell
everyone
you.
is.
I continue to have this imposter syndrome as a builder. Like it took me so much to get out of my seat and say I can actually build a company, because I always felt that I was disadvantaged not being technical. And the first advice I got is like, you got to go hire a CTO. In fact, go look at my first post, pinned to my profile. I said I want to hire a chief of staff and I want to hire a CTO. If I were to write that post today, I wouldn't include those two.
Yeah.
And so I guess what that all means is if you're well capitalized, I think it's quite difficult to fundraise right now for funds, and just traditional retail is not here. But it's the best time to deploy. The question is, are you seeing the smartest guys want to build? And I'm just not seeing that. I don't know if you guys are active on the venture side too. Like,
Yeah,
I haven't come across a team that I'm like, shit, it's electric. I just,
yeah.
And maybe it's a skill issue. I don't know. Maybe I've
No,
lost my
yeah,
head.
we haven't done too many deals.
Yeah. It's
or
just been,
seen a whole lot either.
It's been a lot of tinkering, and I think a lot of it is consumed by AI, and that requires a little bit of a different skill set.
Yeah.
Yeah.
But it's agentic commerce. I think a lot of people. One thing I will say is it's very tempting to say, like tokenized stocks are not going to be a thing, or agentic commerce is not going to be a thing, because like look at 402 volume, and it's like, it's declining, right? And it sort of fizzled out. I remember when I did the seed round for Polymarket, I had lost money on Augur and Gnosis, but I was fascinated by the idea of prediction markets. I was like, something will work. And there's, you gotta position yourself so that you can win. You're not gonna get it right. You're never gonna get timing right, but position your portfolio. You know, like agentic commerce is gonna be a thing. You know that AI agents are gonna wanna use stablecoins. And gosh, we're gonna be here, like we're gonna look back in 10 years and it's like, why were we overthinking this idea that markets should be 24/7, 365?
Yeah.
Like in fact, it's gonna be nonsensical markets that are not 24/7, 365, right?
Yeah.
So position yourself to capture that value. Yeah. So this is why I think I'm going like, the counter to what I'm saying that tokens are not investable is I think there is room to continue to innovate. There is room to continue to fund the incremental L1, because I don't buy this idea that we've solved the L1 scalability. So like layer 0 is really interesting. As much as I'm an investor in Brian and team and Roz, they would say we've reached, like this is the end state. I don't buy that because we haven't really seen a proliferation of use cases on top of the infrastructure. Now we even Hyperliquid, like we've reached the point where like the infrastructure is no longer the bottleneck, is no longer the handy. And you could argue that over the last 3 years we've been in that state, but it takes time.
Yeah.
It takes time.
And that's typically the evolution that we see happen, right? Is, the infrastructure reaches a critical point, an application gets some product market fit, it ends up juicing the infrastructure to the extent where it does break the underlying, and then we kind of reset the cycle and we go back to the infrastructure and then kind of expand the throughput from there. I've kind of gone on the record here and said that I think the next L1 trade is the New York Stock Exchanges, the NASDAQ, some of these guys that
I thought you were going to say inversion, but like fine.
Well, inversion's in there as well, just not from the tokenized equities point of view. I'm just curious. I mean, do you put inversion into that group? And if so, like, do you agree that is the next L1 trade?
Well, what you're saying is very similar to my house view, which is, what does the NYC, NASDAQ, Western Union have? They have distribution.
Mm-hmm. Yeah.
They have flow. And that's my whole MO is I'm going to go buy something that has distribution, because I don't want to build distribution. I want to acquire it at a really good price. Yeah. The best part of all this is, people are like, when are you going to announce your deal?
Yeah.
So I've
You guys been acquiring for 3 years.
I've been acquiring for 3 years. I promise we'll do it now. For better or for worse, what we've done over the last 12 months is really narrowed down the scope. Because we started with this, and it still is a very flexible mandate. It's like, you can buy anything, right? And so what I can tell you is, as much as we love AI in-house, the AI will hallucinate because it is going to scrub all the different pages of all the different vendors out here that are claiming a lot of stuff that hasn't been really implemented. And so, we've looked at different sectors like FX, and when we actually collect field data, it's like, no, you can't really make that business more efficient with this stuff. Not now. It's a liquidity game, so crypto doesn't solve that. We've looked at a business like Figure as a really good case study of, okay, this is an interesting business that has dominated HELOCs where other banks were not servicing them. How much of that is related to what they've done on the crypto side? Or how much of that is a combination of Mike being Mike, a phenomenal builder, also using a lot of good technology, traditional technology, and then some crypto stuff. So now we really narrowed down the focus of where we actually think this technology is really useful for. And of course, we're the first, and likely will be dominating in the field of what type of business can use this technology. But it's equally valuable to understand stuff that you definitely don't want to buy. Because the whole point of Inversion is don't buy stuff where you die. Just don't die.
Yeah.
Don't do a stupid deal. Like Berkshire Hathaway, like Warren Buffett, his first deal was a textile business. He bought it, I think, for a couple $1 million, and it was a terrible bit. Like it was probably one of his worst deals. And then he bought that insurance business for $8.5 million. And that kind of set the stage. So I'm kind of paranoid and maniacal to not buy a business where the AI, or you go talk to a lot of these folks and you're like stablecoins are gonna transform the world. Yes, but how? And in what sequence? Because I do think there's a lot of, crypto's phenomenal at over-promising and under-delivering. I want to do the inverse. So I'm not gonna go on the record saying I'm gonna buy something now, even though I got 48 hours to close, sign a pretty definitive agreement on a transaction, where I feel really confident in what stablecoins can do and what tokenization can do. Again, it just goes back to something that I posted earlier, which is we sort of have we know there's foundational stuff in crypto that will really, really work. And it just goes back to a very narrow use case of 24/7, 364 markets. And we've built internet capital markets. I'm not saying that gaming is not going to be a thing. I'm not saying that NFTs will never come back. They will. But the big opportunity for us is, stablecoins. Getting stablecoins in the hands of people that really want it, or using stablecoins in a particular financial workflow that can cut costs. And the same with the Western Union sort of woke up to that idea.
I remember, this might be pushing back a little bit, just because I remember, we were sitting at Permissionless, I think this was last year, and you were very concise and direct and said you wanted to buy the second largest telecom business in Latin America. And it felt like, okay, you already knew what you wanted, what you didn't want. And so was that still just kind of like a theory and you had to go out and do it and just confirm that thesis? And that's what you've done over the last 12 months?
You have to agree on price.
Yeah.
So price dictates the return that you get. Yeah. Again, Ethereum could be a great asset, great technology, terrible price. Mm-hmm. It's not worth $300 billion. Certainly the market agrees with me since November. These things are not worth what they are. Right? So in that particular transaction, it's a lot of it is price. As much as I like it, as much as I think telco is a great asset, your telco provider should give you more, should be your financial institution. You've seen it in Asia. It will happen in Latin America. Latin America continues to be a cash-based society. So there's risks in that deal that I need to underwrite to then derive to a price. Now, if the seller doesn't want to agree with me on the price, I'll walk away. Again, I don't want to do, the worst deals that I've done are because I chase the deal, and in venture is a bit different because the difference between 25 million and 30 million, pre-seed or seed, don't overthink it. It's like you're investing in a killer team that is going to drive through a fucking wall and make a good investment. Don't overthink it. Don't nickel and dime on the venture side. On where we're now operating, you definitely want to nickel and dime, and you want to structure terms, and you want to meet the team. And in this particular case, we're still hunting. It's a core thesis that I have, which is, stablecoins have really worked in the developing world. Look at Tron. In the U.S., people are not jumping out of their seat when you tell them, hey, there's this thing called USDC. They're like, yo, dude, I have Venmo. What are you talking about? Get your head out of the gutter. What are you guys cooking up here? You're fixing a problem, doesn't need fixing. But when you go out in Mexico, You go out to Brazil, you see how quickly Brazil is digitized because the government during COVID said, we're now going to introduce PIX.
Yeah.
Overnight, the economy went digital. So there are risks when I say, okay, I want to buy the largest telco, one of the largest telcos in Mexico. If I get it at a good price, I get access to 15, 20 million users. Most of them are using remittances with someone like Western Union. Most of them are paying month to month, $5, $10 at a time to buy data. I can get data cheaper.
Yeah.
I can use data to get them to fund an account. And you look at a company like Nubank, 70 billion. They jumped on the opportunity in Brazil. They had the timing right. They've invested a lot of money, but they've tried to penetrate other markets like Colombia, and especially Mexico. You look at the customer acquisition cost, very, very different than Brazil. So I compute all that in my thing and say, I'm going to acquire. Again, I think it was like Travis the founder of Uber, that went on another show, not yours, and said the most important thing is LTV to CAC. Like, what's the lifetime value of the user? What's the customer acquisition cost? If you look at the world through that lens, you stay really, really disciplined.
Yeah.
But for me, I think, so if I look at, here's an experiment. Like, if we could walk around, we'd go on in every booth out here and ask them, like, what is your customer acquisition cost? And none of them, when I say none of them, will tell you that. Like, go talk to Visham here. Like,
They don't know.
They don't know.
Yeah.
No.
And how crazy is that? And some of them will tell you, we don't know the user behind the wallet. I'm like, okay, well, airdrops don't really cost. I'm like, they definitely cost you money. It's part of your equity. I mean, like, so I'm very focused and disciplined on acquiring a business with distribution, and I look at the world through LTV to CAC.
Yeah.
Now, when I think about what does LTV go from, and just a telco business, and people have $5, $10 to spend on a monthly basis for telco, you're not going to squeeze out an incremental dollar for these guys. But they don't have banking services. And so I think it's like the classic DeFi mullet that I didn't coin that term, but I think it's very good. So all this to say is, it's a core thesis that we have. It is a bit more front and center. It's one of the rare cases where I actually do want to buy a business that is B2C.
Yep.
In a market that is very underpenetrated. But when I stay very disciplined on the price. And they came out to me and said, we're going to sell this business for like 3 times the amount. I'm like, good luck.
Yeah.
And lo and behold, I'm not going to sleep for the next 48 hours because I never want to chase a deal.
Yeah.
That deal did not go through, and it's still there.
Yeah.
So I don't want to. Here's what inversion should never do, because you always want to know, in the classical inverting sense, know how you die, and then just don't do that.
Yeah.
And then don't do. You don't have to be incredibly smart. Just don't do dumb shit.
Yeah.
I can tell you, don't overpay. Especially when you have data to underwrite, right? What is crazy here, I'll give you an interesting stat. So when you look at all the different fintechs in Latin America, Felix Pago and Dollar App, and the market is willing to pay, on average, $1,000 per user. So, and the simple calculation is like, if Nubank has X users, their valuation is Y, divide Y by X, you get to average price per user. So I have like a comp sheet of all the different fintechs in Latin America, all the venture rounds, all the public companies, Mercado Libre, Nubank, all of them. The average and the median there's like a pretty big divide because some of these rounds are pretty overvalued.
Yeah.
But the market is willing to pay $1,000 per user, fintech user in Latin America. So if you're going to fund Felix Pago or whatever, they're using WhatsApp and stablecoins people can send money through WhatsApp. I'm looking there and saying, okay, this business is worth a couple billion and they have like 300,000 users. I can buy a business for 280 or 300 million that has 21 million users that are not fintech yet.
Yeah.
Oh, if only I could use stablecoins, because I know, and I'm not theorizing, like I'm not prompting the LM. I'm going out to the convenience store, calling a customer, meeting a customer. I hired like 20 interns in Latin America. I said, go and talk. Every week you have to meet people. It's crazy, like simple things. You want to become a better investor? Do things that don't exist online.
Yeah.
And I say, just as a fun anecdote, I was a really good investor. I've been talking to him for like a year and a half. Every so often we catch up. And every month he's like, look at this nice dashboard that I've created with AI. I'm like, honestly, better than what I could do. Pretty impressed. How'd you build this and all this stuff? And he's like, I'm ready to go buy like a plumbing business or an HVAC business. It's all the rage these days. Like AI-resistant businesses. So he wants to go buy a like a plumbing business. I said, your dashboard, every time I talk to you, looks better and better. I think you're using it, you're sourcing all these, your CRM looks great, you have all this data on these companies. I'm like, have you called any of them? He said, just stared at me blank. And I said, what is stopping you from calling the founder? He's like, I don't know. I'm like, you realize AI is not going to do that for you, right? I mean, maybe you can create I'm like, there's nothing quite like going to a conference, sitting down with someone, looking at them in the eye and reading their body language and saying, there's a very human element that will never be outsourced by AI. The temptation is like you're here and like we love Claude and we're using the best model and Perplexity and all this stuff. There's just certain things that if you want to go out of your way and do things that don't scale, especially that the AI won't do, there's massive amounts of value. Yeah. For us, it's like doing surveys and like looking at a Mexican consumer and saying, okay, what is a consumer between the ages of 18 and 25? Do they have a bank account? Are they using remittances? How much data are they consuming? What apps do they want to use? Can we create a partnership with TikTok or Disney or ESPN? And that the difference between the user that is 18 to 25 is different than 25 to 30 and 30 to 40. And so a lot of this data doesn't exist online.
Yeah. And so you're still very focused then on this market and on finding a product where you can basically insert like a form of neo-banking into a existing set of users or customers and effectively become like their banking layer as a part of it.
You guys have a great neo-bank report. It's embedded finance. It's like integrating a financial solution that is powered by DeFi, that is powered by a stable coin.
Yeah, exactly.
The other sector we really like is credit. Yeah. Especially at a time where this is probably the most contrarian take that I know you guys gotta kick me out of this thing because I've talked for too long. is short duration credit. Now, this is at a time where you've had the most amount of DeFi, like hacks and DeFi have really gone up over last year. It sort of spiked up quite a bit. I think there's 132 million of hacks and losses. Most recently, the Resolve stablecoin. Again, an Oracle problem. Shit, guys, come on, just get your Oracle right. I think that there's two things that I think we're very focused on, which is fixed rates. Most of rates, if you want to borrow, most of that is recursive leverage. It's like funds just doing loops and loops and loops and loops. Like again, back in the day, I was a farmer. You go yield farming. So it's very short duration because money's moving around very quickly in the incremental farm. But you haven't had like a fixed term loan.
Yeah, like longer term
crypto. And the reason that is, I think, is there hasn't been quality opportunities brought on chain. A lot of the RWA platforms have a principal agent problem and an adverse selection problem. I've looked at all these rounds. I passed for the same reason, which is you didn't work at Oaktree, so your underwriting standards are not going to be as good. And the stuff that you're bringing on chain is the bottom of the bottom of the bottom. It's the equipment financer that couldn't get credit on in the real world. And a word of caution for if you're looking to capture these opportunities from an investing side, or you're like a vault manager, you got to make sure it's quality paper. Let's for once, crypto should avoid the problems of TradFi and what you're seeing in private credit and duration mismatch and asset liability mismatch. That's where we come in, because if we're buying a business, so in the case of the telco, right? Why I like it again is there's a lot of smartphone financing. They're right now selling those receivables for 80 cents on the dollar, 60 cents on the dollar. We can bring that on chain, right? If the incremental user needs financing for their smartphone, I'll provide it. I own equity in that business, and I'll bring that credit on chain for someone else to take that receivable off my books. So that's not my core competence, right? And I think that you can get better terms on chain. And it's quality, right? You're underwriting against a smartphone that has value, against a user that is paying you month to month, so you can underwrite credit. I'm skeptical of these vault managers because, and certainly automated strategies. You have to be close to the customer to underwrite credit. This is why Figure is perhaps the most bullish case of how this space is going to evolve, right? They took a segment of the market, which is HELOCs, home equity lines of credit, and Mike said, why does it cost, starting subtraction? Why does it cost $11,000 for a bank or a non-banking financial institution to underwrite a home equity line of credit? Think of it. You know the zip code. you know a lot of data of the house that you can underwrite against. So why does it cost $11,000 to do that? And Mike I think being Mike, just built a really nice business off of that, and he's not going to stop with HELOCs, right? So in a similar way, I think that credit on chain will be a big opportunity. I do worry that a lot of the hacks, a lot of the stuff, the paper that is being brought on chain is not high quality.
Yeah.
Because the people that are bringing it have nothing to lose.
Yeah. And they're just looking to sell it to somebody else, basically, on chain.
And Apollo is going to jump on it because, there's a lot of brokers in that assembly line.
Yeah.
We're not brokers. We buy the business. We underwrite. We put equity on the line, which is junior to debt. And I think that's the way it's going to work.
Yeah.
Santi, just closing out here, quick thoughts on just the state of this conference and the state of kind of institutional adoption of crypto. I know you kind of have this phrase, the great valuation disconnect. It's clearly happening. Close us out here.
I mean, it's very exciting. I mean, I still go back to the days where I was showing up in the Bitcoin Soho Center trying to buy my first Bitcoin in. I was in a suit and tie, coming from JP Morgan, trying to squeeze out when I was a young investment banker, and people looked at me and saying, like, what is going on? Right now, if you're not wearing a suit and tie, I wouldn't go as far as saying a tie. If you're not wearing a suit, look, I'm looking across the room. Pretty much everyone's wearing a suit. So I think, again, this is the state of the market. And it's incredibly exciting to be in New York, to see a lot of, look, even booths, I just can't even recognize half the booths in this room. So very different crowd, I think very institutional. Adoption will continue. Adoption will 10x from here. Your typical token is not going to do that. But I do think that a lot of these opportunities, a lot of these new companies are going to emerge. And in fact, I think the biggest benefactors of this technology will be companies like Western Union. Let's see how much they implement it and execute on that. But companies like Robinhood, Klarna, this year I'm paying a lot of attention to those companies in the public markets, and I want to really see how they can, especially Klarna. Klarna's a really interesting one.
Yeah.
Payouts to creators, what stablecoin does to that business model. Once that happens, and the incremental company that reaps benefit and outperforms the index because of crypto, I mean, that is what detonates the next leg up. And that might push tokens up, and I might be looking like an idiot here saying, oh, you really ticked the bottom. I hope that's the case. I mean, I don't want this space. I mean, Lord knows it. I still have a lot, over 256 private investments, of which more than 2/3 haven't launched a token.
Yeah.
And so I want, of course I want teams to win. I think in order to win, you have to be smart. And it's not going to be, let's slap a token. In fact, I don't think you should launch a token. Like, kind of wait 6 months to a year, figure out how regulatory clarity is going to evolve, maybe to what you're referencing, Robbie. I mean, we're certainly not eager to go launch the chain until we have scale and users. But no, look, really exciting conference. Appreciate you guys having me on. You guys haven't tired.
Thank you, Santi.
You haven't tired of me coming here and regurgitating the same stuff?
I'm actually glad that we got the inversion stuff here. It was much needed. Nice little investor update. I think that folks will be happy to hear it.
All right, we're building in the open, but thanks for having me on, guys.
Thank you. We'll see you next time. Thanks, Santi.
Guys, we are live here at DAS Day 2 at the Javits Center. Santi's building Inversion, the chain that inverts a lot of the traditional practices that we see from blockchains and brings them into a new light, new distribution. I'm glad that we got to hear about the process of actually, acquiring a company and getting kind of an investor update there.
Yeah. Look, I mean, he did come on last year. He said, second largest telecom company in Latin America. And it sounds like, after you've identified a target purchase, there's still a lot of work to do, negotiations on price, all these things that go into actually making that deal and facilitating it, executing it. Then it's really like a new beginning. That's when the work starts. Like ripping out the old infrastructure, implementing stable coins, doing all of this work to ultimately make the business more efficient, improve it, and then reap the rewards as off of that. So,
and we'll see. I mean, we'll see when it, how he goes into launching it and building it out. It's going to be a process for sure. Obviously, you don't want to rush it. But.
No, I think he also just in a nutshell put the valuation disconnect as far as how the adoption of these things is going to 10x. The tokens will not. However, I do think that we're going to have to take a look at the N7 and sort of think about what equities we want to include. Like I think Robinhood and maybe Klarna belong in the N7. I think there's probably some other things that
if they kind of actually adopt stable coins and
and ultimately I think look, who better to invent some sort of index product than, those who have a bird's eye view on both the equities market and the token market. As these two worlds converge, these will ultimately become one market, and we believe that those who are implementing these new technologies like AI and digital assets and chains, these will be the primary benefactors of the neo financial acceleration.
Guys, we've got Jeff Park, the CIO at ProCap. He's going to join us next. He's here. We're ready for Jeff. Looking forward to having him on and talking about MicroStrategy, Bitcoin, STRC, and more. I've actually not really heard much about STRC yet on the show. Jeff, please. Great to meet you, man.
Happy to be here. Thanks
Welcome
for
to the show,
accommodating
man.
me.
Cheers.
Jeff, thanks for joining.
Yeah,
Cheers,
it's
Jeff.
Thanks for having me.
Absolutely.
What's going on,
go.
man? How's the conference treating you?
This is, I think, the biggest turnout I've ever seen for DAS New York. And I'm a New Yorker, so
There
I've
you go.
seen all the DASs throughout the years.
Yep.
Congrats
Everyone's got
are
the
due
sport
for
coats
Jason.
on or the suits on. And
A lot
kind
of people, it's
repping the flow.
their first crypto
well,
conference
you guys have
here.
suits on, so this is all very uneasy for me now. There's too many suits in this room.
Jeff, man, we haven't talked much on this show about STRC, and I don't know if there's anyone better than you to talk about it. There is so much misinformation out there about whether it's going to blow up, the sustainability of Saylor's strategy. He also recently just pushed out a new update and kind of a new kind of product evolution there. What's your honest take on STRC and on Saylor's current accumulation strategy? How are you kind of viewing it as part of the Bitcoin macro lens?
Sure. Well, let's go right into it. STRC is complex because it doesn't fit into a box very nicely. And as you know, many things in crypto don't fit nicely into boxes, which begets a certain amount of uncertainty, but excitement, and STRC is one of them. At a high level, I do think it has found product market fit, in the sense that there are investors who want to earn high yield with the understanding that that yield could be collateralized by hard assets. And STRC is a medium that permits that possibility. At the same time, I think we have to acknowledge that it's highly unusual as a pref equity structure that has existed in the capital markets environment. And so there are rightfully, I think, concerns as to the sustainability of those underlying strategies. So for example, I know it's popular to call these digital credits, but preferred equities are not credit instruments in the eyes of the court, in the eyes of bankruptcy. So even though there's a credit-like element because it pays a coupon, credit and the relationship that it represents implies a sense of seniority versus junior investors and shareholders of a company and a capital structure upon the event of a bankruptcy. Preferred equities have slightly different protections when it comes to that as a covenant than true credit instruments would, and I think rightfully some people may ask questions about those dynamics. This is not to say that STRC therefore is an inferior product. Quite the contrary. I think STRC is uniquely purpose-built for exactly what Saylor wants to do, which is Bitcoin accumulation at a lower cost of capital. And the nice thing about these pref securities is that you can do things that you can't do with traditional credit instruments, like having a variable interest rate, like having the ability to pick and defer, like the ability to defer payments, and all these things, while they're not kind of black and white favorable constraints of a credit instrument, can long-term be actually good for Bitcoin accumulation. So I think we'll find out in the future based on kind of the inlays that it makes with new investors. But I think the headline news is this: people like it. People like it.
Yeah.
People like getting paid 10+% on Bitcoin-related risks, and I understand that to be a positive feature for the ecosystem.
This is ProCap versus strategy, race to accumulate as much Bitcoin as possible. Saylor's got a little bit of the lead here, but we cannot fade Jeff here. We cannot fade Jeff.
I appreciate that.
I'm just curious where you think Bitcoin sits in the broad scope of a portfolio these days. Obviously, we saw the run up in gold as that reacted to global uncertainty. The thesis was that Bitcoin was a better gold. How do you think this plays out over the coming months?
Well, I think in the coming months, the uncertainty for global macro is as high as it has ever been. I believe the World Uncertainty Index hit a local high, which is pretty astounding and not surprising, perhaps, based on kind of the news flow that we're all witnessing today. In light of that, I think Bitcoin has been fairly heroic you may know that Bitcoin actually had its local bottom on February 28th upon the announcement of the war with Iran, and ever since it's been kind of steadying higher. I think, as everyone knows who's been in the space long enough, Bitcoin generally sings to its own tune, and that correlation you can measure intermittently between equities or gold or bonds are dynamic and always changing, but the perpetual state tends to be uncorrelated to most of these asset classes, which is actually how most commodities behave, because its price is purely determined by the marginal buyer and seller. And going back to your question, I do feel like right now, most of the seller exhaustion has been processed, because the news flow that has come out that one could think would be acute to the downside of Bitcoin hasn't been true. And that makes me think that anyone who's actually want to be out of Bitcoin at this point is out. And that's generally a great place to be, because usually when those exhaustion goes away is when the indifference curve hits and people have apathy towards Bitcoin. And once there's apathy, that's when people can actually start accumulating more soundly, and then it will tend to have its run up thereafter. So part of me is excited that people aren't talking about Bitcoin as much in the mainstream, because that means that people are going to be focused on it over a longer time horizon than the moment of now.
Yeah. Jeff, you're somewhat critical of the traditional investor portfolio through your Twitter and just through your strong, you have an opinion set that Bitcoin should be in everyone's portfolio. You have this kind of radical portfolio view, as you call it. What does this actually look like in practice for investors, right? I know that the 60-40 portfolio is obviously not the way forward. What is the way forward? How should investors think about building a Bitcoin-oriented portfolio? And what kind of tools and assets are you looking to add to that portfolio?
Yeah, no, thanks for the shout out. The radical portfolio theory is one of
like
my held close to heart projects to espouse the mission of dynamic investing for the next generation. And it ultimately goes back to the view that most economists assume the world will look the way it does in the future based on the past, but the reality is there's always a great monetary reset that happens every generation. And I do believe that we're in the midst of one where the death of the Washington Consensus is unlikely to dissipate. So everything we've known about investing based on Warren Buffett or Benjamin Graham's Intelligent Investor are built on this foundational assumption of what American capitalism looks like and what that represents in the risk-free rate of the US Treasury bonds. Once you assume that the US Treasury bond may not represent the risk-free rate, and one of the cases I make is actually people should start calling it the risk-full rate rather than the risk-free rate to reflect what it is in the construct of our ever-growing deficit and our debt expenditures, you have to rewrite what that future is going to look like and the roles of other exotic and esoteric assets that can play into portfolio construction. So my theory is that there's going to be a very big generational liquidity transfer in the future. And that's because there are certain signs that point towards that inevitability almost with 100% certainty. So, as John Maynard Keynes says, it's better to be probably right than precisely wrong. And the thing that I think most people have precisely gotten wrong is that the demographic trends in this country is inverting. And that inversion is going to result in a wealth transfer that is almost unavoidable. So as I've looked at the latest stats, in 2030, which is 3 years from now, all the baby boomers are estimated to be about 65 years or older. And that's 1 out of 5 Americans. And then in 2034, which is only 70 years from now, there's going to be more adults living than children for the first time ever in American history. And then 2 years after that, 2036, the fertility rate of this country is going to go below 1.5, which is well below the replacement value. And it's projected to stay there for another 20 years because, as you can imagine, if you're not having kids then, you got to wait 18 years for them to become adults to even have kids. So we know this train is coming in that direction. And I think in preparation of that, we have to think about how to invest for the future, not what we're taught about what 60-40 represented in the past 3 decades, but what it could look like in the future. Bitcoin is, I think, one of the most canonical assets to imagine what that liquidity transfer can look like for a young generation to not be caught on the other side of the big trade.
Yeah.
could you just paint, what the portfolio construction looks like in the radical portfolio theory?
Yeah, absolutely. So 60-40 is coming from the idea that you want to own some equities, you want to own some bonds, because they tend to be uncorrelated between risk-on and risk-off sentiment, right?
Yep.
People go flight to safety for bonds, and then if you want to be risk-on, people buy equities. So the decoupled relationship should hopefully push out the efficient frontier. But I think what we all know is that's false. Literally, bonds and equities now kind of move lockstep together.
Yeah.
Right now, it's happening as it is. Like 30-year bonds, 10-year bonds are all imploding, while stock markets are not having a very good moment. And so once you see that, 60-40 just has to look different. So going back to your question, my framework is to think about compliance assets and resistance assets. And I think this is the key demarcation I'm trying to draw. When you own bonds and equities, those are all what I call compliance assets.
Yeah.
You're all part of the same global liquidity money flows in which assets are moving amongst a compliance system of financialization. It's a big part of what is otherwise called the global carry trade, in which money that is coming from Japan's low interest rate funds US equities, and it's a pretty circular mechanic of how financial assets rise in price through kind of the way GDP is measured today. The resistance assets, the 40% that I think of as truly radical, do not play a role in that global monetary system. They're removed one step further, and therefore their correlation behavior by definition just has to look different. In that world, Bitcoin is certainly one of them. We're finding, though, Bitcoin is becoming more intertwined with the macro systems as institutional adoption is happening. But a big crux of why Bitcoin was interesting and important was that it was removed from that system.
Yeah.
There's actually a lot of assets that should be investable, that behave like this, that people just don't have abilities to access. And I do think that's why tokenization is a really important project for crypto, because I know a lot of folks are interested about tokenization for US equities and real estate funds or private equity funds, but I think the true value of tokenization is giving investors liquidity into esoteric assets that were once uninvestable. So take, for example, the idea of bringing liquidity to US farmland.
Yeah.
If you want to own US farmland in a way that represents ownership interest that's not going to look like a private fund or an ETF, but farmland is definitely uncorrelated to the rest of the global macro systems because it's not tradable in that 60-40 portfolio, you should have an allocation to farmland. It's just historically been inaccessible. I think collectibles also represent a bit of that category, and sometimes I joke about people buying Pokemon cards and all that, but I actually think it's real. I think that if there are demands for scarce assets, which is, again, not part of the global carry trade and the financialization of the said Pokemon cards, it retains value in a slightly different way. I think watches, luxury bags that women collect, all kind of play a role into having a 40% allocation that looks different than what you're taught otherwise in Econ 101. I mean, the Hermes Birkin bag, which I don't expect you guys to know, but my wife loves, has basically outpaced the S&P in the last 30 years.
It's incredible.
In value.
It's incredible.
It's hilarious.
One of the things that you left out, I think you probably did it intentionally from the radical portfolio, is private credit. I think you left this out for a reason. I'm curious as to why, because, I think I know why. It's because we're starting to see the cracks. Just talk to us more about why private credit is left out of this radical portfolio theory. How early do you think we are in the, where do we stand on the fear-greed index of private credit? And how early are we in this cracks? Do we think, like, right now we're kind of scraping the bottom of the barrel when it comes to tokenization. We're going to work our way up to the high-quality assets. How does private credit fit into this? Hopefully it's just a stepping stone to higher quality things, but just generally, private credit, where do you stand on this? What's happening?
Yeah, wow, we're getting to the spicy stuff now, and you're right. I don't talk about private credit often in allocation because as a category, I'm fairly pessimistic. It's not to say there are certain aspects of private credit that actually fulfill a function that can be desirable, but private credit as a catch-all phrase of what it represents today, to me, is not a good value proposition, right? Because private credit's ultimate value and why institutional investors gravitate towards it is precisely the things that you should try to avoid if you can. In other words, private credit is valuable for most investors because it doesn't market. It doesn't mark to market every day. There's no price discovery. So if you can book an asset for 100 and book it at 100 for next month, next quarter, next year, that's great for an institutional portfolio manager because you're not taking any volatility. But when a Sharpe ratio looks like 4x or 5x, you have to be very careful about what the distribution of 2 standard deviation events can be once there's price discovery. And what you alluded to exactly what's happening. People are finding out, actually it wasn't worth 100. And they're learning it the hard way. And so my problem with private credit is that the incentive alignment has been abused. You should want private credit if you think you're truly earning a premium for the risk that you're undertaking, whether it's because of its duration or whether because the exotic risk behind that particular profile requires heavy structuring that qualitatively demands a premium. But if it's just private credit because it's not traded, to me that's not enough. And in fact, one of the things that I've noticed when I was pitching Bitcoin to a lot of investors over the years is people would gravitate towards private credit for the exact same reason they would hate Bitcoin. They don't like Bitcoin because it's too volatile, and they don't want to have risk towards that portfolio that they're not responsible for because they can't control the price of Bitcoin, of course. But those people generally tend to love private credit because it's the exact opposite alignment of feeling like it's 100. And it's 100 for a while until it's a 0.
And that's the cover photo of your Substack is the Thanksgiving turkey. The happiness with turkey is it's great, and then it's Thanksgiving, and that's what.
No, that's right. I think one of the things that sometimes finance miseducates young investors and old investors is this overly focused physics and kind of focus on like Newtonian laws on what like portfolio theory should look like, but portfolio theory is only as good as there's liquidity. You can't have Sharpe ratio on things that do not trade. The problem is if you abuse the numbers enough, you'll get the output you want. But sometimes the proof is in the pudding. And I think if you go back to like your childlike curiosity of just questioning like, well, why do people think this way? Like, why is it valuable that there's no price discovery? It feels like you should want to know what the price is. And you go back to those fundamental 101, you'll realize a lot of things they teach you in finance today is ultimately involved in this great liquidity transformation with incredible duration mismatches that blind the younger generation versus the older generation.
Jeff, have you ever thought about being a teacher?
No, man. My wife's a teacher, so I think I get enough of that at the home.
You've got a very teaching vibe to you. Like I'm sitting here just learning and consuming.
It's really
Oh, man.
I appreciate it.
Well, no, I love educating people, but also I learn a lot from having conversations with people. It's a two-way street, and that's been one of the most fulfilling aspects of reaching out to the Bitcoin and crypto community. I love that all the folks I meet through the Bitcoin community came for different reasons. Bitcoin can sometimes be a mirror to reflect the social values that you feel that is most important and pertinent to you. And in some ways, the common value that I see amongst all of us is we're all high agency people. We all want self-determination. We all want to think independently and critically. And I cannot imagine these features being more important now than ever. And if I can be a part of educating that importance more and more, I will be a part of that story any day.
Jeff, are you bullish on BitTensor?
You know, I haven't spent nearly enough time on it as I should. But from the time I've spent, I think that I think the meta is super important. I think it is one of the keystones to be had in the age of understanding what agentic finance and agentic commerce could look like, especially with the inability to price intent. So I think the meta is very worthwhile. The same way I think that the meta behind privacy coins are very worthwhile. I often have a hard time ascribing the value of the meta to the actual price action of a single token, but the people that are behind it, the foundations that are supporting it are credible people that I've come to like in the space. And so it should probably sit on my research queue a little higher, and you can ask me next time when I'm back.
I'm going to ask you another one. Are you bullish on Hyperliquid?
That one I can answer a little more conviction and say yes. I am bullish on Hyperliquid. I'm bullish on Hyperliquid because whether you like it or not, whether your politics lean left or right, it's pretty clear that hyper-financialization is an unstoppable trend. And it's not a crypto story. That's actually happening everywhere. we're seeing that with private equity and private venture companies being stuffed into public ETF formats that are trading at premiums outside of its NAV. We're seeing that with the rise of 2x levered ETFs and 3x levered ETFs. We're seeing that with the rise of zero-day expiry options. I don't know if you guys saw, but in February, 60+% of all S&P options, 60% plus were zero-day expiry options. It's a new record. Now, I'm not saying whether that's good or bad. I'm just saying it's happening. And so the thing that I appreciate about what Hyperliquid at least is doing is they're trying to create a market structure around these thematics with more transparency than I think most traditional markets permit. And as there's growing unrest in the roles of how automated market makers are abusing our US capital markets, I think it's important that there's a competitor that can stand behind it in a different way to offer a parallel system. And that keeps competition, that keeps people in check about a value proposition, because in the end, without customers, exchanges are nothing. So it is one of the purest businesses, in my opinion, where if you do a good job, you're rewarded. And if you do a bad job, the customers don't come. And Hyperliquid clearly has proven something valuable based on the tremendous success it's had. And I do believe that trading derivatives is just going to become a larger part of how people think about risk-taking and hedging. And so those types of developments at the frontier is where the exciting things are happening.
Yeah. Last thing for me, I'm just curious to just hear about anything that you think we didn't cover that you think is particularly interesting, that you have your focus on as of late, and you want to make sure that you educate the people on.
Man, I've only been thinking about crypto for so long that it's hard to sometimes get my head out of it. Look, I read something pretty scary the other day, which is that most Americans are reading less, and actually kind of the growing population are having a hard time reaching even the fluency of a sixth grader amongst the cohorts that are rising. And to me, this is a problem. This is a problem that is universal beyond the issues at crypto. This is a problem about, again, going back to human agency. And so one thing that I do feel really passionate about is we have to start reading more. And by reading, I don't mean doom scrolling Twitter. I don't mean TikToking. I mean, pick up a book, sit down with it, read it from cover to end, and don't check your phone, and try to actually teleport yourself into this other world, because that's how you build focus. And focus, believe it or not, is a muscle. Yeah. And if you don't build it, you're as good as an NPC and a bot. Yeah. And my bigger virtue above all of crypto is I want people to live a high agency life. And to do that, you have to read more. And I will go even one step further to say you have to read fiction.
Fiction.
Fiction. Because I think nonfiction is read with a different deliberation for purpose, which is information discovery and knowledge gathering. But it's really in reading fiction when you are allowed to have creative thoughts that can metamorphosize into something intelligent and unseen. And especially in the rise of AI, where you're already seeing how everybody sounds like slop because they're repeating the things that otherwise is consumed as common knowledge amongst news. It's actually in fiction that you find the art of communication that allows you to be convincing and empathetic, and all the ways that you're not going to learn from participating in AI slop. And so I think reading fiction is so important, and it's a little out of favor. I know this because none of my guy friends read fictions, but it is, I think, probably the most important thing we can do for ourselves for our own longevity for the decades to come.
Great take. Awesome. Jeff, thanks so much for joining
Jeff,
the show. It was an
joining me.
absolute pleasure.
This was great.
Meet you, man.
This was so fun.
Soon.
Let's do it.
Education's one of our main missions here, and you certainly educated us and the audience. I really appreciate it.
I love it. No, thanks for the kind words.
Absolutely. We'll see you
Ladies
next
and
time.
gentlemen, we will take a quick commercial break before our next guest. Guys, don't go anywhere. Stay tuned.
With the Genius Act in the US and MiCA in Europe, formal stablecoin rules are taking shape. However, regulatory fragmentation remains, and clarity is still often cited as the biggest barrier to stablecoin adoption. Are these new rules accelerating institutional adoption of stablecoins and cross-border payments, or creating regional silos that limit global scale? Austin, you want to start with this one? I think you have some strong opinions here.
Yeah, I mean, I guess the answer is integration between rich regimes, because the answer to your question is yes. Both. For instance, if you look at Genius stablecoins and you look at MiCA, they might be mutually exclusive, which that's not actively helpful for cross-border payments unless we establish some sort of reciprocity. Here's the reality. The views of regulators and governments on this are not uniform, and the incentive functions that they're dealing with are very different. If you are a small to medium-sized sovereign in global markets, like outside of the G8, US dollar stablecoins are probably an existential threat to your existence. And so their view of that are going to be very different than, say, the Eurozone, where I think the euro probably continues to perpetuate. The other problem here, and Tom was alluding to this earlier, is the granularity of what do we even think we mean by like money. Genius is a good example of this, where they define stablecoins as essentially an instrument attempting to hold a $1 value on a blockchain. And then you go and read it, and there has to be a list of like 20 different things that are exempted from that because they're doing the exact same thing, but they don't want them in that framework, like tokenized deposits. And then elsewhere in the text, maybe didn't think about that, and so some weird interactions are happening there. There's going to be a lot of teething. So is this accelerating institutional adoption? Yes, but you need to be specific on a use case by use case basis. None of these frameworks cover all possibilities.
Yeah, I agree. It's definitely helpful to have clear rules of the road, so that institutions in both markets can understand what needs to be done and what good looks like in order to participate with this new technology. But the real value proposition of stablecoins is that the sending institution in one country can send that cross-border in seconds at a very low cost to another institution in another country in settlement of a liability. And if those two countries have different regulatory regimes and the same stablecoin can't be used because of regulatory fragmentation, then that really undermines just the core thesis and value proposition of using these things for cross-border. And I think we're already seeing that with, so Austin pointed out, in the MiCA regulation, MiCA requires the reserves to be held in European banks, and that's designed to protect the European banking system. But that means if you're a global stablecoin issuer, operational in lots of different countries, and for a company like ours who wants to use a stablecoin to transfer value in lots of different countries, that fragmentation is very unhelpful. You have to have a very specific reserve mix, specific operating model just for one market. And I think that is a problem. And if regulation develops in a similar way in lots of other markets who are taking notes from both Genius and from MiCA, that could be damaging to the overall value proposition. And I'm hoping regulators can get their heads together and really think about that.
Bob, you want to add anything else? Tom or Lauren?
I mean, just in terms of regulation, I was in Washington last week at the DC Blockchain Week, which is a fantastic event. And it's pretty clear we have a real tailwind from the regulation from the Genius Act, from MiCA. There's a similar stablecoin bill in Hong Kong, for example. And so all of those things matter, but step one is legislation. Step two are the rules by the people who've been designated the regulators for that. In the case of Genius, that's at a state level as well as at a national level through the OCC. Those rules have just been published and out for comment, right? And again, it goes back to my certainty point. Corporations and financial institutions are not going to use any kind of asset, including new forms of money or digital forms of money, unless they're certain on what it is. Unless they're certain what rules do we play by. They're not just going to say, I'll just put $5 million in my balance sheet and see what it turns out to be. Like, nobody's doing that, right? You need the clarity. We're making really good progress on that. Congress is working together very, very well. They had different agencies, CFTC and FDIC, I think are part of this conference as well. They're committed to it, and they'll get it right in the U.S., and I think that'll be a catalyst for the rest of the world. And then it gives you an environment where it's ingrained in law. It's not going to switch with a regulator or an administration, and people can get back to certainty, which is what you're going to need in an institutional environment.
Lauren, how does Ripple look at regulatory landscape? Is it a tailwind, headwind?
Yeah, like everyone said, the tailwinds are strong. So as an issuer on the Ripple side, we take a really conservative approach to regulation. We work very closely with our regulator, the NYDFS. On top of, we've now been approved for an OCC bank charter, and so we'll be doing the work there to make sure we're adhering as needed. I think as a builder, maybe stepping back from Ripple, I've been building in crypto for 5 years. You know, we've watched different firms take different stances on how liberal or conservative to go, and we've seen some firms be burnt. We are hopefully past that, but yeah, I mean, I agree with everyone. Like I said, as an issuer, we take a very conservative approach, and we want to make sure we are following the rules and innovating within guardrails, and that is what's best for our customers.
I'll say though, I understand everybody on the institutional side says that. There are some people who are going to push the boundaries, and this is going to create some problems for regulators, especially as we get outside of the jurisdictions that have had really good rule of law. So like Tom, operating from Belgium or operating from the United States, you're within systems that, to be honest, have largely worked properly. But if you look at global stablecoin distribution, like if your other option is, I don't know, the Bolivar or something like that, like locally, you might take a yo on Tether, right? And so one of the other things that regulators have to realize is all people need to get a US dollar stablecoin of any form is the internet and something of value to trade for it. So if your local system is worse than that, you're gonna lose, right? This is something where people will be dragged along by the technology, kicking and screaming, in some cases voluntarily leading in others.
Great. So now that we've discussed stablecoins, value proposition, institutional adoption, and regulation, if stablecoins achieve global scale and cross-border payments, which institutions or revenue pools are most exposed to margin compression, and which business models are best positioned to capture the most economic upside? Tom, you want to take this one first?
Yeah, I like the business model question because sometimes this is not fully understood or gets conflated. And sometimes when we say a bank, you know, whether it's, you know, Citibank or these are large, complex organizations do many, many things really, really well, right? So one of the business models they run is the corresponding banking business model. That's high-value payments cross-border. Those are important payments. If they don't happen, then money gets stuck someplace it shouldn't get stuck, or somebody who's relying on those funds to do something with that doesn't get their money. Right, so with the larger the value and this kind of the corresponding banking business model, again, it's very different than retail. But another thing that's really important to consider is that the banks that are on SWIFT, the correspondent banks that are on SWIFT, actually compete with each other every day on SWIFT. So think of SWIFT as the network where the corresponding banking business model is run, and that's where large value institutional payments are done today. So how does when we're talking about the business model, how does a corresponding bank make money? Right, there's three ways of doing it. Foreign exchange, obviously cross-border, right? They keep float or get interest on the Nostra Vostra accounts, which are gigantic, right? There could be, I know, estimates of $10 trillion in Nostra Vostra accounts on any given kind of normal day. And then they make fees when they intermediate, right? When you instruct a payment here through your U.S. bank and they have a relationship with a bank in Japan, for example, somebody's going to collect a fee along the way as that money moves around. So the thing that's really interesting is that
All right, we are back, day 2, Digital Asset Summit. Very excited to welcome my friend Muriel of Optimum here to the show today. Muriel, it's a pleasure to host you, I think, on the show for the first time.
Yes, yeah.
Absolutely. So, quick story. Muriel and I met in the University of Florida. She was giving a talk, very technical talk, very informative about how some of these things work, algorithms and staking infrastructure and data availability at the time. And so I think it would be great to start with just sort of maybe a bit about your background, but then we'll get into some of the architecture around Optimum, kind of lay the foundation for everyone to understand what's happening here.
Thanks. Yeah. It's funny, right? It was like 2 years ago, I think we met in Florida, something. Yeah. And we had such a great time. I remember going to that great deli near the campus.
We went to lunch there too.
Yeah. My name's Muriel Medard, and thank you so much for having me. As I said, first time on the show, I was really looking forward to it. I have spent my career as an academic, as as you were mentioning, giving highly technical talks to willing or unwilling audiences and students. And I've been doing that at MIT, holding the NEC chair in software science and engineering. It's the main software science and engineering chair for the School of Engineering. And this whole time, I have been working on decentralized coding. Coding in the sense of taking data, making equations, and making those equations render the data more robust, more reliable, faster to access, and effectively creating truly a decentralized data infrastructure, accelerating the data. When I started doing it, I think my colleagues were doing wellness checks on me because it was just like such a weird thing to do. But, I was very, very fortunate. My career went very well. And I think because people thought, well, this is really innovative and the math is really cool and you can do all kinds of cool things, who knows why you would ever do anything decentralized? Can you think of anything decentralized? And then, of course, here we are this many years later, and we have Web3, and it's about decentralization.
Yeah, and for so long, academics such as yourself were working on the math, working on the algorithms that ultimately, they were pushing the efficient frontier, but there wasn't a lot of pragmatic product market fit or any sort of real tangible applications for a lot of this math, which I also have a pure math degree as well, and I think that is sort of a drawback of the industry. So much of this feels like pushing and pushing and pushing without the gratitude or the gratification of ultimately finding an application for a lot of these things. So how did you feel after working on a lot of this math and then having Web3, Bitcoin, blockchain ultimately come forth? It was just a match made in heaven?
It was. I mean, I have to say, I really believed at some point we would have this sort of decentralized, infrastructure, basically for data and computation. And the reason was that you can't really scale without it. It's not so much, to me, a question of philosophy. I mean, there's some really interesting philosophical questions about, what kind of governance you want and so on. But whether you like the decentralized governance or not, it's the only one we have that can actually scale. Think of, for instance, the electric grid. Really, when you have failures, it tends to be because there's been too much centralization in one location, but we don't have one big global interconnected grid. It is interconnected, but it's not centralized. And if you try to make it centralized, it would be so fragile that it couldn't hold. Same for Web 2. It is robust because it is decentralized. Again, many times when we have, massive outages, it's because there was excessive centralization in at least some part of it.
I want to clarify, when you say decentralized governance, it's maybe not, the typical DAO voting structure that we're talking about.
Right.
We're talking more about the coordination of actors in a decentralized network.
Yeah, that's right. No, that's a really good point. Decentralized operation, heterogeneous players having to manage playing together without a single person telling them all what to do.
Yeah, and blockchain is great for this. It's, I think, the best technology for coordination of actors that are not necessarily trusting of one another. They don't have to, but they are able to facilitate transactions and coordinate and orchestrate with one another. And so you were working on this, you saw decentralization finally come up as a practical application for a lot of this math. Bitcoin and blockchain continue to progress. When we met, I think it was a couple of years ago, Optimum at the time was primarily used for the computation of data availability. And the industry has progressed quite a bit since then. There's still a lot of compute. In fact, I maybe later in the conversation we'll get to the decentralized inference and compute that's now being talked about in AI, NVIDIA and Chamath Palihapitiya. We're talking about this at NVIDIA's conference. So, BitTensor and these things are getting a lot of traction as of late. But kind of, working our way up to this, Optimum started, at least my understanding is that it started as data availability. Give us a sense of how it started and how it may have evolved over the last couple of years since we last spoke.
Absolutely. So for us, when we were talking about data availability, it was not data availability sampling, let's say, in the traditional sense, only. It's really about accessing and having data access. So data acceleration, getting your data or whatever you need about your data fast. It's not necessarily just about sampling and figuring out whether, a full node
Whether it
has...
exists.
Exactly.
Right, but actually getting that data.
Yes. So, if you think of, data availability and access, data acceleration writ large, that's what we do. Which is, not just about checking that it's there. And in particular, what we've been doing with validators on Ethereum, and right now, if you look at the validators that we've signed out, we're talking about 30 billion of staked ETH, and many of the larger ones, and our partners like Everstake, Nethermind, Blockdaemon, etc. What we're doing is we are making the operation for the validators faster and more reliable.
Got it.
And effectively, that's what you need to have a true infrastructure. I need to know that the lights are going to go on. I need to know that my internet's going to be, not always there, but by and large, yes. Otherwise, you can't rely on it. You can't really create services. And you can't afford just putting tons and tons of money and building out hardware everywhere. That doesn't scale, certainly not at a global scale. And even locally, it becomes very, very expensive. So what we do is this decentralized coding, which I mentioned I've been working on. Actually, it just finished Monday and Tuesday. The reason I wasn't here yesterday was doing a first decentralized coding workshop at MIT, co-sponsored with Optimum and also Georgia Tech. My good friend Sharon Vishwanath there, and we had people talking about data availability, sampling, as you were mentioning. A lot of people talking about decentralized online learning, and so you can see that this is really bringing together all of those different strands.
Yeah, and so there was a big piece of news that dropped today, which was BitMine. Obviously they're working their way up to 5% of the global Ethereum supply. I think they are, over halfway there. They've got billions of dollars, I think upwards of $7 billion now that they have in their treasury staked. And, they're working on deploying another $5 to $7 billion. And they're targeting staking infrastructure and verticalizing it, being the largest staker of ETH and doing so in a very quantum secure way. I'm curious what you think this could mean as they are verticalizing their staking infrastructure, what it could mean for BitMine as one of the largest holders of Ethereum.
Yeah. I'll maybe address those very good topics more generally rather than just in the context of BitMine, although obviously that's a prime example as you bring up. So I think that there's a couple of things there. One is, really staking with APY in mind. I think, that's the first facet of what you're describing. And a lot of that actually relies on speed, right? I mean, we all know about MEV and MEV games and timing games. Those are really gaming with differences in speed and latency. So what we're able to bring is better latency. But not just better latency on an average measure, but also, and you'll love this as a as a math major, but also with respect to reducing the variance, more reliable, right? So you very much improve the mean, and you massively improve the variance. And that's one of the things that coding does in writ large in many different settings. It reduces the variance. So that's, I think, very important if you are going to say, look, my gig is I'm just going to get better APY. How do you do so, A, and B, how do you do so reliably? And whether you're staking your own ETH or staking for somebody else, that's the name of the game. The second facet that you brought up, which is the quantum security. And it's interesting because Post-quantum security has nothing to do with quantum, right? It's actually about cryptographic approaches that are, as far as we know, not breakable through a non-deterministic computer, aka a quantum computer. And many of sort of the workhorses of cryptography right now, such as, for instance, RSA, which was co-invented by Ron Rivest, a colleague in my department at MIT, was later shown by another colleague at MIT in a different department, Peter Shor, to be breakable if you had a quantum computer, right? So, we can argue how big a quantum computer, when do we have it, but the point is that the algorithms are there, the math is there. And so the types of cryptographic systems that are post-quantum secure are actually very few and far between, and they're actually all based on coding. So the coding aspect, the making of those equations that I mentioned at the beginning of our conversation, is actually the basis of post-quantum security. So you can't do post-quantum security, short of doing, some really very difficult physical things, without having the coding. So the coding is really underpinning everything there.
Got it. And so this is Optimum's specialty.
We're the coding guys.
The coding in particular.
Yeah.
And so help us just understand, if we're drilling down a level deeper here, the coding and the architecture that allows for more reliable and lower latency staking infrastructure. You mentioned that you've onboarded $30 billion worth of ETH. Give us a sense of how you've done this, why people that are staking for others in terms of institutional stakers and staking for themselves, these large holders, why they're choosing Optimum and what sort of tangible benefits they're able to drive.
Yeah, so we are actually right now through the process of launching mainnet. So we're right now what's called the calibration phase, right, when you're calibrating, and we'll going on mainnet next month. Ethereum mainnet. So it is a very, very exciting time. But as I said, we've had very, very large number of partners with, considerable portfolios on our testnet for several months at this stage. So the idea is the following. You need to your node, and you need to have some information from somewhere, and it's decentralized. So somewhere in this big auditorium that we're in, this big room, somebody sends something, and you need to get it.
Yeah.
How does that happen? Well, if we're talking about Ethereum, that person hands it to their neighbor, who hands it to other neighbors, and this information is just flowing around, sloshing around until it gets to you. One of the approaches is, first of all, to make that information into smaller pieces, right? So that people are not, handing over, big blocks, but maybe smaller shards. So that makes everything a little bit more fluid. One can see the benefit there almost intuitively. But the problem is now you're going to be picking these shards, and maybe somebody took a block and cut it into, say, 10 shards. And you get the first shard you get is maybe shard number 4, and you go, great, I got shard number 4. I never saw it before. I'm so excited. And then the second shard, 90% of chances it's not the one you saw already, right? Because you only have one. By the time you have half of the shards, 50% of the time you're going to see something you already saw. Right. By the time you got 9 out of 10, almost every time that you see a shard, you're like, yeah, tell me something I didn't know. So there's a name for this problem, which is, why it's easy to start collections, whether it be a Pokemon collection or a shard collection, and it's hard to finish a collection. It's called a coupon collector problem. Now, if instead of doing that, you said, hey, look, I'm a math major. These are shards, but actually they're just numbers. I'm going to combine them. Now I have 10 unknowns. If you give me 10 equations, as long as, there's nothing wrong with the equation, so that, I can solve my system of equations, 10 unknowns, 10 equations, I'm done. As soon as I've got 10 equations, I'm done. So you almost never see a repeat equation, right? Versus you almost always see a repeat charge, towards the end.
Right.
So
Got it.
that's the crux of it.
Okay, awesome. Muriel, my last question here as we sort of draw to a close is, obviously you've onboarded a significant market share of ETH onto the Optimum system, $30 billion worth, looking to go live on mainnet very, very soon. ETH is at about a $260 billion valuation right now. So, over 10% of the network. Will we just continue to see the Optimum market share continue to drive up until we're hitting really, really high numbers in terms of the percent of ETH that's staked through Optimum? Is there any cap? At what point is there a centralization risk or something of ETH staked? How do you think about this and the go-to-market and the scaling strategy?
Yeah, so we're decentralized ourselves. So we're not, we don't have a centralized system. We are actually decentralized. So, as I was telling you, these equations, we're not making those equations. Other nodes are making them. So we don't have a centralization. I couldn't centralize it if I wanted to, not that I even want to. Our goal is not to hit any particular number. It's just to onboard people if we can be helpful to them.
Yeah.
But as we're moving ahead, we're actually also going to other projects.
Okay.
So Ethereum's of course a great place to start, but we're chain agnostic.
Yeah.
And our goal is to have this data acceleration for as many chains as possible.
Last thing just came to mind, if the elevator pitch, if BitMine is out there watching now, they've got a lot of ETH, they should be staking it through Optimum. What's the 1 minute elevator pitch to Tom, Lee, and BitMine watching, thinking about how they're going to stake in their new program?
Well, staking rewards, connect to latency, APY and latency are tightly intertwined. You want better APY, you better have better latency.
Awesome. Tom, Lee, you heard it here first. Muriel, thank you so much for joining the show.
Thank you. Thank you so much.
Yeah, looking forward to the next one, and best of luck on the launch.
Thank you very much. I hope to be able to update you about it in the future.
Please do. We'll see you then.
Thanks a lot. Take care.
Thank you so much.
Thanks.
See you soon.
Bye-bye.
All right, guys. We'll be right back. Thank you so much for watching. Don't go anywhere. We're going to have our next guest, RJ from Aligned, chatting a little bit about DK. See you soon.
problem that we have right now today in the blockchain-based finance world is that it resembles the same fragmentation that we started with. And fragmentation breaks financial systems. To quote the BIS in a recent report, when transaction fees become too high on one blockchain, users migrate to alternatives, new blockchains emerge to cater to these users, and the user base splinters across multiple chains. Rather than the virtuous circle of greater acceptance and greater use, there's a fragmentation of the monetary landscape. Network fragmentation has emerged as one of the most pressing hurdles to adoption and building at scale within blockchain-based finance. There was a recent report co-authored by the DTCC, Clearstream, Deutsche Bank, Euroclear, BCG, about the key problems of interoperability and the fact that without interoperability, assets remain trapped in isolated pools, operational costs remain high, and operational and regulatory risk remain elevated. The key thing about cross-chain interoperability is latency of settlement finality. So contrary to what maybe most people understand, messaging or bridging standards are not enough to solve coordination alone. Applications across chains, fundamentally, they can't communicate with each other faster than transaction finality. So if you have different standards or protocols out there like CCIP, et cetera, they can't communicate messages between blockchains faster than those blockchains are actually able to reach finality. And for context, blockchains like Ethereum have extremely slow finality times. Ethereum takes 15 minutes to finalize transactions. Even if it's on so-called layer 2 chains on top of Ethereum like Base, settlement time is 15 minutes or more. And so applications spread across different chains can't communicate in real time unless you have fast finality of many different chains. And so what we do at Espresso is we use state-of-the-art consensus to unify liquidity across assets and create seamless interoperability between blockchain platforms. We provide speed and security. Importantly, we provide customizability. You can create different blockchains that all inherit the fast finality and speed and security of Espresso Network, but using different types of customized environments. We're compatible with all kinds of VMs, even application-specific blockchains. It could be EVM, it could be non-EVM, it could be something entirely different, as we're going to demonstrate today in our collateral management use case demonstration. And the important thing is that everything running is composable, not only with other chains that are running on the Espresso network, but also with other blockchains that exist today, like Ethereum, Solana, et cetera. It's a fast settlement layer, so it can support many, many chains collectively reaching very high, up to millions of transactions per second. And while today we don't necessarily need to support millions of transactions per second to bring mainstream finance on chain, people do talk about how with the future of agentic commerce and the more kinds of heavy calculations you might want to bring on chain, we do need to scale up to that kind of throughput. And the way this scale happens is through parallelization. You need to be able to support many different customized chains running in parallel, and that's how you get to millions of transactions. That's how you get to real-world scale. The key thing that the Espresso network does is it doesn't handle the application logic on these different chains. It just provides settlement of data. It finalizes transactions and makes it so that everyone can read it consistently across the world. Now, that brings me to what we're going to talk about today, which is collateral management, a use case that many have stated is the killer app of blockchains. Collateral mobility is the killer app for institutional use of blockchain, as Dan Donnie from the CTO of DTCC said. And the key thing about collateral management is that positions can span multiple chains, especially if we're in a multi-chain world. And we need to have a continuous risk recalculation. It's very computationally intensive. And cross-chain actions that involve pledging of collateral, movement of collateral, or even freezing of assets when...
Ladies and gentlemen, we're back, day 2, DAS NYC. We're here with RJ Roberto Catalan de Buenos Aires, mi amigo. He was asking about our amazing production team down in Colombia, trying to find out where they are. We're here today in New York City. RJ, join us here, man. How are you?
All good. Am I in the right position here?
Yes. Yeah, you're doing great, man.
Very good. Happy to be here.
Welcome to New York, man.
Thank you. Yeah, I know you are locals now, so...
Slightly.
It's your job to receive me now.
from your home towers.
We're here. It's DAS Day 2. Everyone's wearing suits. It's very institutional. There's a tokenization mania happening. Aligned being a very DeFi native, crypto native company focusing on ZK, focusing on launching blockchains. How do you guys adapt to this ever-changing environment here where it's much more of an institutional-oriented environment? What is the Align strategy to play a part in this future of digital assets?
Yeah, I think now our job is having the conversations to explain to all of these new players why the infrastructure that we have built in crypto has actually get us to this point, right?
Yeah.
I mean, people demand Bitcoin, they demand Ethereum and DeFi for certain reasons, certain features that we built with the infrastructure that we have. The question is, how can we explain to them how these features are useful for them in order to grow their businesses and provide better services as well? So our job has been talking to all of them, trying to understand how they can adapt to this technology, and we call upgrading, we're in the phase of upgrading the system to Ethereum or to blockchain, right? And it has been a new type of adventure, I would say, because there are people that see the world differently and they make different trade-offs. So for us, we are 100% focused in talking with enterprises, fintechs, and institutions to see what we can build in the last mile to offer them to migrate to wallets, to rollups, and to interoperability using digital assets.
Yeah, and so you guys are doing some work with, or at least kind of associated with a couple big companies, Nubank, Levenue, some of these larger institutions and neobanks down in Latin America. There's been a really big jump in neobank adoption in Latin America as well of stablecoins and digital assets. How do you guys take a part in that, and what is your view and vision on the kind of neobanking side in Latin America? What's your take on that side of things?
Yeah, I think it's an objective thing to say that today neobanks are eating part of the pie of fintechs. And I think every single fintech in LATAM is asking themselves, like, what can I integrate in my tech stack so I can compete with them? Because if you're from a country where your currency is very weak, you have a lot of inflation and devaluation, offering services in dollars, that is a strong currency, is a 0 to 1. And it has always been a very big problem for fintechs. How can I get access to the best banking system in the world, that is the US? And neobanks have offered a way to offer this to users just by connecting to the internet. So everything we're seeing is people saying, okay, how can I integrate stablecoins so I can offer dollars? The product they're selling is access to the dollar. So for us, the we're an infrastructure company, what we are doing is building every single part of the stack they need in order to offer what people are demanding right now, that is access to dollars. And for that, we need to do a work that is not only on the fintech side here, but also on the fintech side in the US. Which fintechs in the US want to get into LATAM, and we can be a bridge between the neobanks that we have and the more formal place in the States. And that's what we're doing a lot as well. Like, I give the technology, but we are someone who can speak with a fintech in LATAM, but also with a fintech in the US, because we know very well the technology and very well the use cases. And I think that's an edge that we have.
So a lot of the announcements that were made this week, some of the biggest ones were co-branded announcements and partnerships between tokenization partners and asset management partners. Like Superstate, we had Jim Hiltner talking about their partnership with Invesco, Carlos Domingo and Securitize partnering with New York Stock Exchange. These are asset managers partnering with these tokenization to ultimately give them distribution, tokenize their funds, give them composability, all the benefits of tokenizing and using blockchains. Neobanks are a little bit different, right? Yep. But they're still kind of in this, they're not really crypto native, right? But they're on the more like Web 2 fintech, that sort of side, similar to these asset managers, but a little bit foreign. What are the neobanks primarily looking for? I take it it's probably a little bit different from the asset management space. When you're helping them as a tech enablement partner, what are you hearing? What kind of questions do they ask you? What are you helping them with?
Yeah, I think the first question is, how can I give access to my users through a debit card or credit card that is with stablecoins? Like the first thing they ask out of the box. Why? Because that already has a product market fit and people are asking. But what we are saying to people, and it's very related to what you're mentioning with tokenization, Robbie, is stablecoins show that the world demands dollars, and they want an easy way to access dollars. What is the US exporting? Just the currency. But the next wave is not exporting only the stablecoin or access to a quick bank account, but it's also exporting the financial system that you have with Wall Street. People in Latin America, they can't easily buy an Apple stock. And people who say they can, they haven't actually tried. I ended up buying Bitcoin first because I couldn't buy an Apple stock. That was literally the problem I had as a user. So I think the next wave to neobank is saying, hey, we can give you access to stablecoins, but people will, of course, they will want Bitcoin and Ethereum in many cases, but they also want NVIDIA. They also want access to T-bills. Getting access as a small enterprise in Latin America to yield on using T-bills, that is the safest asset in the world, is extremely hard. You can't do it.
Yeah. So it's turning the main export of the U.S., which being the U.S. dollar, it's activating more of the U.S. economy, the entire U.S. equities complex, more of the Wall Street financial mechanisms, exporting those in addition to the dollars.
Exactly, because the U.S. has built over the years, it has started like great institutions. Replicating those great institutions is extremely hard all over the world. And if you see when you travel, having a Wall Street is not easy. And the thing is, when you speak in Wall Street, people are saying, yeah, you can upgrade and have like 24/7 settlement, instant finality, whatever. But at the same time is, hey, you can grow your business because you can connect Wall Street to the rest of the world. And the question is, what's the best infrastructure to do that, and how can you do it in a way that is easy for neobanks to offer to their users? So I think the next thing we'll see is kind of like what you have seen with Stripe and Bridge. That Bridge like nailed the UX for developers for using stablecoins and bank accounts, is nailing the real world asset and tokenization. Because that's what people will demand.
And so when you guys are looking at the aligned product roadmap and kind of sales cycles, again, like how do you guys get in front of this? Is it partnering with the neobanks? Is it building chains for different banks, for different institutions? How do you kind of bridge this LATAM and US capital markets gap?
Yeah, so I think there are two things. One is like the BD part, and the other one is the technology part. We're very confident that the technology part is almost solved, because CK's already got us here for scalability and privacy that can be also used for compliance. And the customization you get with your own rollup is very important for people in Wall Street, that they need to have their own garden and define their own rules. There are like, adoption is coming here, but every single person I have spoke from Wall Street, they want to do something, but they don't know exactly what are the rules right now, and how would that do, how the connection with the new technology will work. So our job is trying to advise them and tell them, hey, this is how our tech in our part of the world works. Let's see how we can connect it in a sustainable way that can actually help grow your business, and go into the neobank saying, hey, you already are offering something people want, dollars. Okay, why don't you offer this as well? In this case, tokenization of assets. Mm-hmm. Or how can we help markets in existing countries, like in LATAM, get access to the liquidity of the states? Because it's a two-way bridge. It's offering Wall Street and also connecting or giving Wall Street opportunities with better trust assumptions of countries where they cannot operate. If you want to operate in Argentina, you don't know if in 10 years you will have someone else who will increase capital control. And if you run a multi-billion-dollar business, opening a subsidiary in Argentina is a risk.
Yeah.
But if you use stablecoins, maybe the risk lowers and you can take that bet.
Yeah. I'm curious how important ZK is still to the Aligned stack. Is this something that neobanks are prioritizing in fintechs? Do they care about privacy? Do they care about ZK? Or has the strategy shifted towards one that's more stablecoin centric?
So ZK is not the product. ZK is like the techno. If I had to make an analogy, I think it would be like, hey, I'm PayPal. Mm-hmm. My edge is that I'm connected to the internet, anyone can access to me. Mm-hmm. And they nailed the fraud part. But they were not selling the internet in itself. They were selling the availability for money, being able to connect the dollar directly to eBay and all these things. So we're not selling ZK. What we're selling is products that are way better because we use ZK. Why they're better? Because they're simpler to understand and build. Because a rollup used to be a Frankenstein before.
Yeah.
Now it's not a Frankenstein.
Yeah.
It's simpler, modular components, and that's only possible because we use ZK.
Yeah.
They do want privacy and compliance, and I think that's where ZK will come very handy. And that part, even though a lot of people think KYC and ZK is solved, I think we're not there yet. And I'm very confident that with our expertise, we can solve problems people have by knowing how to use this technology correctly.
Yeah. I'm curious about the consumer behavior. Like, we've heard that, consumer behavior is one of the slowest things to change. Obviously, people know the brands that they like. They have their consumer practices. They're used to going onto online banking, logging in. They're used to these sorts of practices. Once you start to offer some of these other Wall Street mechanisms that we talked about, and these other more, even if they are like high quality US equities, these other speculative assets inside, some of the neobanks and fintechs that, people are accustomed to, how do you think consumer behavior might change? Is this going to be like the hyper financialization and gambling, like everyone seems like they're addicted to it now? Or like, how do you think people are going to react when they start to see equities and stocks and lend borrow inside of their fintechs?
So I think, yes, we'll see a mania of like people buying a lot of things, but I'm very optimistic that I think with these new rails, we'll be able to build markets that were not possible before. And I will give you an example. When you look at how finance used to work like 150 years ago, things were more local. You used to go to your bank, you knew the person that was in touch with you in the bank. They say, okay, you're a farmer, I know your family and friends. There was some trust network, right? And that broke because we didn't have the technology in order to scale that system of trust. I think with crypto we'll go back to the basics, saying that it will be internet native communities that will use this to build new kind of banking systems, like Mr. Beast bought a bank.
Yeah.
I think that's very interesting. Why? Like there's I use this example of a very widely popular YouTube channel in Latin America that is for traveling. It's called Luisito Comunica, like Luisito Speaks, basically. If I use him to decide where I travel, why wouldn't I use him to save in order to travel? Or use him in order to pay when I go to Brazil?
Right.
Like, I think the consumer behavior will change in the sense that now people that have different markets and different type of users that trust them for particular reasons, I will be able to put money involved in the middle. Because now we have the technology that allows us to make anyone be able to offer financial services with very high integrity. And that was not possible before.
Yeah, I mean, I think that as you look at the markets that are being the most adopted by blockchain technology, stablecoins, it is the markets where it is needed the most. It is the markets where these, as you mentioned, a lot of the access and the ways to get exposure to different dollars, equities, et cetera, isn't available. And so when you think about your kind of customers and who's going to be using your technology, it's almost like a lot of it's down in the Southern Cone, down at home.
Yeah, I think it will be connecting the two worlds. We're in a very unique position where we can go and say, okay, I know very well the technology, so to understand exactly what someone in Latin America needs. But because we know very well the technology, we can speak with someone here and say, hey, this is the right stack, and this is the way we can communicate the two worlds. Because for Wall Street, I think is how can I grow my business? How can I have more people buying and selling assets?
Yeah.
Well, the way is you already have the stage is very developed. Where else can you go?
Yeah.
I think it's incredible. I think the proliferation of this is you're going to ultimately get picked up on both the American side as well as the South American side as these things proliferate. And look, us as crypto native people, we're looking forward to high quality assets on chain.
Yeah.
This is something that most of the token economy is just not there. It's not high quality assets. We had Santiago talking about this. Like, we know this is the case. And so high quality assets on chain, I think, is something that everyone around the world is looking forward to. Because ultimately this improves everyone's financial health.
Well, it's just that all we had was crypto assets on chain, and now we're getting more opportunities, more flexible opportunities, and also from the strategy perspective, kind of bringing these two worlds together now becomes the main MO, right? I mean,
Yeah. I think the first person that benefited from stablecoins was the U.S. government. More people bought T-bills. I think the pitch to Wall Street is the Fed benefited a lot because people were buying, you had like Tether and Circle buying enormous amount, billions of dollars of T-bills. Okay, Wall Street, you can now have billions of dollars of people buying your assets. High quality assets, right?
Yeah,
just dump them on us. Let us have them. Thank you. RJ, man, enjoy your conference. I know you have talks. I know you have this other fellow over here trying to give you a demo. Thank you for joining us.
Thank you, guys.
Hope you have a great time here. You might need to wear the suit tomorrow.
Yeah. I'm going from hoodie to Patagonia.
Yeah.
Next step is the suit.
We're on the same journey. RJ, thanks so much, man.
Thank you, guys.
See you next time.
Thank you very much.
Man.
Pleasure.
All right, guys, we're going to keep it rolling here. We've got the Solana Policy Institute up next. Joining us, Miller Whitehouse-Levine. He is the founder of the SPI. Huge week in policy with Clarity Act, stablecoin yields. Obviously, a lot of controversy around these topics, guys. Regulatory clarity is coming, whether you like it or not, Rob. It's happening. I've got 30 minutes until my talk.
Okay.
I've got a neo-finance panel
do you?
on the institutional stage here, ready to drop some bombs.
Who's on the panel with you?
Invesco, Circle, and a couple others.
Yeah.
So we're gonna be joined by Miller here, the
There he is.
CEO here. Miller.
Hello.
Crypto policy is hot right now.
I guess
Good to have
so.
you, show.
I guess so. I've heard.
Missed you in DC at the amazing
I
DC
know.
Blockchain
Well,
Summit.
Here we are.
Yeah, we were supposed to host an event together, but the weather, the tornadoes in DC
Oh yes,
got us.
the tornado, the first in 20 years, of course.
Right? Of course.
The
On
event
the night
was,
of our event.
It was called Proof of Spring, so we earned it.
Man, I take it you've been quite busy lately.
It has been the busiest 15 months of our lives, for sure.
Yeah, man. I like to think of the SPI as kind of an extension of the entire digital assets complex. You know, I think you guys are obviously doing work within Solana, but really
Yep.
all the work that you're doing to push legislation forward for crypto as a whole is very important. So just wanted to thank you for that, man.
Well, I appreciate it. It has become a complex, and I think that's due to the crypto industry realizing DC is important. And if you're not at the table, you're on the menu, I think is a truism in Washington. So when I first started doing this work, it was a 3-person complex in Washington, not so much of a complex, and we had 0 resources and 3 humans. So it's been very encouraging, and we're appreciative of the investment.
Well, a lot of great work done so far, and a lot still more to do. Maybe we'll just start with a bit, of your background.
Sure.
From 3 people, no resources. Get us caught up. Where did you start in DC, and ultimately, how did you find Solana Policy Institute?
Sure, yeah. Happy to give my origin story. So
Yeah.
I first got into crypto 2013, 2014. I was in school, so not professionally, and I'm not a technical person, so I knew I couldn't do anything coding, but it grabbed me at the time. I was living in China, and that's quite an education. You really feel the presence of the state and how technology can be used to empower the state. And I think crypto is the first major technology in several decades that I think has a real shot of empowering individuals via centralized intermediaries, be those businesses or governments. So, I had an ideological attraction to Bitcoin at the time, and nothing else existed. Eventually, I got a job at the Blockchain Association working for Kristen Smith, and that's where I started my career. So I have only done crypto policy. I'm completely unemployable anywhere outside of Washington in crypto. And I think to answer your real question there, I think there have been kind of 3 eras of crypto policy. And the first was benign neglect. Like, no one cared about us. If a member of Congress ever said the word crypto or Bitcoin, it was an exciting moment, and we would all text each other. Now it's every day, like hundreds of members of Congress are talking about crypto, and it's like overwhelming. But, at the time, no one cared. And where that really changed was first with Libra, the Facebook stablecoin attempt, and then with the Biden administration. Era 2, Gary Gensler trying to kill us, not just him, but really the entire US government. I think in retrospect, it's come out engaged in a coordinated attempt to crush this industry in the US. That's problematic for a variety of reasons that we don't need to adjudicate again. But that brings us to Era 3, and I think a lot of the progress that should have been done and could have been done 10 years ago has happened in a very good press time frame. So it's just been incredibly busy and totally encouraging. I still have to pinch myself that legislation like the Genius Act is law, and that we're going to have it probably for the rest of our lives. So long may it continue. I think it's just always surprising to me how much more work is to be done. Like, each time we get something done, 10 new issues come up, and it's certainly going to be a long journey here, but we have to engage if we're going to be successful.
It feels like you said, that there's so much opportunity compressed in such a short amount of time that it is an all-out blitz and sprint to get as much done as possible. With the caveat that with government, things take time. What would make this administration a success? What has to get done? What work still has to be done to ultimately say, okay, we did what we had to do with the opportunity that was given to us?
Yeah, I think my philosophy, and I think the admin's philosophy, is to try and establish or implement as many durable wins as possible. I think our greatest macro risk from the policy perspective is the pendulum swinging back toward the Gary Gensler approach in the way that it moved in our favor last year.
Right.
So I think our big risk is 2029, and we need to get as many rules, statutes, laws on paper as quickly as possible, such that they're not immune, but are more durable next administration. Vibes are good. Obviously, tone at the top is important, but that can change quite quickly with an election. So I think getting rulemaking done, getting legislation done, which on the Genius Act has happened, is the focus. And I think to the extent we have rules that will outlast this administration in place by 2029, it'll be a success.
Yeah.
Epic.
Yeah. So there was recent news here over the last couple of days about some insiders getting some access to the next set of docs on the Clarity side, and that the stablecoin yield portion was still quite restrictive. At least that's how crypto insiders would receive it. Where are we at here? I mean, Armstrong has gone tooth and nail in DC to defend his business, obviously in his private interest, but the entire space. Where do we go from here on Clarity? What is the rumblings on the inside on the stablecoin side? Is there anything that you can share?
Yes, I mean, I think the first rumbling is just an immense amount of frustration.
Okay.
I've said several times already, the Genius Act passed last summer. This provision, or the issue that is now holding up market structure, was in the bill last year. Like, usually when a law passes, you wait a decade before trying to re-adjudicate it. For whatever reason, the banks were asleep at the wheel for the first bill to pass through the Senate Banking Committee in like a decade. They missed it. I don't know what happened, but they're trying to renegotiate a deal that was reached last summer and passed into law. So I think that is extremely frustrating, because now we have a stablecoin policy issue. We passed the stablecoin bill last summer, holding up market structure legislation because the banks, weren't doing their jobs last summer, is pretty much how they explain it. So that is extremely frustrating, and I think it's disappointing that they've had success holding up this bill over this issue. At the end of the day, what Coinbase and other stablecoin issuers are trying to do is pass on rewards to customers. That's a net benefit to consumers. Banks can compete if they want to not lose customers to someone that can give out more yield or rewards than they can. The banks don't want competition, and unfortunately, they've convinced certain members of Congress that that is a valid position. I don't know exactly where things stand today. The deal reached Friday does seem to be pretty favorable to the banks, and that's certainly what Coinbase is saying. So I think, hopefully we can have a peaceful resolution here in the next 48 hours, because time is running out.
When you say the deal that was reached Friday, like, who is that deal between? Because it does seem very one-sided. At least what we heard was that, effectively nothing that even resembled some yield could be passed on to stable coins. And so when you say a deal was reached, does that mean that crypto teams and blockchain lobbyist groups, signed off on this?
Not to my knowledge, and I think that's part of the problem here. I think the agreement in principle that was reached on Friday was between members on the Hill, so senators and the White House. And I don't know if anyone in industry has actually seen legislative text yet, because I don't know if there is legislative text yet of reflecting whatever the deal in principle was. So I think part of it is this issue has been now holding up this legislation for 9 weeks, and we're looking for a breakthrough. And so I think everyone was quite hopeful that the deal in principle would resolve it, and it hasn't.
My understanding of the way that these policy institutes such as Solana is essentially you're representing Solana in DC, and so I guess, would you advise Solana accept the current deal on the table?
Well, I think it depends on who you are. Like, I think our interest is making it as easy as possible, and as having as clear as possible rules for anyone that wants to build on Solana, to build a business, to build a protocol, to do so. Stablecoins are a massive, important part of the Solana ecosystem, and I think it's ridiculous that the banks are using what I believe to be, a fig leaf argument to try and protect their regulatory moat. So I certainly don't want to take the deal. I think that in context, the question gets trickier. Like, what I'm thinking about is, are the banks winning this battle, but we can win the long-term war? Or are the banks winning this battle and we're going to lose the long-term war? If it's the latter, then we should, take our medicine and take the rest of the bill, because there's huge benefits to other portions of the ecosystem by getting market structure done. So I think that's, unfortunately, the tough choice we as an industry and as an ecosystem have to weigh right now. Are the upsides of the rest of market structure make it worth, taking our medicine on rewards? And do we think that if we sacrifice market structure for rewards, that the banks won't win via some other legislative vehicle in 6 months, and we're all going to be very regretful. So, it's tough because you're taking a leap of faith either way, and it's late March.
Who do you think has the leverage right now?
On this issue? Well, clearly the banks have a lot of leverage. They've activated because, to their credit, whatever strategy they're implementing here is seemingly yielding them results, no pun intended. So I think who has leverage? I think crypto has leverage, the banks have leverage. It's kind of like an immovable object, unstoppable force situation, which is why this issue hasn't been resolved. Ultimately, someone has to lose here, and both constituencies have a lot of leverage.
Yeah. And is the urgency just midterms coming up? Is that the urgency?
That is the urgency. Congress in a midterm election season really leaves Washington at the end of July and aren't doing serious legislative work until after the election. And who knows, where things stand after the election. So that's the clock.
So we have 2-3 months.
We just thought it was Europe that took off for the summer.
Yeah, no, they're going on tour, right?
Yeah, exactly.
They
got to go win.
Yeah. What are the other less talked about things happening in policy right now? Everyone's talking about clarity and market structure. Are there other things around taxes, around payments, around blockchains? Is there anything else that's happening that's interesting?
Yes, for me, the most interesting thing that's about to happen that I feel like people in crypto have not picked up on enough is what Chairman Atkins was talking about yesterday with the innovation exemption. Yeah. What the SEC is talking about there is allowing for people to trade using wallets, self-hosted wallets, and on-chain DeFi protocols, U.S. equity securities, and public securities. That is an insanely revolutionary idea. 14 months ago, if someone told us that would be in the cards in 2026, I would have laughed at you and then shot you in the head. So it's, I think, quite revolutionary. I think it's a once-in-a-lifetime opportunity. The dream is for all assets to live on chain and be able to use them anywhere in the world at any time online, and the SEC is about to make that real.
And how do you anticipate companies and teams leveraging this innovation exemption? Maybe we have so many tokenization and asset management partnerships that have been announced.
Yep.
And he's going to go on a panel with Invesco here in a few minutes. How do you anticipate companies such as these guys are going to use the innovation exemption?
Well, I think there's a lot of obvious applications. What I'm most excited about is the unknown innovations or new markets that this will bring. It's much cheaper to go public on Solana than it is to go on the New York Stock Exchange and NASDAQ. So I think new access to capital for businesses that could not otherwise raise money is, I think, the most exciting thought in my mind, potentially new addressable market that the U.S. capital markets have never been able to serve. And same with the investor side. If anyone with an internet connection can access investment opportunities in U.S. companies, that's good for U.S. companies. That's good for wealth creation on the user side. And then if you're an issuer today, we have $100 trillion worth of securities, expanding the liquidity available to buy those assets, expanding for businesses the pool of capital they can tap is in everyone's interest.
Yeah. Quick question on the investor side. We also heard Seelig talk about how he's going to look at pretty much every rule in the rule book and remove a lot of the antiquated ones. One of the ones that I think he may be talking about, I'm curious to hear your take, is accredited investor laws.
Yep.
I just think it's ridiculous how they, it's okay for, normies, I guess, to buy lottery tickets and go to the casino, but they're not allowed to buy, private placements and securities. It just doesn't make sense. So what do you think is going to happen? Are you hearing any rumblings? Is accredited investor laws on the table as one of the things that could get repealed as Seelig moves through these rule books?
Yes, so I completely agree with you. I don't know how our current accredited investor laws are currently still the law. It's not just you could go buy a lottery ticket and get in private placements. It's only if you're rich enough and make enough money can you participate in what has become, in the U.S., the private markets are now larger than the public markets because the SEC, in the last admin made it so difficult to go public. So it's just crazy, and it's totally antiquated, and I think classist to a large extent. The good news is, I think everyone pretty much agrees with that, on a largely bipartisan basis. The Elizabeth Warren crowd somehow finds issues in expanding access to investment opportunities, and you'll have to ask her about that. But
man, I'd love to have Elizabeth Warren on the show.
But Senator Tim Scott, who's the chair of Senate Banking, this is a big issue for him that he's focused on. So he has a bill that would not change the existing accredited investor qualification rules, but add an additional one. So you would be able to qualify under the existing income and wealth standards, but in addition to that, there would be a knowledge-based test that folks would be able to take in order to gain access to private placements. So right now, a finance professor that makes $180K can't access private placements.
Ridiculous.
And to the extent a finance professor knows more about the risks and can pass this test, they should have access to those investment opportunities.
Yeah.
So I hope to see that happen. It's I think common sense and would be a huge unlock.
Yeah. Well, shout out to everyone watching. Keep watching the Rollup because we're going to help you pass your test. If you guys want access to the private placements, you're going to have to study up. We're going to help you pass these exams so that you can, be up there with all the accredited investors and participate in these private markets.
Yeah, man, I just want to say thanks again for the work on the Hill. It means a lot to everybody in the industry, in Solana, in all the communities. Let's get this bill through, man. Let's get it done.
I know. Fingers crossed, knock on wood, and I appreciate having you on. And it's an honor to do the work we do. So I couldn't imagine doing anything else.
Well, thanks for coming on. Appreciate all the hard work.
Thanks again.
Great.
Yeah. See you
Great
next time.
See ya.
Yeah.
Alrighty, guys, we're live from Dallas,
Yes,
New
we
York
are.
City. It's day 2. We're going to take a quick break until our next guest arrives. See you guys in just a second.
All of these other assets that are coming on chain, where do we see them happening? Do we see it on public blockchains? Do we see it on private blockchains? Do we see these two merging over time? Do we see them being separate financial systems? What are your takes on that? Dennis, maybe you start with
sure. So again, I do think it is use case dependent. We have certain use cases that run on our private permission blockchain platform, which I don't think will ever necessarily leave that platform. And these are primarily ones where we're targeting those efficiencies that we talked about earlier. And the reason why they're easier on the private permission is because we don't have to worry about provisioning wallets or teaching our clients how to use wallet infrastructure. We don't have to do sanction screening, transaction monitoring, all these additional things that come with issuing assets on a public blockchain are a bit easier when we do them within the walled garden. That said, obviously in the second half of last year, we started deploying assets onto public blockchains, and there the idea was a distribution use case, so bringing traditional assets to folks that want to buy them on public chains and really using those networks as a distribution mechanism. The important thing for us is that any network that we deploy on and we build on, we want there to be demand for what we're doing. And so, we, again, going back to I kind of look at the different blockchains as distribution layers, and some of them will be better for certain ones than others. But as far as the JP Morgan side, we will be deploying on multiple blockchain networks.
Same here. We will be deploying on multiple chains. Canton was the first, but not the last. We definitely were intrigued by the compliance features of Canton for all the reasons that Dennis just mentioned, right? There's an element of privacy that you don't want people peeking into other people's wallets and seeing what's in there. We will support public and private. We're actually chain agnostic, and it's really going to depend on where demand is, and our clients had demanded Canton, so that's where we started first. So we have a nicely curated public-private chains, and it's only been a couple of weeks now that the SEC sort of took off the shackles of public chains as well. And we're deploying an orchestration layer on top of it that would allow for a secure movement of tokens among different wallets, different chains to be able to do that. So again, when we talk about being open, we will be open to any blockchain that a client wants to look at, as well as the partners that we bring into our ecosystem. So that is how we believe we can build an infrastructure that's accessible and useful to the market at large.
Yeah, the Open Eden, we look at utilities. So for the most part, it will be public because that is where the flow is, that's where the activities are. So bringing the product on chain is just that one, bring the accessibility. But step two, which is really more important, is to bring on utility. For example, having the asset being freely tradable on decentralized exchanges or having a borrow market. And all of these things are existing in public blockchain rather than private. So for us, really, we kind of go to where the demand is. And for institutions, I can understand why private blockchain would make a lot of sense. But I think for the most part, at least, our existing user base are people that are still trading or living on chain.
Okay, so I mean, earlier in this conversation, we talked about, maybe different types of tokenization would lead to fragmentation issues. But then if we start to launch on this private chain, on this public blockchain, on this different types of virtual machines, aren't we worrying about fragmenting there as well? Like, are we just hoping that one has liquidity, one is like NYC?
When we've looked at different initiatives around
Matter expert, and we'll go down the line.
Cool. Hi, it's great to be here after a 19-hour flight from Asia.
And we'll go down the line.
Cool. Hi, it's great to be here after a 19-hour flight from Asia. So my name is Alvin Ali.
Matter expert, and we'll go down the line.
Cool. Hi, it's great to be here after a 19-hour flight from Asia. So my name is Alvin Ali.
Matter expert, and we'll go down the line.
Cool. Hi, it's great to be here after a 19-hour flight from Asia. So my name is Alvin Ali. Growth at Big Get Wallet. We're building the truly first borderless wallet.
Matter expert, and we'll go down the line.
Cool. Hi, it's great to be here after a 19-hour flight from Asia. So my name is Alvin Ali. Growth at Big Get Wallet. We're building the truly first borderless wallet.
Matter expert, and we'll go down the line.
Cool. Hi, it's great to be here after a 19-hour flight from Asia. So my name is Alvin Ali, Growth at Big Get Wallet. We're building the truly first borderless wallet for everyday finance. So we have about 90 million users globally, where people can trade, earn, and pay with digital assets and stablecoins.
I am sadly only coming with a 30-minute car ride from...
Alrighty, day two here in New York City at DATS. We got Austin Campbell, who caught my eye with a lovely quote tweet of one of my posts about some company that's very well capitalized but not talked about. Not sure if he's going to share, but Austin, welcome to the show, man.
Thank you very much. Happy
Yes,
to be
sir.
here.
It's good to have you, man. I think it was it was one of the revenue tweets. People are talking about revenue now, Austin. People are valuing these tokens like companies now.
I think this has been an alarming development for a lot of the crypto ecosystem, where we lived in this world. I mean, if you rewind the history of crypto, most of it existed in a zero interest rate environment where a lot of investment was very speculative on future value. Now we live in a very non-zero interest rate environment. Are people starting to worry about things like cash flows and actually generating money? And it is a pretty big regime shift in what matters and what doesn't.
Yeah, I mean, definitely. I mean, hyperliquid. I don't know. There's not much else to say. So this company that you were speaking about, there's a company there that is doing a lot of revenue but isn't getting a lot of interest in getting bought out, or it was vice versa?
No, so the tweet was about, so it's a company I'm actually an advisor for called Inca Digital, which is how I know the entire internals. They do what I can best describe as open source intelligence operations across not just the crypto, but forms of financial ecosystems. So most people listening to this are probably familiar with the existence of something like Chainalysis, which is to say that's a wallet forensics tool. You can look at what happened on chain. But if you've worked in anti-financial crime in the fintech ecosystem or the traditional financial ecosystem, usually your best data comes from places like social media, and weirdly still sometimes the newspaper, as bizarre as that sounds. Also fully aware of this, the US intelligence agencies. So there's something called open source intelligence operations, which is taking info from places like Telegram, Reddit, Twitter, WeChat, right, where people talk about stuff. And let me tell you, the number one source of information breaches is people just talking about stuff. Take all of that, slam it through large language models, which is where the AI intersection really matters, because now you can taxonomize that data real fast. And you actually start finding very interesting things on the blockchain, because you could do a huge amount of reconstruction and wallet address connection, or you could break into a Telegram chat and just see the wallet address where the Iranian guy told you to send the money.
Yeah.
Right? And one of those two methods is actually much more reliable and faster than the other if you can pull it off.
Yeah.
So this company exists. Nobody in crypto pays any attention to them. Just so you know, if you're in crypto, they are spying on you and reporting on you to the federal government, because this is their job.
It's exactly what we wanted to hear.
I'm being honest. And they are generating tens of millions of dollars a year of revenue, because a lot of the real asset tokenizers work with these people, because they want to make sure if you're a stablecoin issuer, if you're like a tokenized money market fund manager, you don't want to have Kim Jong-un come into possession of a huge amount of your tokens.
Definitely not.
Right? And the open source component is important, because they're not KYCing everybody or like hoovering up huge amounts of information to create honeypots.
Yeah.
But these sorts of businesses, and this is not the only one that exists in crypto, but they exist and generate very little interest, even in crypto. Like, let me ask you this. What blockchain in the world has the most KYC'd users doing payments activity?
Aptos.
No.
Solana.
Cello.
Cello, right.
And
with their
nobody
mobile
will
app.
know this. MiniPay, yeah,
Yes.
the Opera mobile app. They literally hundreds of thousands of KYC users, and I think 12.5 million actual users.
Wow.
Only the exchanges have larger audiences. Like, yeah,
Wow.
Binance has more customers, fine. Cello token, like total market cap, one of the lowest of all of the chains.
Yeah.
And so your point like really resonated with me, that
Yeah.
we've gone from this meta of like hyper speculative investment to revenue. And I think there's a few projects, like you raise Hyperliquid is a great example of one with positive revenue, but there are many others that are kind of undiscovered right now.
There are. But we don't value revenue in the same way. Like there was a comparison of like Sky and Hyperliquid, and Sky does half the amount of annualized revenue, about 360 mil. Hyper's doing around 8, and it's 1/20th of the fully diluted valuation. So revenue is also not valued equally depending on the sector, depending on the project as well. And so there's kind of also an inefficiency in the way that people are valuing the types of revenue.
It may be an inefficiency. It may actually be crypto, whether we like it or not, starting to become more TradFi.
Yeah.
So if you look at traditional financial businesses like banks or asset managers, they attract lower multiples than a lot of like the speculative tech companies, right? And the reason is there's only so much user growth and margin growth that JP Morgan can have, right? That thing's pretty damn big. But also, in those businesses, the network effects don't work the same way. Like, the more people who use Facebook, the more valuable Facebook is. The same is not true of, like, stocks. Like, it is not the case that if more people have bought a specific stock, that's actually a forward indicator of value for the stock. Similarly, for asset managers, if I'm winning because I have high yields now, if I have lower yields the next year, I actually lose a bunch of my customers. So the network effect is different.
Yeah, and the stickiness of that revenue, how we project forward those multiples. I want to double back to, well, actually, so you mentioned Cello, and you know they have a lot of KYC users via MiniPay. You're suggesting that that customer data is really, really valuable, and a lot of the crypto companies don't have customer data because a lot of this is permissionless and wallets and these sorts of things. It's just keys and coins, right? What, like, you're saying that we should go further into this direction, or more companies, more crypto companies are going to start to look like this? How should we start to navigate like the KYC'd era of digital assets and tokenization?
So one, like, I am very pro-capitalism and pro-competition. My answer is people should experiment and figure out what works, and that the diversity is actually part of the game, right? And that is a good thing for the world. So I'm not specifically saying everybody should go become MiniPay, but I am saying what's odd to me from a market perspective is you have somebody demonstrably doing something different with significantly more users and significant transaction volumes that is being ignored. If anything, my critique is the reverse of like crypto is too monotonic in how it values things. It needs to branch out.
Yeah. Do you, I put out this tweet that was like, if the tokenization thesis is correct, and I think this was the one, trillions of dollars of assets coming on chain, which company is going to benefit the most? The resounding answers were exchanges, oracles, and like DeFi / like lending. Do you agree with that?
No. Yeah, pretty simply, the answer is no. Exchanges will only benefit if they hold on to the customers. But here's the thing. These are currently exchanges for native crypto assets. If you have tokenized stocks, are people going to buy that through Coinbase? Or are they going to buy it through Robinhood? Right? Are they going to buy it through Schwab? And so it may be that some of the winners here are already existing financial companies that integrate this into their existing consumer base.
Yeah.
The other part is, for market innovation and efficiency, the end winner is usually the consumer. It may be that the profits don't accumulate at any company, right? Good example, the stablecoin yield debate. If stablecoins start paying everybody in the current environment, let's call it 3-ish% yields, that's actually into like your pocket and my pocket.
Yeah.
We are the winners. It's not a specific centralized company.
Yeah. I'm a little bit more curious about, some of the things that we talked about early on, which was kind of like this surveillance-ness that you mentioned, and how...
Guys, got Zach XBT on the screen.
So I saw this recently where the Circle froze a bunch of balances.
Yeah.
People were kind of unsure as to why. And Zach XBT says, there was he spoke to one of the affected businesses directly. They stated that it was an ongoing U.S. civil case. Details are not yet disclosed. I'm just curious, again, as we get more into this KYC era of crypto Chainalysis, their entire business is just accumulating user data and labeling more and more wallets. How do you think we're going to react as more of these crypto companies become the central infrastructure that connects a lot of these financial mechanisms together? Here Circle and Tether are freezing Iranian wallets. Good thing, bad thing, permissionless is taken out of the equation. It just looks more and more like, the existing financial infrastructure. How do you think this plays out?
I mean, so I've been saying this for many years, and I think people are only now coming to the problems that I've been identifying. And Zach is very angry with me right now, but I think he's misunderstood the point I'm trying to make, which is that you could pick two of being permissionless, having real-world assets, and having smart contracts. You cannot have all three. And the reason is exactly this, which is to say, take a hypothetical example of a legitimate operating company with an omnibus wallet structure that's got $100 million of funds in there, and it turns out that, 5.9 million of it is the Iranians. A federal judge doesn't look at that and go, oh, those crypto guys got me. They put it all in a pile labeled money. I guess I can't do anything. They'll just say freeze the whole thing and sort it out. And so what you end up is with huge amounts of collateral damage to unrelated businesses and people. But one, a freeze is not a permanent seizure. Most of these people will get their money back after the court proceeding if they're not, literally the Iranians.
Years later.
But two, by having built a system that just ignored the existence of real-world law and how these things historically work in the U.S. legal system, because I will remind everybody, in asset commingling cases, the standard is freeze everything and figure it out. That's true of TradFi companies. Ignore the blockchain. And so you basically said, we're going to be permissionless cypherpunks. We're going to build complex, interconnected smart contract systems, but also we're going to use assets where a federal judge can rug them. What did you expect to happen?
Yeah.
Also, what do you expect the judge to do? You can't build a system where you say, hey, because we made strategic errors, you'll damage people, therefore crime is legal.
Yeah.
So this is where people start to say, hey, Ethereum, Solana, these L1s are actually L2s built on Circle and Tether.
And if you are integrating those into everything, I would tell you that's true, but it's maybe even worse than that. Like an L2 would imply coherent rules on top of that. The bigger problem is that you have a sandcastle built on top of a swamp, and that swamp is the real world concerns around the traditional financial system, because underneath Circle and Tether are a pile of treasuries in the US banking system.
Right. And we've already seen Silvergate.
I was at Paxos managing the stable coins there, and so I was very attuned to this problem, which is that, personal hot take, stable coins should not be on Ethereum in the current way it's designed. Right? It is a matter of time until something like the USD T ETH pool on Uniswap or like one of the major Aave lending pools gets bricked.
Wow. Frozen, just frozen completely.
Completely frozen.
Because we know that there's illicit activity flowing through that pool.
Correct. And the federal regulators are not going to be like, well, you know, we got to protect all these un-KYC DeFi people when we don't know who they are. They're just going to be like, no, freeze
the
it
whole
and
thing.
sort it out.
So what's the alternative?
So there are alternatives. MiniPay is actually a good example of an alternative.
Yeah.
So how does MiniPay work? It is permissionless. It's surprisingly cypherpunk, but everybody has their own segregated account where they hold their own assets. So in that case, if you need to freeze it, we freeze like your $52, not the whole pool.
Yeah.
That's fine. These are little boxes that can all explode individually. Notice what came out in that one, the smart contracts.
Okay.
Another thing you could do is have permissionless assets with smart contracts. I am like a pretty big proponent to Bitcoin. Right? It works great, and that is permissionless, but it's because it's not responsive to any particular local authority. Build smart contracts on that. If you're going to run an exchange that's no KYC, you should have Bitcoin to crypto pairs, not stablecoin to crypto pairs. Lastly,
stablecoins again.
Right. Lastly, if you want to have the smart contracts and real-world assets, then you need a permissioning ecosystem, because at some point, a judge somewhere is going to nuke you. And you need to have an ecosystem that could surgically go in and take out those specific funds to avoid breaking everything, which means controls outside of just the asset issuer. That's the answer.
Austin, last thing for me is, you spent time at JP Morgan, Citi, and Paxos, and more like through lines that you may not have already mentioned today. What should we be keeping in mind as this industry progresses?
I would say the biggest thing is that the crypto people and the financial people have talked past each other in tremendous fashion over the past 10 years. And that is to say, there are real and deep technological innovations happening here that financial people need to be aware of. But there are also basic risk management principles that they have ignored completely and refused to learn from TradFi. We're only really going to make progress if we bring the best of both worlds together instead of continuing to fist fight each other.
Yeah. Awesome. Austin, thanks so much for joining us today. Really appreciate it, and love to have you on again sometime when some more of these debacles play out.
I would be happy to. Thank you for having me.
Appreciate it. See you next time. All right, guys, quick commercial break, and then we will be right back with our last couple of guests for the day. I think we've just got two. We've got Phil from Li.Fi, and we've got our friends over at Framework with an announcement. So stay tuned, guys.
Are kind of the brains of the operation, and I think we can all admit that LLMs, like all of them, they're all great, they're all amazing, they've all been life-changing to me and a lot of people, but like I've seen cases where they still hallucinate quite a bit, right? You'll tell them or you'll ask them something, and the answer might not be completely truthful, or maybe they misread or misunderstood something. Do you think something needs to happen at the LLM layer where it has to mature a certain level so that this hallucination risk goes away? Is that going to be a limiter right now in experimenting this and seeing a lot more adoption where we could see potentially trillions of dollars transacted with AI agents? This is an open question. The rest is going to be open questions, so whoever wants to kind of raise their hand and provide their thoughts.
I have two thoughts. I think first, it's already happening. So I think we're on there's no major breakthrough to wait for, in my opinion. Like all of it is, if you look at the just pace of development of agentic quality, call it, on a year-to-year basis, most of it is already happening. And I think maybe something Alvin was talking about implicitly before is like a lot of this is already happening in trading as well. And so maybe the precursor to like agentic commerce is agentic trading. And we see a lot of people trying to have agents run strategies that I think are going to, for the foreseeable future, run a huge portion of the volume for these agentic commerce protocols will be trading before they are payments, and then it'll switch over to payments. But I think a lot of this we're already kind of on the way. Maybe though the big unlock that we need is about kind of consumer education or user education, which is there's certainly things I still don't trust my agents to do, and until something shifts in my head with regards to the amount of risk, even if I have all the controls in place, until my default behavior is to go and try and spend basically from whatever the agentic interface is, then we will be blocked basically on like intent to purchase. And so having said, I don't think we need anything else. I guess we do need something else, but I think that's more on the human side than it is on the LLM side.
Right. Anyone else? Yeah.
Yeah, I think, look, models are going to change, right? And you know, there'll be, some will be perfect, some will be imperfect. It doesn't matter. I think it's our job to kind of ensure there's a trust layer and there's a policy layer, right? The trust layer comes from, and I'll just give you my framework on it. You know, the point MoonPay CLI serves is effectively a bit of a trust layer because we're integrating everyone else's CLIs. And obviously they're our partners. So, you know, chances of that being rogue malware are zero because, you know, you're interfacing through tried and tested kind of CLIs. But then secondly, there's also a policy layer, which is really important. So if you have the trust layer, great, check mark. The policy layer is, you know, what your wallet can do, cannot do, you know, how does the private key sign things without being exposed? And all that kind of logic, our opinion is should be an open standard, which is why we launched Open Wallet Standard, because 402 and MPP do a really good job at how do you interface on the web in terms of making the payment happen. But they're unopinionated on the wallet layer in terms of where the wallet key is actually residing. So we felt really strongly about that standard and that policy layer being a bit open. So that's why we launched Open Wallet Standard. But I think with the combination of trust and policy, we will continue seeing improvements in LLMs, but it's our job to manage the trust and policy.
Just want to add that I think the breakthrough is already here, right? It's not something where, oh, we've tested something, there's great potential, but we've got to wait. I think it's already here, right? But there are two things important. One is, again, permissions layer. I don't think the LLM can get so good to an extent where you don't have to care about what they spend, right? Maybe that may happen, but it's in what, 1-2 decades? Like you need to make sure that the permissions layer is there for you to control it. And second is then the education, right? Like what Henry was saying. I was just sharing just now off stage where in Asia, there are people, like hordes of people queuing up in parks and paying people to install OpenClaw for them. And then 3 weeks later, they're paying people to uninstall OpenClaw for them, right? Because they realize there's a lot of security violations and so on. So you need to really educate them, what is the risk and how do you manage these risks, right? That is important.
Anyone else on that one? Okay. All right, so I think what a lot of folks, is we have a pretty packed room on this subject right here. You know, a lot of people there. We have some folks from digital asset native companies. We have a lot of folks, and this is a digital asset summit. It's very institutional focused. You know, we have a lot of banks in the room and asset managers and payments providers and such. Maybe if there's anything that you can maybe give some of the folks in the room, maybe a little bit of FOMO in this area, where you can say like, look, here's a real example where we've heard of someone using our product, our protocol, or even anything else, OpenClaw, anything else, that might get people like really, really excited, where they're seeing right now real agentic commerce or real agentic payments or trading happening right now, and maybe like a fun success story that you might have heard in your journeys here so far.
I'll start. I think we see, so on the Privy side, we see about 35% of incoming developers who self-serve today are building agentic products. So they're using our wallet system, our policy engine, and so on to basically give agents funds that they can run with. And so just the sheer volume of experimentation happening, this is always sorry for the VCs in the room, this is always a backwards way of looking at innovation. The sheer amount of VC dollars going into it is pretty wild, and there's a lot of like emergent behavior happening. I think just so that is the first thing that's very exciting, is just the sheer amount of experimentation. The second is, if you look at the volumes going through the protocols, it's still very spiky. So it's driven by like point events. It's still very much being driven, I think, by trading patterns. But at times you get into the quite sizable volumes for things being traded, and so there's real money being put to work basically through these agentic products. I think that's the second. The third is that I think it's actually quite exciting for card issuing. Quite, maybe something that's not intuitive is that I actually think agents will use both digital and fiat rails, and there's a lot happening also on the stablecoin card issuing place where the agents are finding ways to pay not just via agentic payments protocols, but actually by getting stablecoin cards issued that they can then accept. And so I think maybe the thing that to me is most exciting is that this is completely multimodal. It's not like agents get a rail and they can do nothing else. What's exciting about what's happening is that the agents will kind of find, like water, the least resistance to go into to then spend. And so I actually think it affects all of our systems. But the demand that's Stripe is seeing, for example, for how do we price our goods in a world in which a transaction is streaming, it's no longer a single purchase, is absolutely wild.
Thank you.
Yeah, it's completely agree. By the way, especially on the third point, the cards being closely linked with this as a payment method. Agents are not going to care about like you said, it's going to be the path of least resistance in terms of making the payments. But then on the other side, the beauty of this is also it's going to get simpler for the best product to win. Because agents are not responding to marketing and all the marketing materials per se. They just are programmed to get a job done. And I think agentic architectures will also evolve. There'll be some cases in which swarms are needed, and in some cases where a single kind of agent which is heavy on skills is required. And I'll give you an example, one on the e-commerce side, one on the trading side. The classic one is, prediction market trading ARB strategies. And that's what we're launching this coming Monday as a separate CLI, because we realized our CLI integrates a lot of skills, but there's some strategies which kind of can deserve their own kind of standalone version, right? If it's a breakout use case. And the other one is e-commerce, right? Which is, go find me.
All right, we are back on the home stretch of Digital Asset Summit Day 2. We've got our friend of the show, the best mustache in digital assets, Philipp from Li.Fi. Man, welcome to the show. It's a pleasure to have you.
Thanks for having me. Always a pleasure to be here.
Absolutely. Well, you guys, you're at the top of the game. It feels like interop is kind of is it a solved problem? We did it? We solved interop?
I would say interop is solved in many ways, many different ways. And that's also why we exist, right? So Li.Fi as an universal liquidity layer, we are covering all these different bridge architectures, and they all exist for different reasons. Yeah, each design has their own trade-offs. So is it solved? We will see. I think there is still so much more to come with different technologies like zero knowledge proofs and so on. We'll see. We're not done yet.
Okay, not done yet. But you guys are certainly paving the way. I was chatting with your partner Dom, behind the scenes a little bit yesterday, and he just reminded me that you guys have almost all of the major wallets, have integrated Li.Fi's SDK. I think this is a success that's been flying under the radar. Maybe you could just chat a little bit about your success stories, some of the case studies that you guys have had.
Yes, of course. Yeah, Li.Fi grew to over 100 people by now in the past 4 or 5 years. And it was pretty clear a few years ago that the space is going to fragment on so many ways. It was clear we're going to have multiple blockchains. They're going to have different exchange designs like AMMs, pop AMMs, order book chain indexes, and all of that. And then different bridging solutions. Yep. And it was very clear that if there's an application coming from the top, let's say in Robinhood or a wallet, they need to cope with all of that. There's hundreds of API integrations need to be implemented, optimized, maintained. That's a lot of work. So that's a wheel that everyone would have to reinvent themselves. So it was so clear to build a business around that. And 4 or 5 years later now, we have 1,000 B2B clients. B2B crypto.
1,000 B2B clients?
1,000. We crossed 1,000.
Wow.
And you're right, we have almost saturated the market. Within crypto, we're working with almost any institution, from a Coinbase, Kraken, Binance to a MetaMask, Phantom, Ledger, and custodians of all sizes.
So 1,000 companies, like you said, have reached saturation in the crypto native market. You mentioned, a lot of centralized exchanges as well as wallets, DeFi applications as well. I take it at this point, there's an inclination to start to go outward, to start to explore new market opportunities outside of the crypto native world that we've been in for some time. Just talk to us about some of those sectors that you're targeting. What are the categories? Where are you seeing the most the segment that's most ripe for innovation?
Well, RWAs are happening.
Yeah.
And RWAs are exploding on so many chains. And they come via Robinhood chain, they come via Arc, they come via Tempo, they come via Solana, Avalanche. Everyone is leaning into it in different ways with different token standards. So it feels like day one, literally, because also lots of these institutional players are trying to come with their own bridging solutions. We see also like Circle bought Axelar recently, so they are internalizing whatever's out there. Lots of M&A, lots of consolidation, and then things change. And that is essentially for us the same challenge as has been back then. However, I think we just recently solved a very, very big problem, which is multi-chain composability. As things have been fragmenting, we focus so much on interoperability and so on, but what really was missing was composability, that I can actually build on multiple protocols at the same time on almost my contract level. And we have built a virtual machine that really just lives on chain and expresses a domain-specific language in TypeScript. So I can type DeFi workflows within TypeScript. It's being compiled into bytecode and just execute on chain within one transaction. So we can swap, bridge swap, and then zap into Aave, deposit this as a collateral, take that collateral and do something else with it. So that is like true multi-chain composability, and this is something we've been working on for a long time. I think this solves a really big problem.
So we've evolved to this point where we're doing so many of these complex strategies on chain. What do you think is the difference, and from your experience talking through with crypto native applications, but now more recently with institutions, how does their approach differ? Because us as retail, like we've been accustomed to using the chain ourselves. We would go back and forth between chains. We would go to the bridge. We would use Jumper. We would go between chains and these sorts of things. Institutions aren't necessarily clicking the buttons for themselves, and it's with a different asset class. And so I'm curious, how does an institutional approach to cross-chain differ from a retail approach?
Well, that's a big question. It can be answered in multiple ways. I would say when it comes to user experience, many of them are not even at the point understanding what it will mean for crypto native users to navigate to their own chain, to their chain on Canton or to their own proprietary chain, whatever it is, right? Like many haven't even really thought about that. And we are trying to consult them on what does fragmentation actually mean for your users, why they should care about that, why they should care about crypto native users. And when it comes to, also for institutions, it's a go-to market. It's about building brand awareness in a space with a lot of nerds, like deep domain-specific knowledge, people they want to hire, people they want to acquire. There's a lot of knowledge these institutions have to build up internally, right? And yeah, even when it comes to issuing assets, many of them are not even thinking about having multi-chain native assets, which they could have with an Axelar, a Layer 0, a Chainlink, a Hyperlane, a Wormhole, right? Like that, there's this multi-chain problem is not very, very present. Many, like Robinhood Chain, they're simply saying, okay, I want to own the full stack. I like 24/7 trading. Let's start with this offering first, then we can think multi-chain in the future.
And so does the approach from Li.Fi's end, when you're speaking to a Robinhood that wants to verticalize the whole thing versus someone who wants to be a little bit more, maybe a BlackRock that wants to be a bit more multi-chain with BUIDL on almost, every chain at this point, does the approach as you're offering to them these different facilities and services, does that differ?
For us, it's very early sales cycle. Essentially, we educate, we raise awareness and we educate. But then also we have 1,000 clients to show and be like, listen, we know what we're doing. And we're well positioned to help you come on chain as you build out your applications. But I expect an institutional learning curve over the next 5 years in terms of how do we tokenize our stuff, how do we distribute our stuff? And here again, also Li.Fi comes into play, right? You might tokenize your assets, but then you kind of need to sell your tokenized assets to all the players we have already integrated with. So
Right.
here, Li.Fi simply becomes a distribution partner. You don't even have to think about. So we have an open intent system. You can plug yourself in. It's permissionless. You can plug yourself in as a solver and market make your own assets.
Okay.
Right.
Yeah.
So this is where essentially we can really speed up adoption of crypto as an industry, because anyone that comes into the space now needs distribution can just talk to us, and we are there.
Okay, so let's double click into this, because like you said, you have the distribution, you have a lot of these institutions that are bringing more of these tokenized funds, tokenized products on chain. Like the largest announcements here today, all three were these tokenization announcements. It was Securitize working with New York Stock Exchange, Franklin Templeton working with Ondo, and Invesco working with Superstate. It's asset managers at the largest scale working with tokenization enablement partners to ultimately tokenize these things and bring high quality assets on chain. What you're saying and what we've been talking about on the show is that the next step for these tokenized assets is that they end up in DeFi. They end up moving along these different chains, getting collateralized, getting borrowed against, and ultimately becoming productive assets and programmable collateral. Because Li.Fi has the distribution, once these things are tokenized, will you serve these? Actually, there's one more piece that I want to loop in before I get to my question here. We were in DC last week. I was speaking with a founder, and he was bringing up how the one of the main value propositions of blockchain is that right now banks don't like talking with one another. Like, they have their customers, they have their payments, they have their order flow, they kind of stay verticalized. But and so we're not going to see the benefit of blockchain and tokenization on one protocol. We need a credibly neutral layer that works with lots of players in order to facilitate cross-bank, cross-asset manager composability, as you were talking about. That's what I want to ask you about. Is how does this neutral layer that works with lots of players, how will you help to serve liquidity of institutional tokenized products across chains? How does that work? How can you be composable with lots of chains and lots of different banks and asset managers?
Yeah, so you're touching base on lots of things here. In a sense, what Swift solved 40 years ago for banks, we want to do this for crypto. We are talking about fragmented rails, right? Mm-hmm. That's where it starts. And yes, we are credibly neutral, and we will also work on making this provable, by the way. So we're going to make it provable that we are a neutral player.
Okay.
Now, on top of that, yes, after tokenization, the next step will be distribution and making things usable. Distribution comes obviously being making tokenized assets available, but also making it programmable and usable in a way that in form of money markets, for example, right? You want to be able to deposit a certain stock as a collateral in Aave or Morpho, or maybe some beta vaults, and you want to make it work. Yeah. And here, Li.Fi is not only taking care of distribution, but about it tries to enable workflows. Yeah. Workflows that are seamless, that are chain agnostic. Yeah. It shouldn't matter if things have been minted on Solana or on Arbitrum or on Ethereum. It doesn't matter, right? Like, we are trying to pave the way for all of this to happen in a way that everything feels chain abstracted from day one. We've been working for the past few years on across the full vertical stack to enable that from the DEX aggregator to up to like the multi-chain composability VM I was talking about, Li.Fi Composer. Yeah. So yeah, it's a lot of work. Yeah. And obviously also Li.Fi is becoming more compliant.
Yeah, yeah, which is an important piece as as Li.Fi is working more and more with these institutions. Something that you mentioned, also reminds me of another trend that we've been seeing play out, which is this progression from a chain-centric view of the world, where every chain kind of has its AMM, has its lend borrow, has its yield aggregator. If you want to use the applications on a chain, you move your assets there, and then you get access to all those apps. Yeah. We're now seeing this happen in more of an asset-centric view of the world. I have an asset, I want to get another asset. Or I have an asset, I want to earn some yield on it. The yield products are served to me. Anyone who owns these assets, I'm just, hey, do you want 4% yield here? Do you want 3%? And I'm looking at this from my portfolio as the construction of my assets, and then going from there to access the apps that have that asset integrated. So now, just walking through a case study, I'm curious how you might see this working. we had Brian Pellegrino on the show, layer 0, and maybe there's Citadel on the 0 chain, and then there's like Robinhood, right? And Robinhood has a lot of these tokenized equities. How could we see cross-chain bids and asks work when I have an asset on one chain, I just want an asset on another chain? How can Li.Fi help facilitate that type of financial transaction?
Yeah, so there is a smart auto routing. By the way, we have been saying, you spoke about asset centrism.
Yeah.
We recently really went out and said it's about markets, not chains, right?
Yeah.
So markets are where people come together in order to exchange anything.
Yeah.
And it just might be collateral versus loan. And we are trying to look at the space like that. Where are the markets, and how can we enable user flows to these markets, no matter where assets are coming from? So there is a smart order routing component.
Yeah.
At the same time, Li.Fi, to a large extent, to 50%, we are a data company. So we, before someone can trade anything, they need to know, well, what is available, right? So we start by aggregating all available assets across our chains. And after that, these assets have prices. You need to know the prices into which asset are they even swappable.
Right.
It's the next step. And then the third step is, all right, what are the rails that take it from A to B? And do I need to swap or bridge or whatever? So there's so many components. And then the last step is, okay, can I compose this flow within one transaction? And that's like the final step, which then gets signed and executed.
Yeah.
But yeah, it's very multifaceted problem.
Yeah. It's fascinating to see how this space has evolved from just simple interop into more of this universal liquidity layer as a company that's integrated with so many of these asset managers, these issuers, these wallets, these exchanges. There's a lot of order flow coming that needs to be orchestrated across all of these different venues. There needs to be credibly neutral infrastructure that is able to serve all of these venues. Is Li.Fi the place to do that?
Exactly, 100%.
Yeah.
100%. We have always been trying to be as fair as possible in our routing. We also, what we do is, which is becoming more and more important to us, as we implemented hundreds of APIs, we are obviously exposed to their quality of service, right? So we are becoming better and better, like literally week over week by now, where we simply are getting better assessing failure rates and automatically shut down solutions and then shut them on again or shadow transact with them. And like we do multiple things, trying to understand in an automated way what is available, to which extent. We also track latencies, and if suddenly an API becomes too slow, that ultimately means our API is waiting for this specific partner for too long. So timing that out in an appropriate time, and all of these things are becoming more and more dynamic and automated. And that really, what I'm saying is transaction delivery or transaction quality is something we're really focused on this year. And that sometimes might appear like it's not credibly neutral. No, it is. It's all automated, it's all reasoned. And this is something we're really working on, this reasoning on why things are shut down or not being talked to, that we make this auditable. And that we can really say, hey, you made this request, we spoke to these following 10 vendors. We could have spoke to the other 5, but they were deactivated at that moment in time.
They were too slow.
Because they had latency issues, which can prove as well, and like all of this. We really want to become sort of a system of record for this multi-chain environment, which is super important for TradFi to understand why did things happen as they happened. And that's a huge data challenge. It doesn't make money today, but it's important work that needs to be done. And that's what we are leaning into.
Is this crucial for the next 1,000 customers? They want this auditability?
For the next 10,000 customers.
Next 10,000 customers.
For the next 10,000 at least. At least, my friend.
Yes.
Global finance is coming on chain. What do you mean?
Let's go.
Super excited.
Yeah. Man, this is a blast. Any closing thoughts, as we sort of wrap up here? Anything on AI? Just, give us a sense of what's coming next.
Obviously, AI has the same challenge as enterprise, right? It needs policies in which way it is allowed to engage. It needs to find the best routes. It needs to be able to rely on as little third-party APIs as possible. So here again, Li.Fi is extremely well positioned. We recently released our first MCP version, and we already have agent frameworks building on it and sending us samples and demos and so on. It's really cool to see what people are building with it.
Yeah.
And our team is very engaged around agentic commerce and so on. And Li.Fi is going to be a very strong enabler, especially because everything is so fragmented.
Yeah. Man, we just continue to hear, distribution is the moat, and you guys have, 1,000 customers in this space, and I love the mindset of 10,000 more, doing what it takes. Congrats on all the success so far. Really appreciate you coming on. Look forward to the next one.
Thank you so much. It's always a pleasure to talk to you.
Yes, sir.
I love the energy, and thanks. Until next time.
Yeah, we'll see you again soon. Thanks, Philipp.
Thank you.
All right, guys, we're gonna keep it rolling. Shout out Philipp. Another great appearance, friend of the show. Philipp first came on, I don't know, it was 2022, 2023. Absolutely incredible. They're doing great work, and I anticipate they will continue pushing forward. We'll have them on again soon. All right, guys, we are on the home stretch here. The final guest here of Digital Asset Summit Day 2 is coming up very, very soon. We're gonna bring Parker up. He's ready behind the scenes. Without further ado, let's get him up here. Parker Edwards on Frameworks RWA Shift.
How you going? How's
Absolutely, it's going really well. You're closing us out today. Final guest of the day.
Look, it's I've been following along. You guys have been crushing. So
Thank you, man.
always good to come on here.
Really appreciate it. You guys had an epic announcement earlier today.
Yep.
Obex. We've been locked in here, and so why don't you just take us through what you guys announced earlier today?
Yeah. So we just announced we're deploying $1 billion into Obex's first cohort of 8 projects. Obex, just so you know, for anybody that doesn't have context, we work with the Sky ecosystem and administer Obex as an incubator for Sky, for institutional grade, call it like yield products. This first cohort, we have kind of a broad range of companies. We have publicly traded companies included in the batch, all the way down to seed stage companies with people that have been building across finance for 10 plus years. We're covering a bunch of different areas: energy, fintech, AI infrastructure lending, crypto capital markets. We're super excited about it.
So you guys here at Framework have been big supporters of our neo-finance thesis.
Totally.
Andy's on a panel right now giving a talk on neo-finance, and one of the really core pillars of neo-finance is this idea of exogenous yield. We've seen how right now there's this entire hyperscaling race deploying a lot of capital. I'm curious how digital assets, tokenization, and on-chain credit can help to fund and ultimately we can pass a lot of this yield and interest as a result of lending and helping to hyperscale. How can digital assets play a role in this?
So first of all, I think that we're at a time in the industry where we've matured enough to start lending at scale.
Yeah.
Something that DeFi has struggled with, I'd say, over the past 5 or 6 years is this adverse selection issue of we're getting the bottom of the barrel assets traditionally. And I think finally, quite frankly, what Sky unlocks is we now can go compete with the banks and credit funds that are currently funding top tier assets today. You talk about hyperscalers, USD AI is a part of the batch, funding AI infrastructure. Super excited about them. Energy also pretty hot topic.
Yeah.
Daylight, a part of the batch. And then, we have a bunch of things around structured credit. We have a team called River that is going to be a part of the batch as well. We have a very broad range. I also just think you have a totally different type of founder coming into the ecosystem now. You have people that have previously built these products off-chain that now are looking to tap DeFi liquidity. And at some point, we're going to stop calling it DeFi, by the way.
Oh, no, we're calling it NeoFi now.
Yeah. NeoFi, way better.
Yeah.
We're kind of powering this next wave, I guess, with Obex. Look, it takes a ton of capital to be able to compete at scale, and we're finally there.
It's really incredible. I think a good practice here is just let's speed run through the list of the 8.
Let's do it.
And then we'll talk about how all of these companies are using Sky's ecosystem, how this flywheel and Framework Ventures ultimately helps to propel this entire cohort and Neo Finance as a whole.
Sounds good.
Let's start with Maple. Been around since 2021, one of the largest on-chain asset managers, lots of traditional financial experience.
Yeah.
Tell us why Maple is a great fit for this OBEX cohort.
I mean, look, Maple has a track record that is pretty much unmatched when it comes to on-chain lending. Today, I mean, they have like $2.8 billion in deposits, $800 million in outstanding loans. They've also been extremely resilient. And so today, actually, we're deployed right around $600 million into Maple today, into Syrup USDC. And they've been a great partner. So super excited to continue working with those guys.
Incredible. Shout out Maple, Sid, friend of the show, going on for years. Securitize, second company here listed in the press release. Huge announcement, maybe the biggest one this week. Partnership with New York Stock Exchange, the leading platform for tokenizing real-world assets. Over $4 billion. A lot of that coming from BlackRock, also Apollo, KKR, and Van Eck, and just out the wazoo. Digital transfer agent, registered with the SEC, absolutely crushing on all fronts. Hockey stick growth in recent months, and just a leader in the tokenized, the entire tokenization front. Why does Securitize, it feels like maybe they're going on the tokenization front. Why does Securitize belong in this cohort?
So I'll talk about both Securitize and Centrifuge, who are both in this batch. I think a lot of the asset managers are looking for ways to come on chain. This is no secret, it's pretty consensus. But they're looking for partners to do it with. I mean, Securitize, they're working with BlackRock today, they're working with KKR today. We currently work with them on the Sky front. I think Sky is deployed, $1 billion plus into these on-chain products through both Centrifuge and Securitize.
Into products like Biddle and Centrifuge.
Yeah, and JAAA.
Yep.
What I expect here is we will work with both Centrifuge and Securitize to expand the amount of products that will come on chain. I talk to asset managers every week. They're looking for new products to be able to deploy with, and they need these infrastructure partners.
Incredible. Next on the list here, Daylight. We've had Daylight on the show.
Jason's great.
Jason, love what these guys are doing.
Yeah.
They're ultimately, they saw the energy build out happening in the United States, and they said, look, we have on-chain credit technology that can help fund this and ultimately build a decentralized network that helps facilitate the growth of this energy company and redistributes a lot of those incentives across the entire network. Daylight, distributed energy on-chain asset class. Talk to us about why Framework chose Daylight as part of this cohort.
I mean, we've known Jason for a while. I think what they are doing is incredibly impressive. Me personally, I ran an energy fintech company before joining Framework, and so what they're building is super close to home. And just like with them, USDAI, who we'll talk about as well, we're choosing asset classes that from day one can scale. I mean, funding, things like distributed energy, not a new asset class, but it is new for it to come on chain.
Yeah.
It's also just when by deploying via Sky, I think we're able to unlock just scale throughout this. That I don't know if anyone's ever been able to do this to this scale before.
Yeah.
I know USDAI we're probably going to cover. I think they're kind of in the same bucket.
Yeah.
Where just the ticket size to be able to get in, to be able to fund things like data centers and energy, you better be showing up with some serious capital, or once again, we're going to keep continuing to face this adverse selection issue. I think we're going to fix that through OBEX and Sky.
Yeah, and like you mentioned, USDAI, collateralizing GPUs, stablecoin protocol, channels on-chain capital into AI infrastructure. Again, hyperscaling this build-out of data centers, GPUs is a crucial part of the entire energy crisis here in the U.S. And on-chain markets are helping to finance this build-out. It really is incredible. And we saw NVIDIA and Jensen and Chamath talking about Tau and decentralized.
Yep.
Do you think eventually they're going to go a little bit further around the stack and talk about USDAI and collateralizing these GPUs?
I'm super bullish, Connor and David, and what they're building. Yeah, I do think that we're gonna. I mean, capital formation just in general should happen on chain.
Yeah.
And financing AI infrastructure is literally the most capital intensive process that you could choose from, and I do think that they have the potential to really kind of break out here. So,
and just quick side note here,
Yeah.
what is the benefit to capital formation on chain versus the current private market landscape?
I mean, liquidity is one, and also just like if you're somebody looking to get access to these types of products, USDS now will be backed by real world cash flowing assets. There's something pretty special about kind of opening this up to anybody to be able to deposit into. Obviously not financial advice, but we're looking to kind of expand that, I guess, on what kinds of assets people can actually get access to here.
Yeah, incredible. Only a couple more here to go through. Better Home and Finance. This is a public company. First AI native mortgage and home equity finance platform. Why are they included in this cohort?
Vishal is one of the more determined CEOs that I think I've met today. They're building really like the first AI native mortgage platform, mortgage originator. I think they've now originated over $100 million in loans to date. Once again, just an asset class that I think should be available on chain.
Incredible. River, you mentioned earlier, structured credit capital markets. Yep. Just tell us a little bit about River.
So yeah, we, the founders, Braham Mehta and Simon Bokhara, we've been going back and forth with them about some ideas over the past, call it like 6 months to a year almost. And both of them have a lot of experience kind of going, looking at structured credit markets. Brahm has specifically underwritten, billions of dollars in transactions, comes from like a tier 1 fintech company before. And actually, I think this is kind of what we're seeing. Like the best early stage companies are actually the founders who have really just been in their space for a very long time that just happen to now be building on chain. And they're definitely one to watch out for.
Yeah, I mean, bringing industry experience from outside of the crypto native world is almost like bringing capital formation in non-crypto native use cases. It's again, it's exogenous yield, exogenous experience and knowledge. Bringing that, when they find that blockchains are organically the best place to build, they can weave in and intertwine together a lot of the domain expertise that they've found in their respective industries.
Yeah.
TVL Capital, last one in the cohort. Chain traded products, institutional grade secured structured products issued on chain. I believe this is going to be a sector that is just going to explode in growth as more high quality assets are tokenized, end up in neo financial applications, end up in vaults. TVL Capital is doing exactly this.
Totally. Once again, requires the amount of capital to be able to compete with people like banks and yes, they're currently in stealth. I think they also have just a very unique team to go after this product, and we'll have some more news about them here in the next month or so.
Very cool. And so now, just generally, are all these companies using Sky the same way, or are they all doing things a little bit differently here?
So obviously, we have like a very diversified pool of assets, which first of all I think is incredibly important from an ecosystem perspective.
Yeah.
I think Grove and Spark have done a really excellent job, kind of like paving the way for us to be able to go do this stuff. Spark obviously very focused on DeFi. Grove is doing a bunch of things around on-chain credit and off-chain credit as well, actually. I mean, yes. Are they all kind of using Sky the same way? I mean, at the end of the day, we're almost standardizing the way that these companies can access like a global balance sheet, which now is over $11.5 billion in supply, in USDS supply. Sky Frontier Foundation went and published a report back in January. USDS growth is up over 80% this past year. They projected $20 billion in USDS supply. I think kind of the role that we get to play here is by bringing these assets on chain, we get to match the inflows with the types of assets that deserve to be the sources of this type of liquidity.
And where are those inflows coming from? Like as USDS scales from 12 billion to 20 billion, where does that 8 billion come from?
Yeah. So if you go look at what's backing USDS today, actually a very large percentage of it is stablecoins. Mm-hmm. It's USDC and USDT, which is new. So just over the past month or so, we've seen a large amount of inflows come in. We went from 9.5 to 11+ billion in USDS supply, and now we have a more diversified kind of asset pool of assets in USDC and USDT. I think, look, people are looking across DeFi and just seeing yields tank, to put it lightly, and they're also looking for kind of places that have been battle tested. I mean, Sky's been around for now like 10+ years. So, I think as people are going and kind of like comparing apples to apples, you're seeing people obviously kind of wake up to the fact that Sky is probably a pretty good option.
There's a reason USDS was not affected in this Resolve USDR shenanigans. And the reason is because it's battle tested, it stands the test of time, and that's why we've seen almost $2 billion come in as of recently. Man, Parker, anything else here to close this out? I guess anything on Supernova that we want to talk about? Is that relevant here?
I don't have much there. What I would say, if people want to go check out kind of what's going on with Sky, I mean, it's very transparent. You can literally go on info.sky.money. You can go track USDS supply up and to the right, to be very clear. And you can also kind of see where like each star is allocating capital and in what size. It's really the only place right now across DeFi where this is happening at size, all on chain. So we're super excited about it.
Incredible. You don't have to say it. I'll say it. Sky is part of the institutional TWAP. We've got them in our N7 Neo Finance Index. They are one to watch, as well as a lot of the players that are mentioned in this cohort of 8 teams that are the initial cohort. There's more here to come, as I understand it, up to $1 billion earmarked across these 8 protocols: Maple, Securitize, Centrifuge, Daylight, USDAI, Better Home, River, and TVL Capital. So plenty more to come. You guys have been absolutely crushing it. Thank you for all the support on the Neo Finance thesis. And we will keep our eye out for plenty more to come.
Appreciate it, man.
Yeah,
Thank you so much.
absolutely. Thank you for joining.
Yeah.
That's it. Parker closed us out. Digital Asset Summit, day 2. The entire Digital Asset Summit has come to a close here over the last 2 days. Absolutely incredible. I think Andy's still on a panel, so I'm going to go ahead and close this out. We've had upwards of 40 guests. 40 guests? Maybe closer to 30. 30 to 40 guests over the last 2 days. Big numbers here at the Rollup. Couldn't have done it without our team behind the scenes. Megan, Broderick, Atan, shout out to you guys. Shout out to the whole team watching behind the scenes. Leo, Nero, Aliona, Alex, Marcelo. Guys, big shout out. You guys rock. It's a team effort out here. Shout out to Blockworks for having us out. Shout out to OKX for sponsoring the show. Check them out. That is OKX.com, the leading exchange in the Eastern market and making a big push here into the Western market as well. Shout out to all of our sponsors from behind the scenes. And guys, I mean, every guest, I think we did a pretty damn good job covering what has been happening here in the Digital Asset Summit. The entire digital asset world came together in New York City over the next couple of days. We're not taking a break. We will be live from the Nest in the Empire State Building over the next 2 days, and then we're flying out to Cannes. So we are not going to miss a thing. Guys, stay tuned for everything that we have coming up here at the Rollup. We've got plenty more to come. We are just getting started. Lots more action only here at the Rollup. Can I get some air horns? Can we blast? What an absolutely epic last couple of days. Incredible. The energy here, it is not a bear market. It is the institutional FOMO happening right before our eyes in the institutional bull market. It is happening in New York City, and the Rollup is at the center of it all. Guys, thank you so much for watching. We will see you tomorrow on the Rollup. Cheers.